Fifield here, and I have a very special guest on this episode who I'm excited to introduce, and that is Doug Sifu. Doug is the co-founder and CEO of Virtue Financial, one of the largest electronic market-making firms in the world. Around the clock, Virtue are trading in 12,000 instruments across 235 markets and 36 countries with only 140 staff. Virtue often trade more than 4.5 million times a day, and prior to their IPO in 2015, Virtue reported the firm had made profit 1,277 days out of 1,278 days, losing money just one day between 2009 and 2014. And in recent news, Virtue made headlines on the 20th of April 2017 after announcing their acquisition of rival Knight Capital Group for $1.4 billion. Also, well worth mentioning, Doug, along with his Virtue co-founder Vincent Viola, are both co-owners of NHL team, the Florida Panthers. During this episode, Doug and I speak about the backstory of Virtue and the simple philosophy which has enabled the firm to scale rapidly, hitting singles and the law of large numbers, and Doug gives a few words for how others can reach high levels of success. You'll notice this episode is a little shorter than normal, but it's a good one in my humble opinion. So I hope you dig it. Here is Doug Sifu. Let's get right into it. Before Virtue, you were a corporate lawyer, and from what I've read, you were a very good one. You did this for around about 17 to 18 years. How did you go from working as a lawyer to becoming involved in financial markets?
Sure. So it's an interesting question. And, I always tell people a bit of luck, but you do make your own luck in life. So as you said, I was a corporate lawyer at a law firm here in Manhattan, kind of a big prominent law firm called Paul Weiss, Rifkin, Ward & Garrison, international law firm. I had the opportunity, probably my biggest client was a private equity firm named General Atlantic, which is a big global private equity firm, and they hit upon this investment thesis, I'll say, 99, 2000-ish, which was that the financial services industry, particularly like the exchange space, if you will, and the electronic trading space, was going to become further electronified, and there would be an opportunity to assist through, equity capital and, cajoling to transform exchanges, broadly speaking, from cooperative member organizations where a couple hundred mostly white men stood in the ring and screamed at each other into, more for-profit automated electronic venues. And that was kind of their thesis. And so they embarked, and I did all the deals. They embarked on a series of transactions, and I'll screw up the particular order, where they looked at, the BM&F in Brazil they invested in Archipelago, et cetera, et cetera. And one of the transactions that they invested in was a pre-IPO investment in the New York Mercantile Exchange. And the chairman at the time was a guy by the name of Vinny Viola. And so I met Vinny, who's now my partner, and we started Virtue together, kind of on the opposite side of the table. But I was introduced as a lawyer first to the electronic trading and market making space because of my relationship with General Atlantic. And so I got a broad view of how the markets were changing, I would argue for the better, both on the equities and the commodities side, particularly with the NYMEX investment. And then General Atlantic also invested in GetGo, which I'm sure you remember that name. And ironically, I was the lawyer representing GA when they invested in GetGo. And there I was, 3-4 years later as the CEO of a competitor of GetGo. So the world does go full circle sometimes. And so Vinny asked me in 2007, after I'd done some legal work for him, and his predecessor company to Virtue was called Madison Tyler, and I did some work for him there. He asked me to leave my law firm, which was, at the time, kind of a difficult thing to do, and join him as his partner, starting this business called Virtue Financial in New York. And so that's how I ended up sitting on the Skype with you today.
Right. And just for anyone who is unfamiliar, can you just explain briefly what is Virtue in your own words?
Sure. So Virtue is really just a further embodiment of what Vinny was doing on the floor of the New York Mercantile Exchange in the 80s and the 90s. We're an electronic market making firm, and so we make bids and offers and prices across 12,000 different financial instruments in 235 plus markets in 36 different countries, 24 hours a day, 5 days a week, and we do it across asset classes and geographies. It's pretty much all we do is make two-sided prices. We've evolved a little bit. We have some technology services relationships as well, but really just an old school market maker that's used technology and automation to, I would argue, make the markets better and more efficient and provide two-sided prices, connecting natural buyers and sellers and effectively intermediating that risk between a natural buyer and a natural seller.
And what do you think your preference is for being a market making firm? Like, what's most attractive about the business of market making from the way you see it?
First of all, it was all Vinny knew, right? I mean, he was not he was always a local on the floor of the New York Mercantile Exchange. So his ethos, his bias was always towards don't take risk and be notional and directional in positions. Don't bet on the direction of, crude when you're in the crude pit, try to make a tick, making a market between a buyer and a seller in the crude pit. So that's, he grew up as a local risking his own capital. And so our fundamental thesis is that despite, people that write books to the contrary, there's always going to be a need for a financial intermediary. There's always going to be a need for intermediation because the likelihood of buyers and sellers being able to trust each other enough to meet in an open and transparent way and have exact contra interest in the size and price that they want in a particular instrument is pretty unlikely. And so there's always going to be a need for a market maker. You'll have more efficiencies and whatnot, but at the end of the day, there's always going to be a need for a market maker. And so we built our business around that fundamental premise that what we do in U.S. equities is really no different. In fact, it isn't any different than what we do in Australian equities, right? Obviously, Australia's got a different market structure. It's not nearly as fragmented. You've got some regulatory rules that are different than the U.S., but at the end of the day, there are people in Australia that want to buy in the bid and sell in the offer, and we're there to provide that liquidity, on the incumbent exchange and then whatever other competitors pop up. And so we thought that was a more sustainable business model and was a business model that investors would ultimately understand and would be enterprisable. And, thus far, 9 years into the journey, we've been, I hope, proven relatively correct.
Yeah, so you said right there, you're 9 years into this. You started Virtue in 2008, and you gave some stats just before. You said you're trading in 12,000 instruments, 235 markets in 36 countries, all since 2008. How have you been able to fuel such massive growth in less than 10 years?
You know what it is, and honestly, a lot of that was early on. It's really just doing one thing and doing it well and just repeating it. In other words, like when you don't make money because of some hook, because you're faster than somebody, or you have some access to customer orders, or you have this or you have that. Now, for the record, none of those things are nefarious. None of those things are illegal, right? It's not illegal to buy customer order flow. I just don't have that business. It's not illegal to be really fast between New York and Chicago, right? The notion that latency arbitrage is inherently, evil or illegal is just, to me, silly, right? So it's not like I have a moral or certainly not a legal issue with any of the things that these other firms do. It's just not a sustainable business model because at some point the universe gets more efficient and commoditized, and you see it with speed. I mean, people, when we first started this business, going between New York and Chicago, by say New York, I mean the data centers in New Jersey and Chicago, was 16 milliseconds round trip, 15.9 to be precise, right? And then some smart guy said, you know what, if I spend $100 million and dig through the Allegheny Mountains, I can shave that to, I forgot what spread networks was. So it'll show you how much the market's evolved. And that's when Michael Lewis wrote his book about spread networks. It isn't that evil. It's not evil. It's just commerce, right? Someone smart and figured out that they could sell this to people that wanted to be fast. And then someone said, you know what? Well, data travels through air faster than it travels through fiber. If I create a microwave network that is pretty straight between Carteret, New Jersey, and Aurora, Illinois, that I could sell that to somebody else. And so that's just, how it's evolved. Is there going to be, a laser beam or a blimp or something else that's faster. I don't know. I hope not. But at the end of the day, that's not we didn't think that being faster than anybody by a millisecond, a microsecond, a nanosecond was a sustainable business model. That's not to say, unhappily, we have to invest tens and tens of millions of dollars each year in technology to keep up with the speed of the market. But at the end of the day, that's not why we make money.
Well, let's talk a little bit about why you do make money. Let's talk about your strategies there. So just explain for us, I think you may have already briefly mentioned this, but from what I understand, Virtue takes no directional trades. Is that correct?
Yeah, I mean, look, obviously there's risk in what we do. I mean, when the Flash Boys book came out and we had our famous histogram of how we make money every day, there was this natural or unnatural hysteria around it. We must be cheating and this and that. We don't take risk. Of course we take risk, right? We're putting out bids and offers. And if some natural buyer wants to come in and smash the ETF and the futures book in instruments we're making markets in, we're going to lose money. That's the risk of being a market maker, right? So, but what we won't do is by proffering our bids and offers when we are interacted with and we have a position, and obviously we've entered that position because we think we can make a tick, whatever it's a penny, an Australian penny, or whatever the future increment is in the futures exchange, which we're trading on. We try to make that tick. That's our business model, right? Buying fives and selling sixes. If it becomes apparent, and this happens quickly and it's all automated, that we can't sell sixes, we very quickly try to sell fives. And if we think it's going to go down to 4, we'll cross the spread and take a loss. We don't sit there and hold a position, praying for mean reversion, that kind of thing. It's just not it's not our DNA. And so in that sense, we're not taking directional risk around the bid and the offer, if you will, and the price discovery at that increment. We are obviously taking risk. I publicly said many times we trade somewhere between $3.5 and $4.5 million times per day. Obviously, not 100% of them are profitable. Hopefully more than 50% of them are profitable on every given day, and that's why we make money.
Yeah, you've also said publicly as well that you have around about a 51 to, I think, maybe a 52% win rate on average. How are you able to achieve that by not taking directional trades as such?
Well, because obviously we're pretty good and pretty smart about where we're trying to price a particular instrument, right? I mean, there's always going to be a natural price for a particular instrument. We're only going to offer, to buy and sell GE on particular venues because we're looking at the market data and we're thinking, well, we're the bid side or the offer side is stronger, and so we're going to bias one way or the other. That's just kind of classic market making. And when you're trading an ETF against a future, there's a natural spread, if you will. It's not going to be zero. Maybe it's a penny, maybe it's 2 pennies, if you will, depending upon what the increment is between those two instruments. So it's the same way, that a market maker would make a profit 30 years ago. We just do it a lot more efficiently and a lot faster. Now, there's a criticism. People say, hey, you're not really a market maker, you're not taking risk, blah, blah, blah. I would say, listen, then call it something else. But the notion of somebody holding inventory and saying to customers, okay, I'll buy or I'll sell, and I'm willing to take the risk, that just doesn't exist anymore in most asset classes, because the reward of being a market maker, it doesn't offset that risk. So let me be specific. So when you were making a bid offer spread of 25 cents a share in 1982 on the New York Stock Exchange, sure, you could afford to hold more inventory because you would trade a stock, a blue chip, all day, and you'd make $25,000. Now you make less than a penny, and you are not making $25,000 in any symbol unless you're taking risk. So the reward available to the market maker, the financial intermediary, the whatever you want to call it, the liquidity provider, is completely different. And so as a result, the role and function and the behavior of the market maker has evolved to more of, I would argue, kind of what we are, which is, a financial intermediary that's using technology to, hopefully process as many transactions as you can. And at the end of the day, have more winners than losers. The most important thing also, because we win 51% of the time, which we have publicly disclosed in certain periods, doesn't mean we're losing 49% of the time. right? And what we've never disclosed is what's our scratch percentage. When do we break even? We buy fives and we sell fives. Maybe we pay a little bit of fees, but at the end of the day, that's really an important part of being a more risk-averse style market maker.
No, that's a good answer. And can you also explain how the law of large numbers is built into what you do? Because I know that plays a big part of Virtue.
Yeah, it's a funny story. If you Google around about Virtu, all of a sudden there was this article, and although I do media, I honestly had nothing to do with this one. So this is professor of astrophysics who I've never met. I spoke to him one time after the article came out, who was fascinated by Virtu apparently, and so he pulled up our S1, which is our IPO filing here in the States. And we had some statistics. You cited them in terms of how many times we trade, how many times we win. And then we said he assumed what our scratch percentage was, and I'm not going to comment whether he was right or wrong and whatnot. And he said, everybody that assumes Virtu is cheating, and all these people that are all hysterical, Michael Lewis running around with their hair on fire, you're all just wrong. This is just the law of large numbers. If you do something a lot and you win more than you lose, you shouldn't lose money in any day unless you have an operational screw up. And so he said it's basic high school statistics. I never took statistics in high school. He seems like a smart fellow. And he came up with a number. As long as you trade more than 800,000 times a day, he had some assumptions about what our scratch percentage was. He's like, Virtu shouldn't lose money unless they go down or have a blowout or this and that. And there was an article, he got quoted by, I don't even know who the reporter was in the Wall Street Journal. So I called the guy up afterwards and I said, I just want to introduce myself. You seem very fascinated with my firm. And he was, a lovely guy. And he was into, the whole New York to Chicago route because he was a physicist and he was into speed and whatnot. And he was just fascinated by this. And he thought it was, frankly, silly and immature that people couldn't understand that there was a business model that had developed this way. And, certainly we've got really good risk controls and technology. And, there's a big barrier to entry to what we do. But once you've done it and perfected it, you should be in a position of making money every day. And so he described that as the law of large numbers. Again, I'm a liberal arts guy by background. I talked to some of my smart mathematicians and physicists, and they said, yeah, it's a good article. The guy's 100% right.
Yeah, it is a good article. I have read that. And what I'll do for anyone listening to this podcast is I'll put a link to that in the show notes at chatwithtraders.com so you can find it there if you also want to read that. Now, you started Virtue in 2008. So, we're talking 9 years ago. Have you noticed the space that you operate in becoming more crowded, more competitive in any way? And how are you guys dealing with that?
Yeah, it's a great question. So we started in 2008. In 2011, just so you're clear, we actually combined with a predecessor firm that Vinny still owned a significant interest in. He was not active in it, a firm called Madison Tyler, which was a pretty big, they kind of did what we did. And so, we consolidated it and became bigger, and it kind of helped jumpstart some of our development. But, certainly there are firms that existed then that don't exist now that have tried to get into this business. And there's been, a handful of firms that have announced they're either getting out of the space because, the margins, what I'll say is the margins on an individual basis, an individual strategy, an asset class, are very, very challenging. Like if you want to be a U.S. equities electronic market maker, let's just suppose, we spent, and this is all public information, we spent about $70 million last year on our technology, market data, infrastructure, right? That's, public information in our 10K. Now, a lot of that was for our U.S. setup, right? Because NASDAQ and New York are very expensive in terms of colo and market data. And, we have to have the connections and redundancy between New York and Chicago. We got to be at the ICE Intercontinental Exchange Data Center in Chicago and the CME in Aurora. And there's at least 3 data centers and there's a couple smaller ones in Carteret. So all that costs a lot of money. That infrastructure and footprint you need for U.S. equities. Okay. If we were only running U.S. equities P&L through there, you can look at our the $400-odd million in net trading revenue we generated last year, and you can kind of do the math and figure out how much of that, because we disclose it, is U.S. equities. It's somewhere between 25 and 30%. I forget the exact number. And then if you take those fixed costs and say, well, a good chunk of those are allocable to being, to the United States. And then I'm not, obviously you need people and you need licenses and you need a broker dealer. If we were just a U.S. equities market maker, it wouldn't work. We wouldn't be profitable. The secret to our business is that there's not a secret. It's just a scaled business. That same infrastructure I described to you, we use for FX, we use for metals. Indeed, we use for a lot of our trading around the world because there's a lot of futures listed on the CME that are relevant in Japan and in Brazil, for example. And so it's enabled us to grow. There are firms that have started and tried to be U.S. equities market maker that haven't made it. There are firms that relied, I would argue, largely on speed or largely on a real volatile market that have seen their profits, dwindle. And the costs of maintaining that infrastructure I described, I think we're pretty efficient. We got 235-ish venues that we connect to, and all the data centers all around the world, and all the servers and whatnot that we have to buy. And so we spend $70 million a year. It's kind of been, a big barrier to entry, and also it's made it more challenging for what I'll say is smaller firms to, be successful. So you've seen some consolidation. There's a firm called Chopper that kind of folded up shop and sold some of his assets. Tesla Technologies has announced they're getting out of the HFT game and going to become more of an asset manager. In fact, we have a deal to buy some of their telecommunications assets. So these are good firms that were, based in Chicago, New York, or whatever it is, that are either folding up or selling their assets. So I think you're going to see a further consolidation in this space. It's not that easy to be, meaningfully profitable on a grand scale.
Yeah, and I like how you describe it as a scale business. I think that's very cool. And one of the reasons you're able to do that is because you have very good risk controls and your ability to manage risk. On the counter to that, what are the sort of potential risks a firm like Virtue could be vulnerable to?
Well, look, there's, obviously we can't believe our own BS, right? We're connected to a lot of different venues around the world. I don't want to insult anybody, but we're subject to the lowest common denominator of technology in the world, right? The trading world. And so when we put out bids and offers, that's real risk, right? We trade a lot, 4 million times a day. You can only imagine how many orders we're putting out there, right? It's multiples of that, many, many, many multiples of that. And so we have to be very cognizant of the acknowledgement, if you will, and the management of those orders in a way that is seamless. And human beings have to do that. You cannot rely on, technology alone to do that, because a human's got to react and say, hey, we put out this order, we haven't seen it. Or on the contrary, you can have a situation where, your algorithm's screwing up. It's mispriced something. It keeps sending an order on one side of the book. It's lost a lot of money. It's made too much money. It's not designed to make a lot of money. Maybe it's, mispriced a spread. And so we're very cognizant of that, and we've sacrificed, latency by having a lot of pre-trade risk controls, but we also have a lot of what I would say are real-time post-trade risk controls, where we're doing real-time, house versus street reconciliations to manage that risk. Again, I come back to when you have a singular mission, posting bids and offers, when you have a single platform, if you will, a single engine that is multi-asset class, multi-currency, which Virtue is. When you don't have pods, you don't have, trading pods. It's really just one open environment where everybody kind of collaborates and sees, kind of what the firm is trading and what the reaction times are and whatnot. That will mitigate the risk. At the end of the day, though, look, we can't believe our own press clippings, right? We spend a lot of time and a lot of money always trying to improve. And, hubris is a horrible vice. And so we always live by the credo, there but the grace of God go I. So risk controls are really, really important here. And when you own and operate and manage a very large integrated technology firm like we all do, we have to be really vigilant to ensure that, we don't have material losses.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Now, we've kind of spoken about this a little bit, but Virtue went public, listed on the NASDAQ in April 2015. During the IPO process, it was released that you guys had one losing day in 5 years, which, I think you might have brought that up just before. And that one losing day was due to operational error, not so much strategy. Since this info came out, are you able to comment on how many losing days Virtue has had since?
Well, I'll tell you why I can't, okay? Because I put that in there, and it was entirely my fault, because I thought it was going to be well received, not because we were an arrogant, cocky firm that never lost money and we were cheating and ripping everybody off, a la oh my God, I blanked on his name. Michael Lewis in Flash Boys. See, he's out of my consciousness. I forgot his name. I put it in there because I wanted to show everybody, look, we're not swinging for the fences. I don't know if you follow American baseball, but I assume you do. We're a firm. I'm a sports guy. We hit singles, right? There's no shit. You'll score a lot. I said this to my son who's a baseball player. You'll make a lot of runs if you get walks and singles. You don't have to hit a grand slam. That may look good, but if you hit a lot of singles, you'll make money. So the idea was, let's show people over a prolonged period, not that we didn't lose money, that the P&L, the net trading revenue associated with this firm, was really tightly packed in a range on most days, and that there would be some outsized days where there was extreme levels of volatility or surprise announcements. The U.S. government gets downgraded by S&P, whatever it is, where we're going to make a lot more money. But for the lion's share of days, we're going to be between X and Y. And so statistically, you could say, okay, well, I know these guys are telling us they don't take risks, they're market makers, but how do I know they don't make $4 million one day and lose $2 million the other day? That was the virtuous reason we disclosed this. Okay, the world went crazy, and I spent a lot of time talking about this stupid histogram, and I regretted that I put it out there because it created all this nonsense. The guys at Zero Hedge going crazy, writing a whole bunch of just crap, to be honest with you, and nonsense. And I said, you know what? This is stupid, right? The world's changed a lot since then, but this is stupid. It's not really adding any value to the conversation. And so I vowed that I would never, ever disclose it again, and I haven't. So long-winded answer, you're not going to get it out of me.
No, that completely makes sense. And I mean, for anyone, if they actually understand the law of large numbers and they understand how much volume and how many trades you're taking, it just kind of makes sense. Like it works out that way statistically,
Yeah, I mean, I appreciate you saying that. I would say, in fairness to the universe, because I try to be a fair guy, I think people didn't really get that. And then, unfortunately, Michael Lewis came out with this book that might have described the market in 2009. It didn't describe the market in 2015. He didn't really know what the hell he was talking about. And at the end of the day, it was irresponsible what he did. I don't blame him. He's an author. He's a fictionalist. He, is anti-money. He's anti-Wall Street, all that kind of stuff. I get it. I don't begrudge him making his money. He's a capitalist dressed up like a communist. And, that's going to get me in trouble. I don't care. At the end of the day, when people really got under the covers and looked at this firm in 2015, 2016, and now in 2017, they completely get it. It's why we've announced that we're in collaboration and partnership with, JP Morgan, right? They wouldn't be doing business with us if they thought there was something nefarious going on. So the world's evolved beyond all that nonsense. I think ultimately, and you're going to be surprised to hear this, Michael Lewis did us a huge favor. By writing his, fictionalized nonsense, he forced people and us saying, guys, that's just not true. We didn't do that publicly. We said it privately. Come on in and look at our firm. He forced people, market participants, to actually take a look at what these firms were doing. And not just Virtu. We don't have a monopoly on, trading and excellence. There are a lot of great firms that do this. He forced people to look at it and say, maybe there's a different way of doing this. And as a result, there's a lot of great firms now that have benefited because, investors, large banks, folks on the buy side, look at this and say, maybe this actually can help the markets. Maybe the markets have gotten more efficient. Maybe guys like this that are efficient about risk transference are better than the old way we used to do this. And so at the end of the day, and regulators the same way, right? I mean, we had the SEC and FINRA and the CFTC and the FSA and ASIC and a whole bunch of other folks into Virtu. We completely opened kimono with them and said, guys, we got nothing to hide. All right. I don't want to talk about this book. I don't know if it's true or false. It doesn't have anything to do with my firm. And this is what we do. We think we add a lot of value. Are we perfect? No. Do we get fined occasionally? Of course we do. A lot of rules we got to follow. Sometimes we have, traffic tickets and foot faults and all that kind of stuff. But at the end of the day, this is a firm that's here to stay, and it's very important to the ecosystem. That was the conclusion that I think 99 people out of 100 that have come in here have reached that conclusion. So 2017 has a much different feel to it than 2014, thankfully.
Let's step aside from markets now. You've done extremely well for yourself. What does it take to reach such levels of success as an entrepreneur? You own the Florida Panthers, you're CEO and co-founder of Virtu. What are some of the things you've done differently to get to where you're at today?
The honest answer is, like everybody says, I was, I guess, a reasonably smart young man, more liberal arts than math or science, ironically. I did work my ass off to get good grades in high school. I got into a really good college here in the United States called Columbia. Very proud of that. I did really well in college. I went to a really good law school. Because of that, I went to work at one of the top law firms. And then when I got to a law firm, I worked my ass off because I wanted to become a partner. And more importantly, I kept my eyes open and just learned a lot about a lot of different things. And so I'm pretty well rounded. And because of that, I got, some really great clients, customers. And I worked on some really, top flight deals. If you Google my, deal life, I don't even remember, half of them, but I did a lot of big M&A deals and all that kind of stuff. So I got exposed to a lot of stuff as a lawyer. And because of that, I met, this unbelievably talented creative entrepreneur guy named Vinny Viola. We became really good friends, and, he opened my eyes to a lot of things, and I think I helped him a lot. We worked really well together. So the moral of the story is, you got to work your ass off. You got to have some innate ability, but look, I'm no genius. I'm the dumbest guy at Virtu. I'm proud to say that. I interview everybody that comes in this firm. I took the same written IQ test that all of our traders and developers take. If they don't score higher than me, they can't be hired here, right? Because I got to be the dumbest guy here. And, to have the confidence to be able to hire really smart people and empower them, I think that's why we've been successful. So you got to be smart. You got to work hard. You got to have, decent people skills, I think, to have that. And you got to be modest enough to know what you don't know and to, gather around you in a very virtuous and fair way people that can, will add more to the institution than take away and will help you create a great business. I think that's really been, people marvel at our culture. They only have 140, whatever it is, people. And there are, competitors have 500, 600, 800. It's because there's no politics here. It's a flat organization, and we empower really great people, really smart people to, as Vinny would say, to actualize their potential. And I really do believe in that. So that's really been, if I could say, what's the key to my success? It's just been, hard work. A lot of, a lot of good people along the way helped me out a lot. And ultimately, just putting my nose to the grindstone in 2008 to learn a business. To be honest with you, I had really no clue about anything when it came to the financial markets, other than as a lawyer. And I didn't know EBS from eSpeed. I used to, like, on my desk, I would write down like little cheat sheets, because when I would talk to people, I'd be like, okay, is eSpeed the fixed income one again, or is that EBS? And then I couldn't remember, like, the symbols for each of them, all the expirations for all the futures. I wasn't built that way. And so, I was a first year associate again in the law firm. I was the CEO of a firm, but I was the dumbest guy here, and I really had to learn it from the ground up. And that's what I did.
Yeah. And that's what I find so incredible about your story, Doug, is that, you did 17, 18 years as a lawyer, left that, went and started something totally different. You started Virtue with Vinny, and, you're now one of the biggest market makers in the world, and you've reached that level within a very short period of time. You know
what? Here's the other thing I would say is you can't, titles are absolute bullshit, right? It doesn't mean anything. I was a lawyer. Yeah, so what? You know what I mean? I'm a smart guy. That's the same thing I have around here. Like, we don't have titles for people, not because, this is some like great Harvard Business School case study on how to, run a company. It's because I think they limit people, right? Like, if people just said, oh, he's just a lawyer, and they would kind of like poo-poo me, I don't really care at the end of the day, because it doesn't affect my life. But you know what? I'm a smart guy. I can figure it out. Same thing like on the hockey side. People are like, well, you don't know anything about hockey. I said, well, I'm a pretty smart guy. Show me some data statistics. Maybe I can figure some stuff out. That's kind of how Vinny and I look at things. And, give Vinny all the credit in the world. He was willing to take a risk on a guy that, the rest of the universe would have said, well, look, he's a really great corporate lawyer, but is he really a businessman? Can he really figure this stuff out? And Vinny was, I guess the word is courageous enough to, take the risk on a loudmouth lawyer like myself.
I love it, man. That's awesome. On that note, Doug, let's call this a wrap. If anyone listening wants to follow you or find out more, where is the best place to go?
Well, we have a website. It's not the greatest website in the world, but we are a public company, so we got a website, and there's obviously 10K. And then my email address is pretty easy. It's dcifu@virtu.com.
Okay, and you're also on Twitter as well. What's your Twitter handle?
Well, this is really embarrassing. I have to say it, I guess. It's @DougieLarge. And not because I'm like some rich guy, it's because I'm a little overweight. And I had a client years ago used to say, hey, Dougie Large, the man in charge. And I thought that was kind of funny. So
it's kind of catchy. Cool, man. I'll put a link to that in the show notes, as well as the other things you mentioned. Doug, I really do appreciate you taking the time to come on Chat with Traders podcast. Thank you very much.
All right. No problem, my friend. Good luck with everything you do.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's up, team? I'm your host, Aaron Fifield, and this is episode 123. It's a big episode, and I hope you listen right through to the end because there's a lot you can gain from my guest, Darren Reed, who can be found on Twitter at LiftTheOffer. Darren's been a stockbroker, the head trader at a $300 million hedge fund, and an active prop trader at Australian firms PropX, Allium, and Genesis. At the later two, he also mentored traders as a part of his role in trader development. This year, 2017, Darren has returned to Perth on the west coast of Australia to establish a new proprietary trading firm with a few partners called Signet Trading, which is spelled Cygnet. The main focus of this episode can be summarized with just a few words: grit, hustle, and intent. Further, Darren speaks about paying your dues and what it takes to be a good trainer and a good trainee, why your environment is everything, and a window into the life of a discretionary prop trader. Full show notes for this episode can be found at chatwithtraders.com/123. And that's all from me. Please welcome Darren Reed. Enjoy and pay close attention. Okay. Darren, I'd like to spend a little bit of time talking about your experience because you've done a bunch of different things. You've worked at a hedge fund, you've been a broker, and also a prop trader, which is where you're at currently. So just backing up a bit, how did you get your start as a trader? Let's start there.
I guess it's a fairly convoluted story. And if I track back and kind of think, how did I get into the industry and how did I get to where I am? Like, if I'm really honest, it all kind of started at high school. So I think we probably need to go even a little further back. So, and if it sounds like I'm just telling old war stories about high school, I promise I'm not. I'll loop it around and tell you exactly how this all kind of happened. So, like you can probably tell from my accent, grew up in South Africa. I've been in Australia now for about 12, 13 years. Had a couple of years in the States, as you mentioned, at a hedge fund. But when I was growing up in South Africa, I went to an all-boys high school that was pretty famous and pretty well-renowned as a really good kind of rugby school, sort of like perennially in the top 3 to 5 schoolboy rugby sides in the country. Pretty old school, lots of tradition, all that kind of stuff. And it was a public school, but because of the level of rugby we kind of played at, we played sports against all of the private schools in the area, right? So we were the one public school, and we were playing against all these private schools. So basically, they had just like better everything, like better food, better sporting facilities, their boarding houses were better, like everything was just better. So like I'm sitting down as I talk about it, I can remember, to give you an example, a story about that. Like typically on any given day during cricket season, let's say, there was the under 13 A's to E's, let's say. So under 13 A's, B's, C's, D's, E's, all the kind of way down. If we were playing away against one of these other schools, one of these private schools, because obviously if you're going to play cricket at an away school, they'll feed you for the day, you'll get lunch there. Guys would literally make teams just to go and eat food at that school, right? So all of a sudden there was like an F team, a G team, an H team, and it was literally just dudes trying to get on the bus to go and eat at the other school. So long story longer, basically what happened is that we were bred all the way from the beginning with people telling us, look, you don't have the best facilities, you don't have the best boarding houses, you don't have the best rugby boots, you don't have the best cricket bats, you don't have the best anything. But what you do have is teamwork, they bred into us like this attitude of just, the best word is just grit, right? Like just that underdog, like bulldog mentality from day one. It was absolutely indoctrinated into you from day one. And so I went through my entire upbringing, the years when you're kind of being formed as a person, right? It's like between 13 and 18, with that really being like drummed into my head that it doesn't matter what the obstacle is. If you put your mind to it, you trust the process, you just, go as hard as you can at your challenge, and you work as a team, that you can achieve great things. And I think what really cemented that in my mind, and I promise this, we'll get back to trading. What really cemented that in my mind was when I got to my last year of high school. Okay. So, like I said, very prestigious rugby school. So from day one, you get there, and I was just like, all I want to do, my entire focus in life was just, I want to play first team rugby. I want to play first team rugby. I want to play first team rugby. As long as I pass, I don't care about getting A's. I don't care about being anything. All I want is, I just want to play first team rugby. Like, that's the highest standard you can achieve at that school. So in my last year, there was actually a guy who, and I played all the way like through the A grades, 14A, 15A, 16A, the whole way through. And then a guy actually transferred from another school, like just absolute stud athlete, total machine. Like, he actually has also immigrated to Australia a bit before me, and is, I think, Australia's strongest man. Like, he's competed in the world's strongest man and all this stuff. So like stud athlete. He moved over in the last year, right? So everyone's kind of like patting me on the back and going, well done, mate. You'll be second team captain, which isn't bad, et cetera, et cetera, et cetera. And I kind of sat back and I thought, you know what? I can't control who the coaches pick. I can't control if this guy's moved over. I can't control any of that. But what I can control is I control my attitude, and I can control the process, right? So for 5 months, I got up at 4:30 a.m. I trained for 2 hours every morning. Like, I just did everything I could. And I just said, all I can do is like just trust the process, right? Trust the process. And, to wrap this kind of whole high school war story thing up, I ended up playing first team rugby the whole year through, played for the town kind of under 18 side, the state under 18 side, like the whole thing. It all kind of worked out perfectly. And that was a real lesson to me in just trusting process, and just, like I said, that attitude of just grit and just grinding through day by day. You don't want to get up at 4:30 a.m. It's not comfortable. It's not easy. But if you want to achieve something, that's what you're willing to make that sacrifice, right? So coming out of high school, I didn't know what I wanted to do with myself. My dad's an airline pilot. My brother came out of high school and straight away went, bang, dad, flying school, let's go. I wasn't sure. Like, I didn't know exactly what I wanted to do. What I did know was that I loved being in a team culture. I loved being in a culture of excellence. I loved being in a culture of competition where everyone is competing with each other, yes, but also pushing towards the same goal. So like, if you have a cricket team or you have a rugby team, you've got, sure, 11 guys go in the field or 15 guys go in the field, but you've probably got a squad of 20 guys, 30 guys that you can pick from. And the best environments are environments where, sure, Darren and Aaron may be competing for the same spot. Okay, we're both going for that spot, and we are going as hard as we can at each other in practice, and we're both doing everything we can. But there's no animosity around it. There's no ill feeling around it, because ultimately we're doing it so that we can all achieve, right? We understand that I'm pushing you, you pushing me, and we're helping each other be better. So I knew that I wanted to be a part of something like that. Once I finished uni, I have an uncle who lives in the States, and he'd been there quite a while. And he was actually a pastor in a church. So like that's one of these huge, 1,000 people in the congregation type of thing, churches in a town in Connecticut in the States. And the town just happened to be basically one of those Connecticut towns where if you were doing really well on Wall Street, working for a bank or a hedge fund or whatever it was, you probably lived in one of these towns in Connecticut and commuted into the city every day. So, you may or may not know, but there's two towns along that line, Stamford and Greenwich, which eventually became sort of like, in the day, hedge fund central, right? Because the guys got sick of commuting into the city and started moving their offices out there. So I just said to my Uncle Mike, I was like, Uncle Mike, listen, can you kind of, help me out here? Give me a couple of interviews, whatever. And he said, mate, no problem. These guys are, they sin from Monday to Saturday and they're in the church on Sunday repenting their sins so they can do it the week after. So basically that's how I made that connection, right? And I ended up getting an internship at a hedge fund in New York. And I was there for, I think my internship was initially for like 8 weeks, something like that. And they eventually asked me to stay. And during that time, I rotated through kind of each part of the business. So I rotated through the back office. I rotated through, the sales desk. I rotated through client relations. I rotated through legal. I rotated through all these different areas of the business. So it was a real good exposure for a kind of young, fresh-faced kid to all these different parts of the business. And the last part that I went through was the trading desk. The guys who started the hedge fund were an ex-investment bank prop trading desk that had broken off, got seeded, and they'd started the desk. And I remember, like, distinctly walking into that room and just going like, I am home. Like, this is where I belong. And I didn't understand, I promise you, Aaron, like, I didn't understand what they were doing. I didn't understand how they were doing it. I was such a dumb kid at the time. But just the energy in the room and the way they reacted to each other, like I was back in that environment. And that's really where I went, okay, I don't know what these guys are doing. I don't know how I become a part of this, but this is where I belong. There was just that electricity in the air where it just clicked. So that's kind of how I realized, okay, like this is the world that I want to be involved in.
Right. Okay. So you came to that realization, and that was during I think you said it was an 8-week internship. What happened after the internship? They obviously kept you on. Whereabouts did they put you?
Yeah, so they kept me on. I was there for, it was about 18 months, I think, somewhere around that. And basically they were said, okay, well, you're on your path now, right? So you go into the back office, you start, doing the grind there of, reconciling trades, all that kind of stuff. You got to remember that a lot of the things that happen in the back office now just automatically were all done still manually back then, right? So a lot of just that grinding, type of very dull, monotonous work. But that's a part of your learning curve, right? That's a part of your business. I'm a firm believer in the fact that you have to pay your dues. You have to pay your dues, and I think that's a mistake that a lot of people make these days. Is they want to go straight into a position that may take you years of just doing like menial crap to earn, right? I still had some contact with the trading desk, but it's even that it was just kind of menial labor type, like blue collar work on the trading desk, answering phones, booking trades, all that kind of stuff. There was no actual real trading as such involved in that job, because you've obviously got to earn that right. You guys are putting real money on the line. It's big bickies at the end of the day, so you've got to earn that right. It then ended up that because of a bunch of visa issues, I couldn't actually stay. So my time there ended, landed back in South Africa. During that time when I was in the States, my folks had immigrated to Australia, to Perth. So I kind of landed in South Africa, and I'm kind of like twiddling my thumbs going, man, like what do I do with myself now? Like I sort of have a rough idea of where I want to go in this finance world, but how do I make that happen? And during that time, my folks basically called me and said, listen, whilst you're getting your head together, why don't you just come over on a 2-week holiday? Just come over and kind of, we've moved over now. We've got a house. We're settled. Come over, just kind of get yourself together and figure out what your next step is. So I thought, okay, cool. It can't be that bad. Perth, beautiful weather, nice beaches. For 2 weeks, it can't be that bad. So I literally landed in Perth thinking I was here on a 2-week holiday, and that was, like I said, 12 or 15 years ago. So I came with no kind of preconceived ideas. But I mean, I landed in Perth in, I think, 2004, 2005. So out of sheer luck, I just landed in the city right at the beginning of like the biggest period of wealth creation that Western Australia has ever seen, right? Because that was basically when the mining boom really kicked off. And when I landed here, I saw a totally nondescript ad in the newspaper going like, I think it literally said, "Do you want a job in finance?" And I kind of thought, well, I'm here. You know what? I'll go give the interview a whirl. What's it going to harm me? Okay. So I went and spoke to the guys, and the guy who was doing the interview, the recruiter, basically said, like, look, this is for a broking firm in Perth. I think they're actually looking for someone with, 10 or 15 years of experience, but let me go speak to the guys and see what they think. Okay. So he went away. I got a call back, and they were like, listen, can you come in on Monday? I mean, I'd literally been in Perth for 4 days. Can you come in on Monday and have an interview with two of the directors? Yeah, cool, no problem. Chucked on my cheap suit and the tie, traipsed into the city, went and sat down with two of the directors there, had a pretty good 1 hour conversation, left. As I was getting on the train, I got a phone call saying, listen, can you come in tomorrow and meet with the other two directors? Okay, cool, no problem. Same cheap suit, back into the city on the Tuesday, had another sort of 1 hour interview. And they said, listen, can you start next Monday? And I basically started as a kind of a retail desk assistant for retail brokers, sort of high net worth, etc., retail brokers for that firm. And those guys were really, really good to me. I'm still good mates with them now. I owe them a lot. And they were just, at the time, it was small to mid cap West Australian mining stocks, that sort of focus. And that's what they were dealing in. I was like basically their grunt, right? I did that for about 6 months, doing all the account opening and all that kind of stuff, all the kind of work that they didn't want to do, wanted to fob off to me. But I learned a lot through osmosis, just by keeping my head down, bum up, ears open, and just listening to what was happening. And after that, I moved into being, at the time, what they called a DTR, so designated trading representative, on the institutional desk. So the institutional desk, obviously only dealing with kind of, hedge funds, big asset management firms, that kind of stuff. So a DTR at the time was, you actually had to be licensed by the exchange. You had to be licensed by the ASX. And what a DTR did was, you were the guy that had the license to essentially enter orders direct into the market. So just having, like, as we say, DMA, direct market access. At the time, it wasn't like anyone could just have it, right? So if there was an average broker sitting there, if he clicked an order, it kind of went to a compliance person. Is that okay? Yes, that's okay. You haven't messed anything up. Okay, into the market. Now, obviously, if you're dealing with a hedge fund or an insto, you don't want that kind of lag or delay, because things need to be done. If a guy calls up and says, hey, sell me 1 million shares of XYZ, you potentially want it done right now. So DTR, you have direct access to the markets. And the old system is called SEATS, the Stock Exchange something trading system, whatever it was. And basically my job then was to sit there with 5 or 6 brokers in a circle almost around me, and they would just shout orders at me all day. Just all day sitting there. And so you were just working orders all day, bang, 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 bang. Like, your fingertips almost want to bleed because you're just working so many orders. But that was an awesome job in terms of boning up your trading skills, because what you were doing all day was you were watching order flow. You were watching how the market trades all day, literally tick to tick, right? Because a huge part of how a broker makes money is giving good execution. So if someone calls up and goes, sell me 1 million shares of XYZ, and you do a really good job of it, those small kind of basis points or ticks or dollars that you save that guy, that potentially goes into his P&L at the end of the year, and his bonus is paid off his P&L, right? So that execution is a massive part of the game. Like obviously now a lot of that's all disappeared because there's VWAP algos and TWAP algos, and all of that is done kind of quantitatively, algorithmically. But at the time, I would sit there with a pad of like 40 or 50 stocks on a busy day, and I'm, let's say 20 buys and 20 sells, and all I'm doing all day is going, okay, I've got 50,000 of this to sell over the day. I need to do it the best price possible. So you start to develop a decent sense of how is the market moving. So if the market's going really bid and you're a seller, you kind of want to step back and ease off and let the buyers come to you. If the market's going offered and you're a seller, you may have to be more aggressive and kind of hit the bid a bit more, because you don't want to get left behind. Because if the market's going offered and you are not being aggressive enough, the market keeps dropping, and now you're a seller, you want to sell at the highest price possible for your clients. And you may get into a scenario at the end of the day where you've got to be super aggressive when the market is at its lowest. So you intuitively start to develop a sense of how the market is flowing in order such that you can execute those client orders as well as possible, if that makes sense.
Yeah, right. So by this point in time, you've done some work at a hedge fund, you've been a broker or a DTR as you later became. What led you into prop trading? Bring us forward to that moment.
I can remember a conversation I had with, let's call him old Daryl. So old Daryl was one of the old bucks at the broking firm. And I think at the time I was too naive to really appreciate some of the stuff that he said to me. But I remember him saying to me, and this guy was really wealthy, independently wealthy. He was in his like kind of mid-70s at the time, and just did it because he loved it, right? He just loved the game. And I can remember Daryl saying to me, he said, he said, your whole job is just to get your bum in a good seat and stay there, okay? So, and he said, in your first, like I said, take a step back. This is when we're going through this massive mining boom, right? So there's just money flowing everywhere. I remember old man Daryl, he said to me, he said, in your first boom or your first cycle, he was saying boom because obviously he's a long-only equities guy, so it doesn't apply as much to trading, but it still does. He said in your first boom or bust, whatever it is, you'll either lose a little bit of money or break even, okay? In your second cycle, you'll either break even or make a little bit of money. And in your third cycle, that's when you've kind of got enough experience. You've seen the patterns a few times that you know what's happening, and that's when you really can kill it, right? And what he was saying is that you need to get somewhere where you start building your chops in something that you are willing to really dedicate your necessarily your life. I think that's a bit extreme, but you want to dedicate, a huge amount of time and a huge amount of effort to an industry or a craft or a vocation, because this just takes time. You need to play the long game. You need to play the long ball, right? Don't be in it for kind of the quick fix. Get yourself into a scenario where you're in a good seat and you go, right, now it's time for me to really put in the time, so that when the time comes, once I put in my years, I'm ready. Once I'm in that first, second, third, into that third cycle, that I can recognize what's happening and take advantage of it. So I kind of looked at the brokerage world, and for me, and I think this is a part that I got right at a young age. I kind of looked and I went, like, this model, this whole brokerage model is not long for the world, right? It's kind of dying in front of my eyes because, the commissions in terms of a percentage of a trade was getting smaller and smaller and smaller and smaller, because now sort of that whole kind of algo execution domain was starting to take over more and more and more and more of the commission dollars that are going around, right? So clients were getting more demanding, handing out less bro, etc. And I kind of looked ahead in time and went, man, like this old model, this old school way of doing things, I think it's going away. And I think that's been proved true, right? Like you look at what your average broker charges on a trade these days, it's pretty tight. Like the margins are really small, right? It also started, as I progressed from a DTR and moving more into the sales role, not there's anything wrong with sales, but I kind of felt like, every day I was trying to make chicken shit look like chicken salad, if that makes sense. That was all I was doing all day. And I think the biggest thing was that I developed a sense of self-awareness, okay? And I think this is a huge part of what has helped me navigate my way through this world, is that I think I'm I think I'm quite self-aware, and I understand what my strengths are and what my weaknesses are. So I looked at the guys around me who were really succeeding in that world, and they loved the sales part. They loved reading company reports. They loved having lunches with company directors. They had obviously, like I said, West Australian, kind of mining resources focused. The guys had an interest in geology. They loved going to mine sites. Like, I didn't like any of that. I find reading a company report the most boring thing on earth. And so I'm not saying that it's good or bad. It just didn't appeal to me. And I just had this thing inside me where I kept thinking back to that moment that I had where I walked onto that trading floor in New York, and just the way that I felt. And I was like, man, I need to get back to that. So I started seeking out proprietary trading firms. Now, obviously, the prop trading industry, very East Coast focused. So the only place to really go was Sydney. So I started reaching out to firms there, got an interview. And again, this kind of reflects the, I talked about that kind of, just go for your goals no matter what type of thing. At the time, I had moved in with my then girlfriend, now wife. So we were living together, and it was literally like on her birthday, I was like, all right, love, guess what? I'm leaving for Sydney in 4 days. Like, see you later. Because I just had in my head, like, I'm going to go do this. Like, if I have to pack all my stuff up and move across the country to give myself a crack at what I want, that's what I'm going to do. Like, I'm going to go for it no matter what. Now, looking back at the time, I probably could have done it in a more sensitive way. But, like I was 25, 26 years old, whatever, and I just had that bulldog mentality of, okay, I'm just going to go for this. So packed up my bags, moved to Sydney, and got into a training program at a prop firm. Went through that, and kind of that's how I got my start in the proprietary trading industry.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or set equities big without risking your own savings. And now you can also have unlimited. Click the link in the
involved in trader development at some of these firms you've worked at. We'll get to that. Also, I'm keen to spend a bit of time on that. But yeah, tell us about maybe your first couple years as a prop trader. Like, how did you go? What challenges did you go through? What things did you pick up easily?
Well, I mean, I think what happened to me was the worst thing that can happen to a beginning trader. And that was, I had some success early on. Now, that kind of sounds counterintuitive, but I honestly believe that is the worst thing that can happen to you, because if you think of trading as a skill, okay, and I firmly believe trading is a skill. Every skill has a learning curve, okay? Whether you're talking about a baby learning how to walk, someone learning how to surf, someone learning how to play tennis, someone learning how to play chess, whatever it is, how does a baby learn how to walk? It falls over a lot, and you don't look at it and go, gee, it shouldn't be doing it. That's how a baby learns how to walk, How does someone learn how to surf? They fall off the surfboard a lot, So what happened through probably just blind luck, I was actually profitable at the beginning. So I went through the training program, pretty basic, but at the time, I think an advantage I had was from my time as a DTR, I had a good sense of how the market moves, because for many years all I'd done, as I'd said, is sit in front of a screen and watch how stocks move up and down or futures markets move up and down. And so I had I had enough screen time that I'd built some sort of intuitive sense of how that works. And I think that helped me at the beginning. But I think the fact that I had that meant that there were other skills that I didn't develop where the market eventually caught me out, right? So what I always say to guys is you're going to pay your dues at some point, right? You're going to. You are going to suck as a trader at some point. And you want to be at your worst when you're trading your smallest, if that makes sense. Because then obviously, you want to be really bad with a 1 lot, not really bad with a 20 lot, if that makes sense. So at the beginning, I think I actually got a bit cocky, right? And I was like, man, I got this, got through, started the training program with 20 guys. I think they took 3 of us, maybe, mate, like, I worked my butt off, right? Because you got to remember, I may have been naive, but I knew it was on the line. I'm going over to the east where I've got to find a place to live. I don't know anyone. I'm not earning any money. Like, I'm only on a profit split, right? So I understood how much was at risk. I was lucky that I had a bit of money in my pocket from the kind of Perth days after that whole mining boom that I could facilitate that. But it's hard, like particularly for someone coming interstate, because what you really want as a beginning trader is you want as little financial commitment as possible. Because if you go through the natural learning curve that we've spoken about, like when someone's learning how to surf, they fall off their surfboard. Fine. They get wet, they get cold, no big deal. Someone's learning how to snowboard, you get a couple of bruises on your elbows and your shins, no big deal. When you're going through the learning curve as a trader, what that means is you lose money. Okay. Now, obviously, at a prop firm, they are absorbing those losses. But if there's no money in your account to split profits on, then there's no money coming into your account, right? So the learning curve for a prop trader is you go through a decent period of not making money. And that's just the way of the game. It's like, being a prop trader is like starting a small business, right? If you go open a cafe or something, there's going to be a period where you aren't selling enough cups of coffee to cover the cost of your rent and your staff, etc. You've got to generate that following and get a couple of locals that come in every morning after their morning bike ride. A couple of businesses or office workers are coming to you, and eventually you build momentum, and then away you go. So the thing that happened with me was I had some success early on, and then the market changed. Okay, we went through a period where volatility changed, liquidity changed, and because I'd had a good run at the beginning, that was all I could do. I was a one-trick pony, and then all of a sudden I was like, wow, like I don't know how to cope with this, and so I got smacked. I got the lesson that the market was always going to give me, and I got smacked, and I kind of had to take a step back and sort of reassess, like, whoa, like what do I do? Because I kind of hit a patch where my development had stalled, and I was starting to put it bluntly, I was running out of money.
Okay, now just before we move off this point, it's quite interesting because you're certainly not unique in the sense that you had beginner's luck. We quite often hear it from other guests who I've brought on the podcast and, just other conversations I have, people who seem to have quite decent success in the very beginning, but then that kind of fades away. Why does that happen? Like, why do we experience beginner's luck so frequently?
I think there's potentially a couple of angles to it. Like, I'll give you the frou-frou fairy dust one first, and I'll give you the more practical one second. So I think there is honestly an element of karma. Like, I really do think that the universe kind of goes, right, if you are really willing to put it on the line and give us a real crack, I'll give you a little nudge. Okay, I'll give you a little nudge. I'll help you out a little bit. I really honestly believe that. For the people that really commit, and I really committed, trust me, at the time, I think the universe does kind of go, all right, bro, like you've knocked on this door enough times. I'll let you stick your toe in and we'll see how you go. I think the more practical explanation is there's probably a little bit of survivorship bias, what we're talking about, because for as many people that get beginner's luck, there's probably a lot more that just get blown out the water from day one. I think that there may be an element of, at the time, probably my natural skills, my natural proclivities, my natural kind of tendencies just suited what was happening in the market. Okay. So if you just have a natural sort of like, your first instinct is you want to buy a breakout. Okay. Just to give you a practical example. And the market just happens to be going through a period where there's a ton of liquidity and it's trending a lot, you'll have a lot of success. But then if the market changes and all of a sudden markets are range bound and there's not a lot of liquidity and it's, kind of back and forth, and then you're going to get cut up because you're going to be buying every false breakout, right? So I think a lot of that happens where beginners get going and just out of sheer luck, their natural tendencies suit what the market is doing at the time. Okay. And you've also got to remember there's some markets where the market's very forgiving. Like, mate, if you really like commodity-based equities, and that's what you were putting your money in 2004, in 2007, you look like a goddamn genius, but that's got nothing to do with you. That's just because you're going through a massive mining boom. So, it's the old quote, the rising tide raises all ships, etc. You imagine someone that, to give you a slightly different example, you imagine someone that came out of university with a degree in geology from a university in Western Australia in 2002, okay? What does their life look like right now versus someone who came out with the same degree but just happened to be born 7 or 8 years later, okay? Their life looks very different because the guy born in 2002 or 3, he's had the whole mining boom to kind of grow through the industry when people are going like, man, I need new people. I just have to employ people. There's such a boom going on. And that guy can move through the seniority ranks very quickly versus someone who comes out with a degree in an industry where it's just dead or stagnated. Okay. So I think that there's a lot of luck involved in terms of how the market's trading at the time, what liquidity is like at the time. What volatility is like at the time, all those type of things I think contribute to this kind of beginner's luck phenomenon.
Yeah. I think those are both really good explanations. Actually, you nailed that. So that was really good and I think quite helpful. Like I said, we're going to get into this trader development stuff. Just before we do though, there's one little thing I'd like to speak with you about, and that's about what sort of trader you've evolved to today. So you said you struck some beginner's luck early on and you struggled for a while. What sort of trader have you developed into now?
I think I'm fairly similar, but with a lot more nuance, right? So I'm still predominantly, I don't have many charts up on my screen. I read order flow off the depth of markets. I try and I'm trading. I view trading as a competition, right, between traders. So I'm always trying to think, when I look at the market, who's getting trapped, who's getting stuck, who's under pressure, where do I think stops are going to be. I'm trying to kind of gauge the psychology of the market, not looking at it in a fundamental sort of way. So like if someone says to me, what do you think is going to happen with interest rates in 6 months or whatever? Like, mate, I have no clue. I'm not smart enough to know that, nor do I really care to, okay? I'm trying to read order flow on a tick by tick basis and trying to understand where traders are getting stuck, where people are going to be fearful, where people are going to be greedy, those types of things, and placing that within the broad structure of how is the market trading, what prices are important, what is the market trying to do, and how good a job is it doing of achieving that, right? I think that kind of covers most of what I'm doing these days.
Okay, and you're predominantly focused on futures?
Yeah, so the prop trading world in Australia in particular is, and also the same in Europe, is predominantly futures based. You would very rarely find that, I mean, they do exist, but it's quite rare to find an equities prop trader at a prop trading firm in Australia or Europe.
Okay. This is actually one of the things I was going to bring up with you, is the fact that many Australian firms actually trade very similar products. There's not much kind of diversity. How come, and do you think that's a good thing, a bad thing, or indifferent?
I don't think it's a good thing, but I understand why it happens. It happens because it's very difficult to move away from something if you're making money doing it. Okay, so I can put it to you this way. Okay, so after the GFC in 2008, there were a lot of traders trading certain styles. It just kind of got blown out the water, all right? Like the volatility just got them, right? And they kind of blew up and went away. And then there was another style of trading that kind of got through that GFC volatility relatively unscathed. And I think that most of the trading happening in Australian prop firms now is a derivative of that style. Okay, now obviously everyone kind of brings their little twist and nuance to it, but most of the guys are trading a similar style on similar products, right? Now that can be a good or a bad thing. Okay, the reason that it's happened that way, in my opinion, is that prop firms came out and went, okay, well, what's working now? Okay, that's what we need to move towards. The reason why I think it may potentially come back to bite prop firms is that, like we've just said before, the market changes, volatility changes. And what I've seen over the past couple of years is the amount of dollars out there to be had trading that style is progressively getting less and less and less and less. So if you're trading a certain way, the market's getting more efficient at arbing out kind of the little inefficiencies that you are exploiting. Okay, so to give you an example, and this has happened in the US for guys trading that way. It's happened in Europe for guys trading that way. Now you're starting to see it in Australia. Is that, let's say the guy's mainly a US 10-year notes trader. Okay, so for the style that he's trading 10 years ago, let's say he was making, and I'm just throwing out random numbers here, let's say he was making $250K a year. Okay, to make $250K a year, he would need, let's say, limits of 100 notes. Okay, 5 years later, to make that same $250K, he now needs 250 notes. Okay, because he's making less per trade, so he's got to trade bigger to earn the same amount of money. Nowadays, that guy needs 1,000 notes. Okay, because the markets are pretty tight. Like we're in a zero interest rate environment, all those types of things. So risk managers are now, I think, starting to look at this and go, hang on, like this doesn't make sense, because if this guy's trading 1,000 notes and he gets whacked, just like every trader gets hit at some point, that's a lot of damage to our P&L, right? So I'm actually of the opinion that some of the old school ways are starting to come back. And I think the old school way of trading, if I can put it that way, those skills are starting to come back into vogue now. So I think you potentially may see a shift in the way firms conduct what products they trade and how they trade them over the next few years as those new opportunities arise. Now, having said that, a lot of the geopolitical things may change that. Like, you've got the big Don in the US and all that, where all of a sudden there's a bit more volatility, there's a bit more movement. So, those kind of inefficiencies may come back. In terms of the same product set, mate, I'm 100% of the opinion that it's much better to have a diversified group of traders. Okay, like I think that's just absolutely fact, because if you have a room of guys all trading the same product and trading the same way, if that stops working or they get smacked, there's nowhere for you to go, right? Because you've got 10 guys all trading the same thing, all trading the same product, doing the same thing. They're all going to get hurt. Okay, so having a diversified spread of guys trading different periodicities, so different time frames, different strategies on different products, I think that's the correct way for firms to go. It's very much it's a casino model, right? So if you think of the Crown, here in WA or Melbourne or any casino around the world, if you obviously, most traders will know that the casino games have a house edge that varies between various games, but it's always edged towards the house, right? But the edges are very small. Okay, so as an example, let's say that in blackjack, the edges, I think it varies between 1% and 4%. Okay, let's just take somewhere in the middle. Let's say the edge is 2.5%. Now, if you think of that, right, you think of 100 hands of blackjack. The edge to the house is 2.5 hands out of 100, right? That's an extremely small edge, but it's a mathematical edge that the casino knows is there. So if we sit here and we go, okay, what are the chances of this single blackjack table? So one blackjack table, one limit, losing money tonight. The chances are, 47.5%. Okay, that's not a really small amount. It's definitely still edge to the casino, but there is a definite chance that this one blackjack table loses money. Okay, but now take a step back and go, but if you put that same 1 to 4% edge across 20 different casino games, 30 different limits, like you're talking now 30 times 20. That's 600 tables. What are the chances of this entire casino losing money over the month to come? It's extremely small, right? So this is why it's better for firms to have a broad, diversified suite of traders trading all sorts of different things across all sorts of different time frames, all sorts of different products, because it removes that kind of like black swan risk where your one strategy just gets absolutely smacked.
100%. Yeah. Well, Darren, let's move on to the trader development aspect. So tell us how long it was before you actually became involved in the trader development space, and what did that look like? Like, what sort of things were you doing on a day-to-day basis?
Post my first experience as a prop trader, I then actually got a job at a hedge fund in Sydney. So pretty decent size. Like we had like $300 million under management, something like that. So not huge, but not small either. And I was head of trading, right? So I walked into that job going, man, like this is it. Like I've done it. I'm at a hedge fund. I'm head of trading. We've got a couple of $100 million under management. Like all I need to do, like we spoke about old Daryl and getting a bum in a good seat. I was like, right, this is my seat. I just need to ride this pony into town until it drops, right? Like ride until the wheels fall off. And what happened was that when I got back into the hedge fund industry, I very quickly realized that world had totally changed post the GFC. Okay. So, mate, like one thing I've realized, when people lose money, even if it's their fault, it's very difficult for them to put the blame on themselves, and they're looking for someone to blame, and they're looking for people to sue. So what happened was that hedge fund world had become extremely regulated. And so where I wanted to get onto a true trading desk and be involved in trading, I now found that my entire job as head of trading at a hedge fund was, like doing transactional cost analysis reports and sitting in meetings with brokers to try and squeeze the last couple of basis points out of them in terms of our execution, and worrying about, sitting down and making sure that every I was dotted and every T was crossed in investment mandates, and just real like boring crap. And so I kind of went, man, like I was very lucky at the time. I had an amazing boss. The guy who ran that hedge fund was just probably the best boss I've ever had. And he was really good about the whole thing, where I kind of went like, this is just kind of not what I was expecting. And the role wasn't going where I wanted it to go. The industry had changed. Now what I kind of realized was that the prop world now is kind of the last bastion, the last outpost of that sort of true entrepreneurial, true trading kind of realm. And so an opportunity came up for me to be involved again with a prop firm as a trader, and as I guess someone helping develop young traders coming through. And because I'd been through that experience, and because I'd kind of been through the heartaches and been through the ups and downs, and gone through a training program and kind of seen the good things and bad things about it, and dealt with people mentoring me, and because of my my background in sort of, like I said, I'd bring it back, my background in understanding what a proper environment for someone to excel in is. I thought this sounds like a really cool opportunity. And so that's how I got started.
Okay. And was it easy for you to split your day between trading and trader development?
No, it definitely took a period of adjustment for sure. On my part, obviously, if you're involved with developing traders, you need to make sure that when you're doing that, you can do it to the best of your abilities. Because, I mean, let's be honest here, you're dealing with, like, I take it very seriously, right? Like, you're dealing with a young person's hopes and dreams, Like, this is literally, if you are involved with trader development, and I feel very strongly about this realm, and I have, I guess, fairly strong opinions on it, you are dealing with the hopes and dreams of young people who are coming to you probably fairly naive, looking to you for guidance, looking for you to point them in the right direction. And you have a massive responsibility to do the right thing by them. Okay. So there are times when you're going to have to set your own ambitions aside. Now, at the time, I want to be involved in the business of trading. I want to help people. I get a kick out of it. I think I'm very good at it. It's a skill that I have because of my background. So I really enjoy doing it. I enjoy seeing people grow, and I enjoy seeing people achieve their goals. Okay, and I think I'm very good at facilitating an environment where they have the best possible chance of doing that. But there was absolutely a period of adjustment, and mate, like I'm still struggling with it to this day. Like what's the correct balance? I find that you have to be, in terms of trading, you've got to be much more focused on, okay, what are the things that I'm really good at? And I just really need to focus on doing very few things simply, okay? And I need to realize that there may be times when I have to set my own personal ambitions aside in order to help the bigger group, right? Like this is the ultimate definition of if the team wins, I win. Okay, so, going back to the rugby scenario, like you have to go into this going, if the team wins, I win. So maybe my personal ambitions as a trader have to be scaled down a bit. They don't disappear, obviously, because I don't think it's right that you can just stop trading. I think that is, I don't think you can do that either. But you need to realize that if you are going to develop someone as a trader, you need to be able to give them the utmost attention when it's necessary. Okay, you can't be kind of half focused on trading and half focused on someone else. Like you can be when you're with them, you need to be with them. Okay, so I think it's definitely an adjustment. It's something I'm still struggling with a balance with, but I think I've got much better at it.
Yeah, and I think you may have answered this next question I have for you to some extent in your answer there, but I'm going to ask it anyway, especially because you do feel so strongly about this. What makes someone a good trainer? Like, what are the things that a good trainer does?
I think a good trainer is, and again, I know I'm repeating the same things, but I think they're very important. I think a good trainer is self-aware. So what I mean by that is if you're looking to find a mentor or you're looking to find a trainer, and I apply all these things with myself when I'm looking for mentors in business or life or whatever it may be, they are self-aware. What I mean by that is they know what their strengths are and they know what their weaknesses are. Okay, so if someone comes to me and asks me a question about, I don't know, trading currencies or trading mid-cap stocks or whatever, I'm going to say very bluntly, I don't know. Okay, like I just don't know. If someone wants to do, if someone comes to me and goes, "Can you tell me about candlestick patterns and all this stuff?" Like my very honest answer is, I just don't know. I know what I'm good at and I know what I'm not good at. And I think you need to look for people that are very transparent and very honest about what they can teach you and what they can't. All you want someone to do is to tell you about what they have experienced and what is the truth for them. Because in trading, the truth is different for everyone. Okay, it's like a golfer's swing. Your true swing is going to be different to my true swing. Okay, so it's different for everyone, and you want someone that accepts that and understands where their strengths are and where their weaknesses are, and focuses on their strengths, not trying to cover up their weaknesses. I think that a good mentor, a good trainer is transparent. You want someone that is transparent about the grind, right? You want to be someone that's transparent about the fact that, like, this is hard. You know, you want to be someone transparent about the fact that they also have their struggles. You want to be transparent. You want someone that's transparent about the fact that, like, you never figure this out. You know, like, you never solve trading. It's like saying you solve trading is like saying you can solve golf or tennis. It's a dynamic system. You'll never solve it. So people who say, I figured it out, or, you know, that's just such BS, you know. And this is like, you know, I said you want someone that's transparent about the grind and transparent about the hard times. Like, I have a massive issue with people pitching trading as some sort of glamorous lifestyle. Like, Aaron, if you said to me, how do I know that someone is not right? I would be like, if you pull up a video or a profile picture, whatever it may be, and it's them standing in front of their Ferrari or trading off their iPhone from their yacht, like, that's BS, right? Because I don't know a single profitable trader. And trust me, I know a ton of guys that make a lot of money doing this and been doing it for a long time. Not a single one of them trades with their goddamn phone. Not a single one of them trades from their yacht. Most of them, you know, don't own fancy cars. Like, this is a craft. Okay, this is not, gee, look at me at my penthouse in wherever and look at amazing how I am and I've made X amount of dollars per day. Like, that's BS. This is a grind, you know. And if you look at the guys that are really good out there, that's what they're showing you. Okay, they're saying to you, this is bloody hard. Like, this is damn hard. Chances are you won't make it on your first crack. You know, like, guys who come on and say, I've blown up 3 accounts, but I kept struggling and I got through. And I know there's a couple of your guests who said that on your show. Those are the guys you want to look for, right? Like, because those are the guys that are showing you, like, I've got scars from this, you know, I've bled for this. I didn't figure this out in one day. I still haven't figured it out. I'll never figure it out. I'm constantly evolving. I'm constantly having to essentially relearn trading because, like we've said, the market changes all the time. That's why you have to constantly be evolving as a person and as a trader. So you want someone that shows you that. You want someone that says to you, like, this is bloody hard work.
And there you've described a good trainer. How about we flip the coin here? How about a good trainee? What makes a good trainee?
All I can speak about is the guys that I've seen do well. Okay, so the guys that I've seen do well, and I'm talking about someone who walks in literally going, I don't know what a bid or offer is. I don't know what a futures contract is. I don't know anything, right? To succeeding as a trader, making money, kind of living the dream that they want to. And then, you know, once they get to that point, it's up to them, right? How far they take it. I think the number one thing, and again, this is why I took the time to tell that boring high school rugby story. The number one thing is grit. Honestly, mate, it's just, you need to be like that bulldog that gets his teeth around that bone and just will not let go. Like, because this is going to be a slog. It's going to be hard. It's going to take you years. The struggle is never going to end. You know, like, you got to keep grinding all the time. So grit is the number one thing for me. Someone just has that fire in their belly and has seen a bit of hardship. Like, one of the number one things I look for when I'm interviewing guys, I want to see that you've had a bit of hardship in your life and you've got through it. Okay. So I'll give you an example. You building this podcast. Okay. It definitely hasn't been easy. Okay. Like, I don't know the ins and outs, but I can tell you right now, there's a lot of people doing podcasts out there and very few that have had your sort of success and your sort of reach and been able to get the people that you have onto your podcast, right? So you've had to grind, I'm sure, like, go through tough times, go through hard times, figure out for yourself, like, how to do something because you haven't got the money for someone to just do it for you. Like, you've got to bootstrap something from the ground up, right? So for me, that's a huge thing. Seeing someone that's got that grit. I don't know that you can teach that. I think that's just innate. Like for me, that was drilled into me from essentially day one, right? Like, I mentioned that my dad was an airline pilot. Like my dad started as an aircraft mechanic, right? Like he didn't do super well at school, started as an aircraft mechanic, always had a passion for flying, and decided, so he was a flight engineer. So I'm maybe going a bit far back now into history. I'm maybe showing his age and mine, but cockpits in airplanes used to be a 3-man cockpit. So nowadays it's 2 pilot co-pilots and computers do everything else. Back in the day, like you would have a third guy sitting behind the pilots. And what he would do is his job was to, during the flight, manually adjust oil pressure and oil richness and move the flaps up and down and all that kind of stuff. Like he had to sit there with all these toggles and do that manually in flight. Then obviously once computers came along, computers now do all that stuff behind the scenes, so they didn't need a flight engineer anymore. And so my dad basically had a choice. You take the golden handshake from the airline because you're all being made redundant, or you go and do your flying exams and you learn how to be a pilot. But like I said, my dad wasn't a genius at school. He was pretty good at his hands, aircraft mechanic. And he was like, no, I want to go be a pilot. And I promise you, Aaron, I remember that dude. He grafted so hard for those exams. He failed them a couple of times, but he would not let go of that dream. And I remember him going into study at an old house. And I'm talking, mate, I'm like 6 years old now, right? And just studying for like literally 14 hours a day, and to put in that amount of work for weeks on end, go away, not pass, go back and do it again. Just like, I am not going to let this go. And I think that's why I say I don't know if you can teach it, right? I think someone needs to have experienced that or seen a real life example of that in their life to really understand the kind of what I'm meaning when I say true grit. I think another thing you need to look for is competitive drive. Like you want competitors, and I think when I say competitors, everyone thinks sport. I don't. Okay. Mate, if you're competitive at Tetris, you're competitive at World of Warcraft. You're competitive at, I don't know, whatever it may be. You play in the local, touch footy league or whatever it is. But I think you need a competitive drive because whether you like it or not, this is a competition. Okay, trading as a proprietary trader is a competition, and the earlier and the more traders can think of this as a competition, the better off they will be. I think you need someone that's intelligent, but not too intelligent. Okay, I think people make a mistake that they think that the smarter you are, the better chance you have of succeeding. I've actually seen. I don't want to say I've seen the opposite. The dumber you are, but what I have seen is that people that are like super, super smart, the mistake they often make is they come in and they try and figure everything out. Like, why is the market going up? Why is the market going down? Why did the market pull back like that? Why is that bid not dropping? Why is that offer keep refreshing? And mate, the thing I've realized is that you can't figure this out. Like you need to let go of trying to figure out every single uptick and downtick. So you definitely need someone that's smart, but not so smart that they think they can figure out the markets, right? And I think that one of the biggest things is you want to come into this as a trainee, as an empty cup, okay? You want to come in not with any preconceptions or not with any preconceived ideas. And this is why prop firms generally prefer people that have zero trading experience, okay? So someone that's been trading for a couple of years is often more difficult to train than someone that comes in like literally knowing nothing, because someone that comes in with a couple of years experience, there's probably a lot of ingrained bad habits that you have to remove. So someone who comes in as an empty cup and someone who comes in with the attitude of, this is a skill that I need to learn for myself, okay? So you don't want to walk into this going, tell me what to do, okay? Like to come in and go, guys, tell me what the setup is, okay? Tell me what the setup is and then I'll do it. Like, what are your best setups, okay? Tell me what to look for. Tell me what the exact pattern is, okay? So if I'm talking about right, if you see absorption on the bid or offer, well, how much? Well, I don't know. There's no exact number, right? Because like we've said before a bunch of times now, the markets are constantly evolving and constantly changing. So what's absorption or rejection or whatever kind of order flow sort of setup you're looking for, that's going to change. It could literally change from day to day what you're looking for. So you want to step away from this kind of tell me exactly what to do mentality. Okay. And what I always say to guys is it's almost like if you imagine a tennis player, okay, and they're sitting in the change room before they walk out to play in a big final, and they're sitting with their coach, and it's kind of the last final preparations before they walk out. And the tennis player turns to his coach and he goes, okay, so what shots should I hit? Like, what's his coach going to say to him? He's going to go, what do you mean? And the guy goes, well, what shot should I hit? His coach is going to go, bro, I don't know. Like, it depends, right? Like, all I can tell you is these are your strengths. These are your weaknesses. This is what I think your opponent may do based on his strengths and weaknesses. And then you have to go out and you have to play the game, okay? And what shots you're going to hit depend on a million different variables. Like, what's the weather like? What's the score? Are we in the first game or is it match point against us? What shot has my opponent just hit? Is there wind or is there not wind? What's the humidity in the air like? Because that'll affect the way the ball flies through the air. Is the court playing fast or slow? Is my opponent injured? Am I injured? Is my opponent tired or not? Am I tired or not? Like, there's so many different factors that go into what shot should I hit in a tennis game. But what young traders do is they want to be told what shots to hit before the game even begins. Whereas good traders understand that trading is a skill. And what you need to do is you need to build your skills to the point that you can step into the market and you can understand how the market is trading, how the market is flowing. And then you can go, right, given that I understand how this market's trading and how it's flowing, and I think I have a good sense of what's happening, how do I, based on my strengths and my weaknesses, take advantage of that?
And just to add one more thing, as we're talking about being a good trainee here, and you can either agree or disagree and let me know what you think about this, but I presume as a trainer, one of the most rewarding and frustrating things for you would be seeing trainees not take action and actually implement the sort of guidance or advice that you're passing on to them. Like, it must be very rewarding to tell someone something or to bring something up with them and then to actually see them go away and implement it, try it, and actually come back to you and show you that they've actually taken action and done something about it. Because, it's very easy to hear things and take information in, but it really all comes down to execution and action, correct?
Mate, absolutely. And I'll expand on that. I think something that I've been relatively good at. There's not many things I do well, but I think one of the things I do well is that I've been able to get people around me that are good mentors. Okay, so many of the good habits that I've learned off other people throughout my life. Right, I've been able to get good people around me that can support me and guide me and show me the way. And the reason I've been able to do that is that I think I'm a good trainee, right? So all these things I've spoken about, I do myself. So I don't just walk in and go, tell me how to do it, okay? What a good trainee does is exactly what you just said, okay? You show them a basic concept or a basic skill, and they go away and they work on it themselves. They really put some deep thinking and deep work into it. And they absolutely should actually tweak it and adjust it to suit them, because everyone's circumstance is different, everyone's personality is different, everyone's strengths and weaknesses are different. So they go away and they use what you've said and they adapt it to themselves, and then they come back and they ask more questions. And you'll be able to tell straight away if someone's done the work, because every time they come back, their questions are more nuanced and they're showing an ever more progressive depth of knowledge, right? As opposed to the person who, you tell them something, and then you check up with them like a month later, and you go, so how have you gone with that? Well, I heard what you said, but I kind of like, I didn't do that. I did this, and I thought that, oh no, this would be better, blah, 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 blah. Like, I'm not saying that everything I say is gospel, but if someone comes to me for my opinion and I give it to them, at least give that person the respect of actually going away and thinking about it, right? It's like if that person comes back and goes, I really thought about what you said and I did a ton of work, and respectfully I disagree, perfect. I have no issues with that, because that's you finding your way. But someone who isn't even willing to put in the work, like, it can get very frustrating. But mate, the way I've seen a lot of people come and go in this industry. Okay, I've seen a lot of people go through training programs and not get through or quit or whatever it may be. I've seen a ton of people come and go. And someone asked me the question once, like, do you think you've ever let someone go that could potentially become a really good trader? And I'm like, of course I have. I'm a human being. Like, I'll make mistakes, right? Or maybe someone comes to us at not quite the right time in their life, where they actually need a couple of more years of maturing. And in 2 years' time, they'll get through the training program and they'll be away and they'll be profitable and they'll be a really good trader for the rest of their careers. But right now, the timing's not quite right, but the thing that I've always said to them is that I put my head on my pillow and go to sleep like a baby every night, because I know that every person that comes in, I give them my 100% that I can. And if that person is meant to make it in this industry, they will make it with me or without me. Okay, they will find a way. Like, I just know that personality, that kind of, those types of personalities, they will find a way. And like, at the end of the day, that's why I'm in this industry. That's why I love it. It's because of the people, because you meet people that have all of these traits that I've spoken about. You meet people that are just sponges, and they come in and they do all the right things, and their attitudes are awesome. And to see them have success is incredibly satisfying. It really is. It's one of the best things that I've ever done, is to see someone come in knowing nothing and to see them develop over 6 months to a year to the point where they know more than me about certain things, And like, I'll be the first person to put my hand up and go, back at my old firm, there were guys where after a year, there were certain styles of trading or certain things where they were the master and I was a student. Okay. And that's awesome, because that means that I've done my job right, and that I haven't tried to give them a recipe and go, here, cook this. What I've done is I've taught them how to cook, if that makes sense. So a great chef, he doesn't need a recipe book, because he understands taste and he understands flavor combinations, and he, through intuition and experience, can understand how to cook things. So you put 50 ingredients in front of a room of 10, 3-hat chefs, and they'll go, sweet, we don't need a recipe, and they'll come up with amazing dishes, right? But what too many people do is they want the recipe, they want the setup, okay? This is not about setups. This is about developing skill.
I'd like to ask you a few questions, I guess, more specifically about prop trading. And naturally, I presume that you might be somewhat biased on these, which, is totally reasonable. But why do you think being in a prop firm increases your chances of success? This was something you said to me off air, so I just want to bring that up.
Okay, so like we've spoken about the fact that I think I've been lucky to get a couple of really good mentors in my life. So one of my closest friends, who was best man at my wedding, we get really well, very close. He's taught me a lot. He was in the special forces in the military for a long time. Okay, so I think like 10 years in the army, 8 years in the special forces. And I remember saying to him, because he's, like if you think about how many people try to get into an environment like that and fail and can't get through the selection, all those types of things. I kind of said to him, like, what made you different? Like, what kind of got you through? Because if you look at the guy, he seems like a totally normal, average bloke, right? So I said to him, like, kind of what made you, what helped you get through this? And when you were in that scenario, when you were through selection, how did you kind of stay with the pack, right? Because you got to remember, those guys are the best of the best, like the top 1% of the top 1%, or whatever you want to say. And his answer was, environment is everything. And I'm going to say that again because I think it's so important. Environment is everything. And that's why being at a prop firm, in my belief, increases your chances of success exponentially. Because if you can get into a prop firm that has its environment right, your learning is accelerated so much. Okay. So my mate basically said, I'm nothing special, but when you get into that environment where everyone is pushing to succeed, pushing to excel, and all working together to be the best they can be, and you see how, like, I've been saying that same thing from my high school story all the way through, that's where you just get lifted up by the pack. You get lifted up, right? Because, again, as we said, the rising tide lifts all boats. So when you get into a prop firm that has its environment right, from the moment you walk in that door to the moment actually, let me rephrase that. From the moment you wake up in the morning to the moment you put your head down to the pillow and go to sleep at night, and probably in your dreams, all you are doing is eating, sleeping, breathing, shitting, training. That is all you do, okay? So you walk in, guys are talking about trading. They're talking about what happened last night. You sit in on a morning meeting, right? Guys, this is what we can expect today. This is the news that's coming out. This is the order flow, significant order flow that happened last night, because the guys trading the night session, it's now the end of their day. They're still there. So they're saying to you, watch out for that big seller refreshing in the 10 years. Watch out for this guy lifting offers in XYZ. Watch for this guy selling lots of 500 in ABC, okay? You're trading during the day, and in a good prop firm, guys are talking to each other all the time during the day, okay? They're constantly calling out information. As a modern trader, there's so much information that you have to take in, right, that it becomes very difficult to watch everything on your own. So being in a room where guys are calling out order flow, calling out bid and offer changes, calling out new highs in this, new lows in that, this has just gone bid, this has gone offer, there's an iceberg on the bid and whatever, that's unbelievably helpful. It just accelerates everything. And then you have a good trade, you get up and walk to the kitchen to get a drink of water, your buddy's there. How did you go? Oh, no, I puked. Oh, how did you go? I did really well. What did you do? And so can you see what's happening there? Like you're constantly replaying all these things over and over and over and over. You're going to hopefully have good mentors that will sit down with you and go, okay, guys, we've just had the morning session. Who saw what? Who had a good trade? Who did this? Who did that? It's the old Mark Bellafiore one good trade, right? Like you turn one good trade into two good trades, into three good trades, into four, and your number of repetitions just increases so much that your learning curve is massively shortened, because the average trader sitting at home just can't replicate that. It's very difficult to replicate that. Okay, so I think there's a few options nowadays where guys can get a taste of that. So like some of the stuff that FT71 is doing with Stage 5, I think is awesome. Some of the stuff that Alex Haywood at Axia is doing, I know you spoke to Brannigan a couple of podcasts ago, is awesome. That kind of stuff is giving people that don't have access to, aren't in a prop firm, a prop-like environment, if that makes sense. But still, to me, the best chances of success are getting yourself into a prop firm with a good training program where you can be around traders and just kind of learn through that osmosis and repetition and being in that professional trading environment.
Okay. So with this being said, let's say someone is at home. Let's just come up with a scenario. They've been trading 3 years. They don't have any fancy education. They've just been putting in a lot of hours trying to make it on their own at home. They've been trading for about 3 years. Let's say they actually want to now become a prop trader because they've heard all the positive things you have to say about it. What are the first steps? Like, how do you go about it, and what sort of firm should you try to get into? Because there's many different sort of prop firms as well. Like some are very quant heavy firms, some are very discretionary, point and click. What are the first steps? Let's just break it down.
Okay, well, I think if you want to get into this world, your first step is like there's a lot of information obviously out there in terms of well, let me take a step back. I think there's enough information out there for people to get a rough sense of who's who in the zoo, right? But I totally understand how someone sitting there could be going, man, I'm a bit confused by the terminology, or I'm a bit confused. Is this guy good? Like, this guy wants me to do this, and this guy wants me to do that, and this guy's website's really good, or whatever. I understand it can be really confusing. Like, the one thing I'll say is, like, reach out to me. Honestly, I'm quite happy to take emails from anyone, right? I'm happy to answer questions. Like I said, I know my strengths and weaknesses. If I can't help you, pretty sure I can point you in the direction of someone who can. But that said, the decision for someone like that is really, okay, what stage am I in my life? Okay, because let's say you're someone that's, as you've said, been trading for a couple of years from home, but you still live with mum and dad, you have no debt, and you're about to finish uni in 6 months. Your set of decisions is very different to the set of decisions that someone who's got a mortgage, a wife, and 3 kids can make. Okay, so like I said that part of being a good mentor is, or a good, all that is being transparent. So let me be very transparent. This is much easier to do if you have as little financial encumbrance as possible. Okay, that's just a fact, because sitting down at a prop firm and sitting there going, oh, geez, I've got to pay the mortgage. My wife's been on my case. I haven't earned money for 6 months. What am I doing? Blah, blah, blah. Like, the pressure to earn money is going to start making your decisions for you, if that makes sense. And you're not going to be in the right frame of mind to make good trading decisions. Now, that doesn't mean that someone who's sitting at home can't make the switch. So if you have a decent track record, that's your first start. Okay, your first start is to reach out to prop firms and go, this is my story. This is what I've done. This is what I want to do. Here's my track record. Okay. Now, the number of times someone has come to me and said, I trade from home. I want someone in the prop industry to back me, et cetera, et cetera, et cetera. And I've gone, cool. You sound like you got a good story. You sound like you're keen. You sound like you're earnest. Can you send me a track record? Crickets. Okay. Like, you hear nothing back, right? So if that's what you're going to do, like, get your story together first. Like, this is what shows intent and effort on your part, is research the firm and what they do as much as you can. Okay. We don't all sit there and show exactly what we do and how we do it. Like, I understand that prop firms I don't think we're secretive, but because we don't take money from the outside world, there's no obligation on us to really show everything that we do, right? It's only our money at risk. So I would say research as much as you can. Get your story together in terms of, this is my track record. These are all my statements. This is the broker I go through. This is what I want to achieve. This is what I think I'll need to achieve that. And then it's a matter of reaching out. Like, mate, I'm here. I'm sure at the end of the show, we'll talk about where people can get hold of me, but I'm visible. I'm out here. And most people at prop firms are fairly visible. Like, they all have their contact details on the website, and just be persistent, right? Like, you also have to understand that people are busy. So if they don't get back to you in a day, like, give them a little time. If they don't get back to you in a month, keep pressing them, because our job as a prop firm also is to find talent. That's what we're here to do. We're here to facilitate traders making their dreams come true. Like, that's what I said before, right? So it's a matter of you doing the work on your side, getting your story straight, getting yourself ready, having a keen understanding of what you want to achieve, and then stepping up to the plate and going, this is who I am. This is how I found you. This is what I want to do.
And is someone best to wait for a job to pop up on like a message board, or is it better to like cold call and just sort of put yourself out there before things start to appear?
Yeah, it depends. Okay, so I'm laughing to myself because I think some of the guys that I've kind of mentored, they get so sick of me hearing it depends, because in trading and as in life, there's no real definitive answer to anything, right? It all kind of depends on the scenario. So I'll expand a bit on it. I think that someone reaching out, kind of just out of the cold, out of the blue, there's no ad or anything. It's not, something up on some job website, anything like that. That shows intent. Okay. Like me personally, I like that. Right. I like it if, and it's a big if, I like it if the person is reaching out when they have done the work on their end. Okay. So they reach out. I don't want someone to reach out and going, so I'm kind of keen on trading. What do you guys do? I'm like, bro, come on. Like you can do better than that, right? Someone that has done some work on their end, I'm happy to talk to, right? I think, obviously, if people are advertising, you want to jump at that, okay? You want to jump at that. But this business is not, to me, this is not a business of, okay, we're going to recruit once a year. Like, I'm always recruiting, okay? I'm always interested in talking to someone that I can help and that can help me, always. Like, the door's never closed, right? So I think it really depends. Obviously, if people are advertising, they're saying we're actively looking for people, so you should absolutely go for it. But if you're at a point where you're like, I'm ready to go now, there's no harm in reaching out if you do it the right way.
Sure. And just going back to an earlier comment you made about getting together a decent track record. Now, just to be clear on that, it's not absolutely compulsory that you have a decent track record prior to a prop firm actually giving you consideration, correct?
It depends what you're asking consideration for. So if you're walking and going, I don't want to go through a training program. I know what I'm doing. I'm a good trader. All I want is I want to plug into you for capital. I want to plug into you for infrastructure. I want to plug into you for the back office / compliance stuff. I want to plug into you for all those things that a prop firm also gives people. And we can talk about all those different things a bit more if you want. Then you're going to have to show that you know what you're doing, right? Because you're basically stepping up and going, you see that Ferrari there? I want to take it on the track right now. I don't want you to check my driver's license. I don't want you to do anything. Like, I know what I'm doing. I just want to go from day one. Now, for a firm to do that, they're going to want to look at you from their side and be satisfied that you're a good risk to take. So you're going to have to prove that you're a good risk to take. Okay. Now, what do you need to prove that you're a good risk to take? It's going to be different from firm to firm, right? So I can only speak for myself. For me, if someone steps up, I want to see at least a 1 year and preferably a 2 year kind of profitable track record, right? And even the 1 or 2 year number is kind of misleading, because if a guy is like a long-term trend follower and he's like, well, I'm massively profitable because the guy's done 3 trades over 2 years, and the markets he's trading have been just trending over that period. I'm going to go, well, you haven't really proved everything because your sample size isn't big enough, right? And also the markets have been trending whilst just happened to start trending when you started, and they've been trending ever since. So you haven't seen a period where the market's range bound and whipsawing and you're going through a drawdown. You haven't learned how to deal with that yet. So even though he's got a 2 year track record, his sample size is not enough. Now, the opposite is someone comes in and goes, I've built and not that this would happen, it's kind of an extreme example, but I've built an algo that trades 50 times a day, and I've been running it for a year, and I've got, X number of thousands of trades. That's a totally different story. That guy could probably get back to maybe after 6 months, because after 6 months, he's done thousands of trades. He's doing 50 trades a day, right? So it really just depends. I think that a lot of the stuff, Aaron, I think it comes down to as us Aussies are getting more and more keen to say, the pub test. You need to kind of look at it and go, right, does this pass the pub test, or has this person not really done enough work? So that's That's a scenario getting backed where you just walk in and they go, cool, what limits do you want? Here's your account that you log into, away you go. Okay. If you're talking about getting in as a trainee, getting into a prop firm, getting into the trainee program and trying to do it that way, no, your track record doesn't matter at all. Okay. Like I said, I think I said earlier, it's all, if you come in and you literally go, I don't know what a futures contract is, but I think I want to be a part of this world and I've done X, Y, Z and blah, blah, blah. And that all satisfies the people recruiting you. That's cool. Like you've never traded before, but if you have certain personality traits that are right, prop firms can work with that. Okay. Or if you walk in and you go, listen, I'm super keen. I mowed lawns and washed cars and got $5,000 together. And I absolutely blew it in 3 months and I lost it all. And I realized that, gee, I don't know what I'm doing. And I've actually come to you guys to learn and to help. That's fine, because the fact that you were willing to go out and wash cars and mow lawns in the hot sun to get a trading stake together, that to me shows intent. That shows attitude. That shows someone that wants to be a part of this. So the fact that you blew it up, mate, we all struggle. You know, like I said earlier, we all struggle. We all go through hard times. Everyone's going to lose money at some point. So it's more about intent and showing that you are going to be a good trainee, which is all the traits we've spoken about earlier, rather than any sort of track record if what you want to do is you want to start from scratch, which is getting into the training program and progressing from there.
Sure, okay. And a lot of what we've spoken about here, you know, it makes prop trading sound all very positive. Let me ask you, what are the bad bits? What are the bits that aren't so fun about it?
Yeah, well, I mean, depending on the firm, right? So let's talk about the bad bits that are I guess universal about everything. So if we talk about prop trading just as a career, right? I think there's a lot of things that people don't show you that traders have to deal with. So and it kind of relates back to what I said before. Like I have a real issue with people showing trading as like this lifestyle sort of thing, right? Like, look at me on my yacht, look at me with my Ferrari, etc. Like that's total BS, right? This is a grind. I've said it before and I'll say it again. Trading is a competition. And if you want to win that competition, you've got to work your ass off. So what people don't see is they don't see the fact that you're going to be in front of a screen, sitting, staring at a bunch of numbers flickering up and down for hours. Like I always say to guys, at the beginning, to build up your chops, you've got to stare at a screen until your eyes bleed, you know? Now, it's also not just all about who can do the most hours, okay? But it's not about like models and bottles and all that kind of stuff from day one, right? Like this is a grind. I think people's expectations are often far too high when they come into the industry. Like if your first year, probably your first 18 months is going to be bloody hard, right? And I don't say that in saying that your first year or 18 months are going to be hard. And then all of a sudden it's, you know, guys, drinks on me for the rest of the night kind of thing. That's just you breaking through the, I don't know what the hell I'm doing stage. You then still got to get through the, okay, I'm making a bit of money, but I'm still not doing all that great stage. Then you've got to get to the, gee, I think I can actually do this long term. I'm starting to do okay stage. And only after that can you start progressing to the stage, hopefully, where you start making good tin, right? So people don't talk about the learning curve enough, I don't think. People glamorize trading far too much. I think that people don't talk about stuff like boredom, right? You know, because sometimes there's not a trade to be done. You know, depending on what your style or proclivity or tendency or strengths are, there's not a trade to be done. So how do I deal with the boredom of sitting there going, I just don't see anything happening right now that I want to do, you know, because the flip side is you start trading when you shouldn't trade. You start over trading. So, and that you don't want. So you need to find a way to deal with boredom, right? You need to deal with the fact that your income is going to be very variable. You're not getting a salary where it's like, okay, I get the same amount of money in my bank account every month. This is a game where you could You could have a guy who turns around and he tells you how much he's made that year, and you go, wow, that's a lot. And he made it all in a 3-week period. Okay? Now you think of what his year looks like the rest of the time. He's struggling. He's break even, he's break even, he's break even, he's break even, he's break even. And he gets to month 11 and goes, man, like I haven't earned any money this year. And then he has a 3-week period where he absolutely kills it, and now his year looks great. That's an extreme example, but that's the variability of income. You know, like I've said before to a bunch of guys, is that this is a game where you can make your week in a day, you can make your month in a week, and you can make your year in a month, and you can set yourself up for the next 5 to 10 years in 1 year. You know, like I've seen traders do that. I've seen guys come out where they just have an absolutely stellar year. I'm thinking of one guy in particular, a really good friend of mine, who, you know, came out of 2008, and he was sitting at the beginning of 2008 going, you know, I've got the 3-bed, 2-bath house, but I really want to expand because the kids have to kind of, you know, kids have to share a bedroom and really could, you know, have a bigger house, etc. To at the end of 2008, basically buying a house cash where him and his wife will live their lives and die, right? It's like the dream house. So that stuff can happen, but it all sounds great when you talk about the upside. But the downside, dealing with that variability of income, of not knowing when your next dollar is going to come. And mate, to be honest, the pressure of being essentially a solo small business, because like I said before, as a trader, you're a small business. So as a small business, you live and die by your own hand, right? You know, you asked me earlier about it being frustrating that you try and teach guys and they don't do it. No one can click the button for you. You know, no one can click the button for you. So everything you do is by your own hand. And that pressure can build up, right? It can build up on a person's mindset and mentality. And it's very difficult to maintain the rage, so to speak, for long periods of time. It's very difficult to maintain dedication to the process over long periods of time. It's very difficult to embrace the struggle over long periods of time. It's very difficult to embrace competition in particular. You know, like, you know, I don't know how many times I've said this is an extremely competitive environment. And nowadays, to be frank, people don't like competition. Like we denigrate competition, if that's the right word. You know, like that kind of love of competitiveness and achievement is kind of being, in my opinion, sort of bred out a little bit of society. And that's why I think more and more people are starting to struggle when they come through a prop firm, where it's like, you know, people are just absolutely going as hard as they can to be the best they can. Some people find that very intimidating. So, you know, there's a ton of stuff that I think people underestimate about trading, that they think it's all fun and games. But I promise you it's not. It's bloody hard. But having said that, there is no other industry, literally no other industry on earth I would rather be in.
Wow. That's a realistic window into the life of a trader. Let's start to wind this down, Darren. We're getting on a bit here. Time's gone really quick. I know you're in the works of, or in the midst of starting up a prop firm of your own, establishing your own prop firm. How's that come along? Whereabouts are you at with all of that?
Yeah, mate, we're getting pretty close to launching. So I've moved back over west to sunny Perth for family reasons. My wife is from here. Like I said to you before, my folks immigrated to here, so her family's here, my family's here. You know, and we wanted a bit of a lifestyle change. Her folks are now retired, my folks are retired. We want to kind of, you know, we had a really good time on the East Coast. We both, you know, kind of progressed our careers very nicely. But we felt it was time to move back over west. And so I landed here, and I kind of, you know, like, I love trading. I love helping traders, and I'd learned a lot about the business of trading whilst I was over the kind of past, you know, 5 years. And I really feel that there's some spots where traders are not being neglected, but where I think we can do better. Okay, and obviously, if you talk specifically about Western Australia, like, I think West Australian traders have been neglected for a very long time. But if we talk more globally, I think that there's opportunities to be had where I think the way that people develop traders and grow traders has kind of stagnated. I don't think it's kept up to speed with kind of technology, and B, the things that we've learned about how people learn very complex skills. I think there's been a lot of research and discoveries made over the past sort of 10 years about how the human brain works that hasn't really filtered into the way prop firms train their traders. So I've had an opportunity to team up with the guys at Axia, so Alex Haywood. I know you spoke to Brannigan a couple of weeks ago. Brannigan's a really good guy. Alex, has just been kind of at the forefront of trader development for a long time, and we sort of got together to bring this product. Mainly Alex bringing this product to the fore, which I think is just going to sort of revolutionize the way traders are trained in the prop industry. And so I've kind of come over to WA to get the family back here, get back in the sunshine, back on the beaches, living that kind of healthy WA lifestyle. I want to be able to help guys who are in Western Australia who want to be traders not have to make the sacrifices that I made. Like I'm keenly aware. Like I can sit here and I can recall that young 25-year-old guy or 24, however old I was when I moved over to the eastern states. I think it was around that age. And the sacrifices I have to make, and like I said to you, the personal relationships I put at risk and all those kind of things. Thank goodness it worked out. My wife is a very she's forgiven me for a lot of my sins and my boneheaded nature back then. But it all worked out for the good. So I want to make sure that West Australian traders don't have to make that sacrifice. I also think that Perth is becoming a lifestyle destination again. Like the weather and the lifestyle, like I've alluded to, and the fact that like the property market is not as expensive here and all that kind of stuff. And I just wanted to do something unique and special that really changed the way prop firms look at training traders. And when I found Alex and we got talking, I was just like, yes, this is it. So we're a fair of the way down the way. I think we're probably a month to 6 weeks away. Like I said to you over chat the other day, that when you start going down this path, there's things that you think will happen easily that take a lot longer than you expected. And there's things that you think are going to be very difficult that happen a lot easier than you expected. I've been very lucky in that I've been able to lean on some, we talk about mentors again, like, guys like Morad, like FT71, had a couple of conversations with him. He's been super helpful. Rob at DTG, super helpful. And so leaning on those guys has kind of helped a lot over the past couple of years. And so, yeah, I think we're pretty close, and I'm really excited. I think it's really going to change absolutely in WA, and I think in Australia in general, and hopefully in terms of our partnership with Axia Futures, the way traders are trained in general globally.
Cool, man. Very exciting. I hope it all works out well for you. So let's wind this down now. If someone has questions for you, I'm just trying to think, like, should we get them to leave their questions in the comments of this episode, or should they just email you directly? Should they hit you up on Twitter? Like, how do you want to handle that?
Yeah, I'm happy for people to contact us through whatever medium suits them best. So the new firm is going to be called Signet Trading. So CYGNET, Signet as in a baby swan. So I wanted something that was, kind of based a little bit around WA. So the website is www.signettrading.com.au. I'm assuming we can just put all these in the show notes as we go. So signettrading.com.au. There is a little box on the bottom there where people can type in a message and it'll get sent through straight to my work email. My email is darren@signettrading.com.au. The Twitter account for the firm is @SignetTrading, one word. And then I'm on Twitter. My Twitter handle is @LiftTheOffer. So my kind of very trading focused handle. So @LiftTheOffer. Mate, any one of those. People can find me on LinkedIn, put in my name. Like I'm happy for traders to contact me anyway. Like I said, I really do I'm very passionate about this industry. I've been in love with it from literally the day I walked onto that trading floor in New York, and I'm still in love with it. And even through all the hard times and all the struggles I've had, it hasn't been smooth sailing. It's not going to be smooth sailing going forward. But man, I couldn't think of a better industry to be involved in. I've just met such amazing people, and so I'm happy for traders from anywhere. If you want advice, if you want to be pointed in the right direction, if I can't help you, I promise you, if I can point you in the right direction, I will. So yeah, any one of those ways, whichever way people want to reach out to me, I'm more than happy to answer questions and help people out whichever way I can.
Okay, excellent. Darren, thank you very much for coming on the podcast and spending this amount of time speaking with us and sharing some really top insight. Appreciate it.
Mate, it's no problem. Like I said to you before when we had a call a couple of weeks ago, I think you're doing an incredible service for trading in general, probably more than you actually realize. Like I wish when I had started that there was a trove of knowledge like you've put together, and I think you'll be helping traders for many years to come. So I wanted to just say thank you, because I've learned so much from some of the guests that you had on your show, and I look forward to your continued success going forward.
Well, thank you very much. It means a lot coming from you. Cheers, man.
Cool. Awesome, mate. Take it easy.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Okay, welcome to episode 124, you good folks. Now, this is the first episode out since my trip to New York City, so I just want to say a couple things real quick. First up, a big thank you to everyone who came out to the live Chat with Traders event. It was such an awesome turnout, and I was really taken back by how many people actually traveled from out of state to be there. Really cool. Also, a big shout out to my guest and trader, Mike Agnew, who flew in from Chicago. He was just ideal. Shout out to the Sanglucci crew and the good people at Trading Technologies for sponsoring the event and, of course, helping to make this all possible. And also, props to WeWork for allowing us to use their event space at their location in the financial district. Really couldn't have asked for a better venue. Now, I don't want to speak too soon, but I'm hoping, fingers crossed, we may be able to pull off an even bigger and better event in Chicago later in the year. Anyway, I'll keep you guys posted on any developments. Now, my guest on this week's episode is Max, but for those who know him already, probably know him best by his Twitter name, Madaz. I've lost count of how many times I've been asked to bring Max on the podcast, so for those who have been asking, I'm pleased to say the wait is now over. Max got into trading about 6 years ago after a co-worker pulled up in a brand new Lotus Elise, paid for with gains from trading BP stock. Working as an engineer at the time with average pay, it wasn't long before Max opened his first trading account and got to work. Having now developed a unique style of his own, which he describes as a scalping method, focusing on NASDAQ-listed stocks, Max has become very consistent and very profitable. If you're interested, Max regularly posts P&L on his Twitter account. Just to mention a few things we discussed, how traders can benefit from being independent thinkers, the nature of scalping strategies, optimizing your workflow, mindset, and improving your psychological game, and of course, plenty more. If you enjoy this episode, please share it around. Thanks so much for being plugged in. Here is my guest, Max, for episode 124. So I did get a chance to check out your site, your new website, which you've just put together. I was reading your story, on the, I think it was the About section, and it sounds like you're someone who's always sort of been trying to make a quick buck here and there.
Yeah. Yep.
Do you mind sharing some of the different things that you've tried over the years?
Oh, geez. I could go on forever about this. It's just, I don't know why. When it comes down to it, if I make a buck, say, working at McDonald's versus making a buck, from counting cards and blackjack or something, the $1 that I make from counting cards and blackjack just feels so much better. I think it just has to do with just rebelling against societal norms and what's conventional. I think that's all it really is. But to go in detail about the things that I did, counting cards and blackjack was one. That was the thing that I did in college. I used to work at a movie theater, minimum wage, which at the time was $8 an hour. And obviously that wasn't much. So after work, I would hitch a ride with some of my buddies, and we'd head off to one of the local casinos that allowed people that were under 21 on these Indian reservations. You could be 18 and gamble, and we'd go there and we'd count cards, take our entire paychecks and go and count cards. This doesn't sound like a good idea, but I actually got pretty decent at it after a certain point. But granted, in the end, it turned out to be, I think, about $5 an hour or so. But in the end, it was an interesting experience, and I got a kick out of it for sure. That was one thing that I did. And another thing that I did was I would sell things on eBay that I'd find for, at severe discounts. I would go to stores and see some items that are misappropriately priced, and try to make a profit off of it by selling on eBay. And I also would sell items that I sometimes would find people that throw out into the garbage. I actually found some pretty rare movie posters that were in mint condition in the dumpster, and I actually sold them on eBay, and I actually made a pretty good profit off of them. Those were a couple of things. I also did some other really petty things too. It sounds silly when you look back at it, 10 years down the line, but that kind of set, I guess that was like the prelude to why I started trading.
Yeah, absolutely. Yeah, that kind of shapes the direction you head in. What sort of job did you end up getting yourself into before trading came along, though?
So I went to college like a lot of people, and I studied engineering because I was told that at the time in the United States, we were due for a lot of upgrades with respect to infrastructure. So I ended up studying civil engineering, structural engineering to be exact. And unfortunately, when I graduated, this thing called the recession hit, and I couldn't get a job, or at least a good one. a lot of my colleagues from college, they ended up having to move out of state to some, Midwest state or like Mississippi or something like that. And I didn't want to do that. And those are the only states that really needed the infrastructure upgrades. And I live in California, and apparently engineers weren't in demand. So I was actually stuck stocking shelves at a computer electronics store with an engineering degree for a good 6 months. And also I was tutoring on the side. I was tutoring guitar, piano, and math and science at the same time. And it was a very humbling experience because I was here thinking I was going to graduate and I was going to get a good job and I was going to get paid, a good amount of money. Instead, I'm this kid making minimum wage trying to scrape on the side with a ton of student loan debt on top of that. So it was a pretty humbling experience.
Full on. Yeah, I guess that's probably one of the reasons that you got into trading, so that you were, in charge of how much money you earned and not sort of in the hands of someone else just sort of waiting for a job. Am I partially right there?
Absolutely, absolutely. By the time I actually did get what you would say a quote unquote real job, it was still not the job that I was looking for, that I had in mind. It was just a job that was fairly remedial. The pay was well below what the average engineering starting salary would start off with a 4-year degree. And, I was disheartened. It was tough. It was a shock to me because, when your expectations aren't met, you're going to face disappointment, right? So I was definitely disappointed for the first couple of years after I graduated, and I was stuck at this seemingly low-paying job. And luckily I ran into my coworker, and that's a whole nother story, who introduced me to trading. And that's pretty much how it all started.
Yeah, well, let's hear that story because I know it is kind of interesting. So yeah, please share it with us.
So my coworker, he shows up to work. I know that he got paid as much as I did, and I knew we weren't getting paid that much. He was there 2 years, 1 or 2 years before I was there. So he probably had maybe a couple extra dollars an hour on me, but he definitely wasn't making that much. And he shows up to work with a Lotus Elise, a 2009 Lotus Elise. It was a really nice car. It was yellow. It was absolutely beautiful. Pain in the ass to get in and out, but it was a very nice car. I was like, how the heck did he do that? Because, we weren't making much. The amount of money we made, we would struggle to buy like a brand new regular car. And he shows up with this beautiful Lotus Elise. And I go up and I'm like, dude, man, how'd you get that car? So he tells me that he bought BP stock when it tanked during that oil spill. Have you seen the new movie Deepwater Horizon?
I've been meaning to watch it. I haven't seen it yet, though.
Yeah, that's exactly what it's about. That BP oil spill, and then it caused BP stock to absolutely crash. And apparently, my coworker, he went all in at the bottom of that stock and he rode it all the way, and he ended up supposedly making 80 grand. Obviously, I didn't look at his account or anything, but that's what he said. And he bought this car as a result. So he must have gotten the money from somewhere. So I was flabbergasted. I was like, you can do that kind of stuff, because obviously up to this point, I was an engineer. I went to school for engineering. My last experience with anything finance related was AP economics in high school. So, hearing about all these things and my knowledge of the stock market being fairly limited at the time, I was quite shocked. So I inquired more about it, and he convinced me to open an E-Trade account. And I saved up, starved myself for several months, brought my lunch every single day, and I saved up $6 grand, opened up an E-Trade account, and that was the beginning of it.
And what was the next move from there? Like, where did you go with that $6,000 account?
So at the time, I didn't know anything, again, about how the stock market worked or what was hot, what was anything that was in play. So I was completely reliant on my coworker and other people that he referred me to. And they were all talking about Chinese stocks. I think at the time, they were talking about stocks like Baidu, Sina, Dang. And Dang was actually the first stock I actually bought. And there's a pretty funny story behind that as well. So keep in mind, I'm a completely clueless newbie, and I had no idea how anything worked. So I started to try to buy the stock Dang, And I placed an order, and it wasn't getting executed. And I was asking my coworker why. We got up at, mind you, I live in the Pacific time zone, and I get up at 5 a.m. and market opens at 6:30. So I get up at 5 a.m. to do the prep work and all that. So we're up in the morning, and we're all Skyping on with each other. And I'm asking him, like, hey, why? I have my order in there. Why isn't it getting executed? He's like, you gotta keep refreshing the page, man. You gotta keep refreshing the page. I'm like, what page? No, go to the E-Trade page, the dang page. So I kept refreshing and I wasn't getting executed. So later I found out that page was on 15 minutes delayed quotes. So he was telling me to refresh the 15-minute delayed quotes page. So that kind of tipped me off that this guy really didn't know what he was doing. So I'm like, okay. And I finally eventually did get it executed, but it was completely in the dark. I didn't know where the stock was actually priced at. I was staring at this 15-minute delayed quotes page for like 2 hours. I was like, oh, now I get executed. Like, why is that? And I tried to ask him why, and he said he didn't know. I'm like, okay. So
you were trying to day trade at this point with delayed quotes?
No. I was just trying to buy a stock. I was just trying to get my feet wet. I had no idea what I was doing. And with $6,000, you can't day trade with an E-Trade account anyways. So I was just pretty much just trying to get my feet wet. And I was just hoping that this guy who supposedly, I obviously saw him as somebody who was successful because I didn't have any other information other than the fact that he made a ton of money over a short period of time. So, when you're limited on information, you don't have you don't have all the blanks filled up. You're going to come to these hasty, false conclusions, so to speak. He made a lot of money, therefore he's good at it. So, I quickly found out over the course of the next 3 months that he really didn't know what he was doing. He didn't know what even level 1 was. So, I eventually discovered it for myself. I found out how to access live quotes. I eventually found out about, the E-Trade Pro platform and actual charts, live data and stuff like that. And that's when I kind of realized that trading was actually a lot more complex than what I initially thought it was.
And so obviously you discovered that your buddy wasn't really, how do I say this? He wasn't really more advanced than you were. He just happened to get pretty lucky on that BP trade. Where were you learning from? Like, how were you trying to, once you realized that trading was a bit more advanced than what you'd initially thought, how were you learning? How were you moving forward from there?
Oh, geez. Yeah. So it was just a year of just trial and error. Again, I was completely clueless. And this time I had nobody to guide me. I was relying on my buddy to guide me. And again, expectations not met, right, leading to disappointment. So I was forced to head off on my own. And naturally, what you're going to do, you're going to start Googling things like hot stocks and stock tips and stuff like that. And that led me to like various, message boards. And for better or for worse, I, indulged in those for a good 6 months, 6 to 12 months, actually. And eventually I learned that those didn't work out too well, as I found out that a lot of people that posted on there had an agenda, so to speak. So after sustaining some pretty, substantial losses, I quickly realized that when it comes to trading, you can't really trust anyone. You just got to be a completely independent thinker. And I started to look at things more objectively, started looking at more objective material and studying things like chart patterns and level 2 and things that you can't really subjectively interpret, so to speak. So I stopped looking at, reading, I stopped reading news articles where people would obviously, like I said, have an agenda when they write said articles. And I was just start to look at more objective things. And that's when I started to really get a better understanding about what trading really was.
Now, these losses you mentioned, how damaging to your account were they?
Oh, geez. Well, I did get lucky myself on the first couple of trades, and I quickly wiped all of those out once I tried to do things on my own. And definitely they were not only damaging to my account, but damaging to my psyche. It was a huge, I would say a huge confidence hit. You're going out there and you think you have an impression, okay, your buddy's making a lot of money. You think you're going to make a lot of money. You're successful on your first couple of trades. You're going to think that things are going to be easy. And then all of a sudden you get hit, blindsided. and you kind of realize things aren't that easy. You start losing money, and then it becomes a downward spiral unless you kind of realize what's going on and you save yourself and try to, figure out how you can remedy the situation before it gets out of hand. So yeah, they were quite damaging to my account, but then I would say the bigger damage was to my mindset, really. So I almost quit pretty much in the first year, really, if I think about it now.
So what was it that made you not quit?
Well, like I said, I ventured off on my own. I looked up some material that I kind of looked at it more objectively. And again, it was just trial and error. It's really hard to pinpoint the exact moment. I get asked this a lot. What was the exact moment where you just got it? It's kind of like riding a bike, right? People can teach you how to ride a bike or whatever, but one day you're going to reach that certain threshold where you got enough practice where you just get it. And then once you just get it, you never forget how to ride a bike, right? It's the same thing here. I mean, I can't pinpoint the exact moment where I got it. And I certainly didn't just, wake up one day and magically acquire all of the skills to become a successful trader by any means. It was definitely a lot of dedication, a lot of hard work, but it was more of a cumulative process. And one day, everything just clicked. It was just a lot of time, a lot of effort, a lot of staring at charts, a lot of staring at level 2, and it's pattern recognition. So once I recognized patterns and put 2 and 2 together, and that was about maybe like the one year point. If I can kind of at least give you a range of when I started to get it, about the 1 year mark was when I actually recognized various patterns that kind of allowed me to have some degree of success to get me going at least.
Okay, now just backpedaling a little bit, it sounds as though you went straight into live trading, like straight out of the gate. Did you ever consider paper trading?
In hindsight, I definitely should have. And anyone that asks me today, if you're looking to start off trading, what should you do? You should definitely paper trade, hands down, 100%. And the reason why I didn't do it was because I just had, the go-getter mindset, and I just wanted to jump in and I just wanted to start making money. And obviously, that's not the right way to approach it. But, with the benefit of hindsight, it's easy to see. But when you're kind of like a money-hungry kid who's still in his 20s, who's been, I guess, so to speak, deprived of having a good career to start off with supposedly what was expected to be a decent degree, a decent field to enter in engineering, I felt like I needed to make up for lost time, so to speak. So I decided to just jump in to the deep end of the pool, for better or for worse. So
yeah, kind of impatient in some ways.
Yeah, absolutely.
So obviously paper trading is something you would have done differently. Should you have your time again? What other mistakes did you make? Like, were there any other great mistakes you made in those first couple years which you think might be beneficial for others to hear about?
Yeah, absolutely. I definitely used too much capital, a very large percentage of my capital when I was playing. Basically, I was kind of going all in on a lot of the trades, which is highly not recommended. Because when you're new, you don't understand risk management, and you don't understand, when is the right time to take profits, when's the right time to stop out and cut losses. So definitely, if you're a new trader, play small and give yourself a chance to learn, because the moment you run out of money, you lose the ability to learn. And if you lose your money before you acquire all the skills to become successful at trading, well, I mean, that's pretty much the end of the road for you. So I was lucky enough to kind of catch myself doing that, and I stopped doing that before I lost all my money, fortunately. But I'm sure it happens to a lot of people. And, for the people that are still in the process of deciding what you should do, definitely play small. Another mistake that I did was I obviously was too impatient with a lot of things. Like I said, jumping off in the deep end of the pool. I also would believe a lot of the things I would read, a lot of the subjective things that I mentioned earlier on the message boards and things like that. And I think that's true for a lot of new traders. Like I said, when you're new and you're like a blank canvas, right? You don't know what's going on. You're going to read something and it's going to influence the way you think. So that led me to hold a lot of stocks a lot longer than I should have. So, the popular term bag holding. Yeah, I was definitely a big time bag holder in my first year. I'm not too shy to admit it, but definitely you got to be an independent thinker in this game. That's all it really is. I would definitely say think for yourself, manage risk. Don't overextend yourself by going in too big too early, and definitely paper trade.
Okay. Well, Max, let me ask you this question. So when you first came into trading, what things did you believe to be true about trading, which you now realize are not true?
Oh, that trading was a lot easier than it really is. I mean, that's probably the biggest thing. I mean, when I first heard of that statistic, I'm sure this gets thrown around a lot, 90% or 95% of traders fail. When I first heard that, I thought it was just a straight up lie. I didn't believe it. Because if you look at all of the things in the world, even the most difficult things, I'm just thinking of, say, for example, like brain surgery or something like that. I mean, brain surgery is a very complicated task, but 90% of brain surgery doesn't result in failure. So I'm thinking here, like, day trading is that much more difficult than trying to do brain surgery. So I haven't actually done brain surgery, but I've done pretty hard things. I studied engineering. That was a very difficult field, and there were some very tough exams that I took, and here I'm entering a thing where I'm led to believe, obviously, with my buddy telling me that he made a lot of money, I had the impression that it was going to be easy, and now I'm hearing that it's 90%, 95% of people fail at it. I'm like flabbergasted. I just didn't believe it. So that was a big myth, and once I actually got into it, and I kind of realized there was a heavy psychological aspect of it. Now I kind of got a better understanding of why 90 to 95% of traders fail.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Well, let's talk more about how you actually became full-time as a trader. So tell us about the point that you went full-time trading. Like, what did it take for you to be able to make that leap, if you will?
So I can only speak for myself, of course. This is going to differ for everyone. Everyone asks me this question, like, what made you decide to, to move into full-time trading? Why were you comfortable in doing that? So for me personally, I worked on my engineering job for 3 years. And funny story there too. I sneaked trades on the job. I hope my boss isn't listening, ex-boss. But I often sneak trades on the job, and I did that concurrently while working. And, so I was basically trying to gain experience in trading. And obviously I didn't want to completely cut off my engineering job in case trading didn't work out. I would just quit trading and just live life the conventional way and just become an engineer. And I was content with that. And trading was just a thing where if it worked out, great. If it didn't, then that's fine. I tried, and I don't regret trying. So after 3 years, I saved up enough money from my salary. I saved up about 5 times my salary, on top of the fact that I waited for 2 consecutive years of 6-figure gains in just trading. So that was pretty much my metric in measuring what was defined as comfortable for me to quit. So 2 years of 6-figure profits from trading, and collectively 5 years of my salary saved up. So that's what I did.
Okay, so let's break that down a little bit. So you had collectively, from trading profits and your savings from your job, you had about 5 years worth of
Absolutely.
what you were earning. Okay.
Yeah, absolutely.
So, I mean, to make 6 figures 2 years in a row as a trader, just a couple years into this, that's very impressive. I mean, how were you able to do that? I know that's a very open-ended and broad question, but that's very unheard of.
Yeah, so there are obviously a lot of factors. I mean, I put a lot of time and effort into it. I definitely don't underestimate that aspect of it. I woke up at 5 a.m. I would study after hours for 3-4 hours. And this is on top of having a 9 to 5. So I would wake up at 5, trade from 6:30 to 8:30, go to work, and then come back to work. It's like 6 p.m. and I'm still going to be studying material until basically the time I go to sleep. So I definitely I paid my dues for sure. I was also probably very fortunate to be in a time where the market was, I would say, fairly easy. I would say relative to now, the market conditions were a lot easier. Especially it was more friendly to the new trader. Back then, the hot thing was penny stocks, OTC bulletin board stocks, and it was a lot easier to pick up the patterns that were prevalent in the OTC markets as opposed to now that we're trading these small cap on NASDAQ listed stocks. So I guess I was fortunate enough to kind of enter in during a time when it was just, the learning curve was just a lot easier, so to speak. So I picked up on the patterns pretty quick. There wasn't as many patterns to learn. And thankfully, just a combination of hard work and just the right timing led to early success, I suppose.
Okay. And would you say that a large majority of those profits came from a few really good trades, or did you just hit a lot of nice singles?
So there were a lot of big trades for sure. I would say just the nature of the way the OTC markets operated, there would be 1 or 2 hot stocks on average a month or so, and they would kind of drag on for that month or sometimes even more than that. So we would pretty much trade the same stock every day for a month, 2 months even. So again, this goes along with the pattern of things were pretty much repetitive and they're very easy to recognize. So definitely a lot of the profits did come from a few trades, but at the same time, this allowed me to kind of slow things down. It wasn't as fast paced as it was now, so it allowed me to pick up things a lot quicker due to the slower pace of the way the market operated. Given that you can just wait for that one good trade to pop up, as opposed to now where you're always on your feet a lot more often in the more active market with these listed securities. But with OTCs, you would wait. Sometimes you would wait more than a day, and then you would get the big trade, jump in, make your money, and then just sit there and wait for the next big trade. So it just really depends on how often they would occur, but it wasn't really something that was required you to be on your feet at all times, so to speak.
And 5 years salary, I'm not sure how much that is. Do you mind sharing?
Yeah, I was making about $50,000 as an engineer, definitely well below average. So I saved up about $300,000.
You had about $300,000. Okay, so you had about $300K when you quit your job. I mean, that seems like quite a big safety blanket, you know. Not much can go wrong there. Well, I should be careful saying that, but
yeah,
it could go very wrong very quickly, actually. But, you know, you did have a very big safety blanket there. Was that $300K, was that a figure you had in mind that I have to reach this before I quit my job, or was it more I want to have a couple of years of consistency before I go into full-time trading? Like, why did you not quit your job sooner, I guess, is the question I'm trying to ask here.
So it was a little bit of column A and a little bit of column B. So I didn't come up with that 300K number predetermined fashion. I just definitely had that 2 years of consistent profits over six figures in my mind, though. I did have that for sure. And it just so happened to work out that at the end of the 2 years of consistent six-figure income, that it happened to be around 300K. And that's when I kind of took a step back and I kind of calculated my finances and made sure that it was a wise decision to move on. And, you know, in the worst case scenario, in case it doesn't work out, I still have 5 years of salary to live off of and, you know, a good amount of time to look for another job. So it just happened to work out that way, but I didn't have that 300K number predetermined.
Okay. And how long have you been trading for now? I know you said you started in your early 20s. How long have you been trading for now?
As of last month, 6 years.
6 years. Okay. So let's talk some specifics about how you're trading. What sort of trader are you, and what sort of trading opportunities are you trying to catch?
I mainly trade small cap listed NASDAQ stocks, and I mainly scalp them. And I know there are a lot of people that are going to, you know, debate this with me about scalping, but in the end, who cares, right? No matter how your approach is, what your approach is, if you make the money, you make the money. So scalping is something that I've adopted just due to the nature of my personality. And I kind of came to the conclusion that I'm better off finding a trading style that suits my personality as opposed to, you know, changing my personality, changing who I am to suit that style. So I'm naturally a pretty impatient person. I was always that kid that wanted to open that present early on Christmas. And I was also a very anxious person naturally. I was always the kind of person that would, if I was stuck waiting for something for an extended period of time, I would start getting really nervous and I would start getting really anxious. So that kind of made it difficult for me to have to hold the stock for even a couple minutes. I mean, a couple minutes being like 10, 15 minutes. I mean, I could still do that at times, but I would much prefer not to, just because of the way I am. So a lot of people would ask me, you know, why I do this scalping method. And so it just really has to do with understanding what kind of person I am and my characteristics, my qualities, my personality, and finding the right trading strategy that suits it. And that's really all it is.
So when you describe your strategy as more of a scalping strategy, do you mind just really dumbing that down and explain to us what that means? Like, what's your interpretation of scalping?
So scalping basically just means that I get in and out of stocks very, very quickly. Micro moves, long-term patterns, I wouldn't say they're completely irrelevant, but I would say that they don't have as much of an impact on these trades that I take. Also, things like fundamental analysis, I wouldn't say I would throw them out the window. It's still good to know the information, but they don't influence these trades as much as, say, somebody who tries to swing trade for a longer duration of time. So given my impatient and anxious nature, I don't want to have my trade impacted by these other factors. So I try to minimize the effects of them by, you know, limiting the duration of my trades down to sometimes a matter of seconds.
Okay, seconds. So, I mean, what would you say is an average? You said sometimes it can be seconds, but as an average, how long are you typically holding a position for?
Maybe about 2 to 3 minutes on average, I would say.
2 to 3 minutes. Okay. And what sort of price move are you trying to take out during that time as well? Like, so we sort of spoke, how long are you holding these positions for? How much what sort of price moves, what sort of range are you trying to get out of each trade?
So it varies. It depends on the stock. If a stock is a higher price stock, it obviously in a lower float, a smaller share structure, then it might be a larger move. Maybe it could be $1, $2, $3. But for the lower price stocks that are below $10, maybe 30, 40, 50 cents on average, but it varies.
And on a normal day, how frequently would you be trading? Like, how many trades do you take in a given day as a scalper?
So in terms of round trips, I would probably say on an average day, I would say maybe like 20.
20 round trips?
Yeah, 20 round trips.
Okay. And as a scalper, do you ever get frustrated when you see a trade that you got into and got out of continue to move in the direction you were trading? Like, as a scalper, I guess you sort of take the risk that you're going to miss some large moves because you're in and out so quickly. Is that ever the case? How do you deal with that sort of thing?
That was definitely something that I kind of dealt with early on in my trading career, especially the part when I started to develop this scalping style and integrate it as the main part of my repertoire. But I just kind of got over it. It's just the nature of the strategy. It's a trade-off. I'm trading off basically getting in and out quick, mitigating the effects of these random market events such as news or some random thing that causes the stock to adversely go against me in exchange for potentially missing out. And again, with the way trading works, it doesn't really matter because if the stock keeps going up, I can always get back in anyways. So if I take a step back and kind of look at it, I think it's a fair trade-off. And, given the fact that I can always get back in and just keep scalping the same stock and still make money off, it's not really that big of a deal.
So is that something you do quite frequently, is sort of scalp in and out of these larger moves if they occur?
Absolutely. So if a stock is going in a continuous uptrend and I'm in and I sell on a quick move and the stock keeps going up, then I would just wait for the next dip, the next pullback, or the next washout, and I would just get in and buy that and then repeat and rinse until the trend breaks. That's really all it really is.
Would you consider scalping to be somewhat of, I guess, more of an advanced strategy? Like, is it something you would suggest newer traders even consider, or they at least need a bit of market experience before sort of trying to get into this sort of thing?
Well, one of the key things about scalping is you got to be really quick. I think a lot of people give a negative connotation to scalping is because they don't really understand how it works and why I do it. So with scalping, you actually have to be very quick and you have to have the ability to make very, very quick decisions. So sometimes you get into a trade and it might go against you right away and you have to recognize within a second that you got to get out to salvage the situation. So you got to be able to make decisions very, very quickly. So not only do you have to be quick with your keyboard and your mouse, but you have to be very quick-witted and make these decisions very, very quickly. And I believe this is where, again, the whole 95% of traders fail kind of thing kind of comes in, because even if you understand the decisions that need to be made, when you're kind of in the hot seat, so to speak, it's actually very difficult under pressure to make these kind of decisions very, very quickly. And scalping really, really amplifies the effects of these decisions that you make in a very, very small time frame.
So let's not gloss over this. Let's speak about this a little further. You do need to be very quick as a scalper. What are some of the things you do to optimize your speed of execution? Like, do you have, you kind of hinted there, you've got hotkeys set up. Do you have your screen set up in a certain way, like your platform and that sort of thing? What are some of the things you do to optimize your execution and your decision-making ability?
So hotkeys is a very huge component of it. Anyone that hasn't set up their hotkeys to trade, they're definitely at a severe disadvantage. It's almost like bringing a knife to a gunfight. By not having hotkeys, even if you're not a scalper, by the way, if you're in a situation where you have to get out of a stock really quick, you have to exit a position really quick, the hotkey could be the difference between, a small loss and a major loss. So hotkeys is a huge component of it. And I would say the way I set up my platform, I have all of my charts and all my level 2s very organized. And I also have basically my orders kind of pre-entered in, not sent out to the market, but pre-entered in. I also do some pretty thorough technical analysis. So I have a pretty good idea of where these stocks are going to dip to, where they're going to pull back, where they're going to, bounce off of. So I kind of have a pretty good idea of where they're going to go, and I'm going to enter those prices in my platform already. So by the time the stock hits those targets, it's just a matter of clicking a button. So it's like 1 second.
So what are some of the actions that you have set up as hotkeys?
Changing my routes, hitting the offer if I have to. I basically have hotkeys for entering a position where I add liquidity and take liquidity. I have a hotkey where two hotkeys where I exit a position where I take liquidity and add liquidity. So one for enter and one for exit. So it's a pair for each. Share size, changing your share size on the fly. Sell half, sell 1/4. Things like that. That really helps add to just making quick decisions and just being really, really fast when entering orders.
When you're scalping, are there certain order types that are preferable for you to use?
I always have been a fan of only the limit order, because people always ask me this as well. If you try to use a market order, I've always thought that it's kind of a blank check to the market makers. They can pretty much execute your order technically wherever they want, and I don't want to be put in that situation where I get a poor execution, especially on a stock that is very volatile. You might get a really bad execution. So I always use a limit order to have that control, knowing where I will at worst get executed with my orders. So always limit orders. I've always used them. I stopped using market orders after a really, really bad mishap after the first year. So ever since then, it's always been limit orders for me.
Do you mind sharing that mishap?
So it was actually on a penny stock that was relentlessly dropping like a rock. I made the mistake of panicking using a market order, thinking that I would get executed right away, because I've heard people say, hey, market orders, you use them, you can get out right away, They also have priority over limit orders. Okay, fine, let's try it. I tried it. Basically, when on the way OTC bulletin board stocks work is that they tend to fill your orders very, very late. Sometimes the stock can drop even dollars and your order might not get executed. It's just the nature of the way OTC stocks work. So I hit a market order, and like I said, it's a blank check to the market makers. I mean, when the market makers see a market order sent to the market, I would imagine that their eyes are probably lighting up, and they're like, okay, let's fill this guy at the worst possible price, because that's pretty much what happened to me. I hit market order thinking that I'd get out relatively unscathed, and I ended up getting sold at the very bottom. So I took a pretty substantial hit.
Does that mean market orders are treated differently on NASDAQ stocks?
Well, I think most of the time on NASDAQ stocks, you'll get executed where you expect to get executed with the market order. But even if there's a 1% chance that I might get a poor execution, again, particularly on stocks that are moving very, very quickly, very volatile stocks, especially the stocks with a very small share structure that can pretty much skip dollars. I don't want to be put in that situation where I'm expecting to stop out, say for like a small loss, and end up getting stopped out for a major loss. So I want to protect myself by having a higher degree of control by using a limit order.
Now, I think one of the things we haven't really covered up to this point is how you actually identify which stocks you're going to participate in and try to scalp. So do you mind shining a little light on that and telling us a bit about how you actually identify these trading opportunities and these stocks?
Again, I wake up in the morning. This time I wake up around 6 a.m. now. Before I used to wake up at 5 a.m. But now with more experience, I can wake up a little bit later and still accomplish the same thing. But I wake up around 6 a.m. and I look at my scanner. I look at the stocks that were in play from the day before to see if there's any continuation. And I pretty much scan the type of stocks that I like to play, which are typically lower float, small cap stocks. And I'd sort them by large gap percentage change from the close, large percentage change from the close. And I also note the float, like what size of the float the stock is. And I also look at other things too, like percentage owned by institutions, because that also impacts the way the stock trades. But usually I just pick the stocks that have the biggest overnight move or the biggest intraday move, and I just look for volume. If it has all these components and it has the volume and it has the price action, you'll probably better believe I'm going to be there.
Are you able to take that one step further and share maybe a stock that was on your radar today and sort of give us the reasons why?
Yeah, so today the hot stock, the flavor du jour was IMGN, I believe the ticker symbol. And let me make sure that was the right symbol. Yeah, IMNP was the ticker symbol today. And the reason why I ended up trading that was because it was the top gapper of the day. It had a relatively small float. It had very large volume at the open. It pretty much had all of the ingredients for a stock that I would like to trade. You know, I like to trade stocks with volatility, stocks with liquidity, stocks that just offer an opportunity to make a decent amount of money in a very short period of time. Again, going back to my scalping style, and that's why it all fits together.
Now, one of the things I noticed, I think I was watching one of your YouTube videos when we were doing a little bit of research for this interview. You used 3-minute bars, right? That seems a little unconventional. Tell us a bit about the idea behind that.
So when I first started, I used 1 minute, and I was, led to believe that 1 minute made the most sense because, I'm scalping micro moves. Having a 1 minute candle gives me the information that I need to make these kind of micro trades. I eventually found out that 1 minute charts are very, very choppy. They give a lot of false signals because it's a lot of data. It's a lot of information. When you have all of these candles kind of going back and forth, you kind of have a much more difficult time seeing any clear trends or patterns with so much data going on. So I switched to a 5-minute chart, which was something that was fairly popular as well. And I was trying that for a little bit, and I quickly realized that was too little information. That would just give me too general of a picture. And for the purpose of scalping, if I'm in and out of trades, 2 to 3 minutes, 5 minutes was just simply too long of a duration for me, and I just didn't have enough information to make good decisions. So I first switched to another platform called Thinkorswim, which I still use to this day. They had 3 minutes as one of the default time intervals, and I was like, oh, this is kind of cool. Let's check this out. So I started using 3 minutes, and it kind of stuck because it was pretty much the perfect compromise. I mean, perfect compromise mathematically as well as just for the purpose of trading, because it gives the right amount of data, it gives the right amount of information. It's not too choppy like the 1 minute chart where it gives false signals. It gives me a good picture without being too general with a 5 minute chart, and it just works out perfectly for me.
Okay. Max, I'd like to ask you a bit about reading the tape. I posted on Twitter a little earlier to say that I was going to be having you on the podcast, and if anyone had any questions for you, and I don't normally do that, but the reason I put that out there was because I've had a lot of requests to bring you on the podcast, so it kind of made sense. I presume that there would be people who had questions for you. One of the things that came up a couple times was to try and get some insight out of you on reading the tape. So tell us a little bit about how the tape plays into how you trade.
The tape is probably the main thing that I use to make my trades. It's probably the most important component. And unfortunately, it's a pretty difficult concept to explain to, especially to a person who's fairly new at trading, because the tape is basically, it's just the level 2 is just buyers and sellers, right? And the time in sales is just the orders going through, and then the chart itself is just a graphical representation of the time in sales. So the tape, there's lots of stuff going on. There's lots of manipulation. There's lots of algos fighting each other. So it's really difficult to generalize tape reading in even, a couple of words or a couple of sentences, or, it's very difficult to explain it because there's just so much stuff going on. There's so many different patterns. There's so many different algos out there. So when I come and approach a stock, I try to pick up really quick the patterns that the algos are using on that particular stock. I try to pick up, okay, are they trying to support the bid? Are they trying to sell shares on the ask with an iceberg order relentlessly? When are they going to stop selling? Are they going to stop selling? Is somebody buying an infinite amount of shares with an iceberg order? I use terms like bid prop and, refreshing seller to kind of describe these kind of things. But the problem with that is it differs from stock to stock. So what may be true for stock XYZ might not be true for stock ABC. So when somebody asks me, like, how do you get good at tape reading? It's really difficult because it's different every single time. So my best advice to these people would be to record your trading days, as many as possible. Record your level 2 and your time to sales and the chart too. And then once the trading day is done, go back, watch it in slow motion, watch it in half speed, 1/4 speed, however slow you need to kind of pick up these little things that the algos are trying to toy around with on the level 2. Like I said, there might be a hidden order, a hidden buyer, a hidden seller, an iceberg order, something like that. You got to be able to pick up on these things. And again, it's not the same on every stock. So you got to pretty much do this every single day until you kind of develop a sixth sense or an intuition to be able to pick up these things and be able to adapt no matter what stock is in play. You kind of know the tricks, and when they come up, then you kind of recognize it right away. So that's probably the best way I can put it.
Yeah, and that's one of the things I was going to ask you about. I was going to ask you, like, is tape reading something which can be taught, or is it really something you have to learn through, hours upon hours of screen time and just observing sort of the market behavior and that type of thing? So I think you've made it pretty clear there. Also, I think a good question to ask you around this, what advantage do you get from tape reading that you couldn't get from your 3-minute bar charts?
Oh, that's a very, very good question. So I would say, again, the chart is just a graphical representation of the time and sales. And another term for level 2 is market depth. And the key word here is depth. So what does depth mean? That means that you can see beyond the first buyer and the first seller, right? If you're looking at level 1, you got the best bid and the best offer. But then when you have level 2, now you have market depth, which means you see all of the buyers below the best bid, and below all of those sellers below the best offer. So you get the advantage of seeing beyond what the chart can tell you. The chart doesn't tell you how many buyers and how many sellers there are. It doesn't show you imbalance, right? It doesn't show you an imbalance of buyers or imbalance of sellers. You can't tell. With the level 2, you actually can kind of see that. But then again, when it comes to tape reading, you got to be able to recognize things like hidden buyers and hidden sellers, because people can do things like hide size on the level 2 and try to deceive you that way as well. So it's not exactly black and white either. But then again, like I said, it's better than nothing. So with the level 2, with the market depth and the depth part of it, you kind of get to see, I guess, so to speak, what's below the surface or what's behind the scenes, as opposed to seeing just only what's on the front.
Yeah, no, I think that's a good way of putting it. So we've kind of established here that you use bar charts, or candlestick charts, whatever, 3 minutes. You use the tape. And I noticed that the only indicator you use is VWAP. How do you use VWAP, and why is that your only indicator?
So VWAP was something that is a fairly recently popular indicator that kind of came into the market, I would say maybe a couple years ago. It gained prominence. I'm sure it's been around for a while, but it got really popular amongst the trading community about 2013, 2014, around that time. And as a result, I kind of noticed that a lot of the algorithms started to base their trades off of VWAP. Of course, that's not always the case, but trading is a game of probability, so you got to go off of what the odds are. So I noticed that a lot of the algos started making trades off of VWAP, and they would tend to use it as an over-under. So what I mean by over-under is if the stock is above VWAP, it tends to be bullish. If the stock is below VWAP, it tends to be bearish. So I basically just use VWAP as just a kind of an indicator to know whether to be long bias to stock or to be short bias to stock. So I wouldn't be shorting stocks that are above VWAP. I would only be longing them. I wouldn't be longing stocks below VWAP. I would only be shorting them, and so, things like that. Now, the reason why I only use VWAP as my only indicator is because if you kind of understand what indicators are, I'm talking about things like simple moving average, things like SMA, EMA, MACD, things of that nature. They tend to be what we call lagging indicators. And lagging indicators, it's in the term, right? It just means that it gives you a delayed signal. So by the time you get the confirmation signal from these indicators, be it like a golden cross or whatever, the move has already been made. The true traders can actually anticipate these moves before they happen, and that's where the profits really come in. So if you're reliant on these indicators, such as the simple moving average and things like that, you're kind of behind in terms of, all these other guys that are beating you to the chase using, their abilities to anticipate moves before they happen. You're going to be pretty much chasing their stock. You're going to be pumping their stock even higher so they can sell at a higher price. So that's why I stopped using them. I did use SMA for a while. I used RSI for a while, and I used MACD for a while. They didn't really help me. So I just kind of use VWAP, and I don't use VWAP as a signal to get me in and out of a stock. I just use it as an over-under, a general over-under to distinguish between bullish and bearish, and that's all I really use it for.
When you use VWAP, do you factor in the slope of VWAP or anything like that, or is it plain and simply just is price above or below?
Well, there are other things too. For example, if a stock has if it's considerably above VWAP, then you can kind of draw a conclusion that the longs really have control, the bulls really have control of this stock, and that the shorts are in deep water. So if you can kind of measure the distance between the price of the stock and the VWAP, and that kind of tells you how much of a discrepancy you have in terms of buyers versus sellers. If the stock, for example, is well below the VWAP, the price is well below the VWAP, then you can kind of say that the bears have firmly in control of the stock. Now, if you see a stock trading kind of at the VWAP, then it's kind of more neutral. And I guess you can say that, it's a no man's land, so to speak, and nobody has control. If the stock is only barely above it, then maybe the longs don't have as much control. Things of that nature. So I would take into consideration the distance of the price of the stock to the VWAP.
Excellent, man. Very good. Let's change gears a little bit. Let's talk about psychology, and then I think that'll probably take us out. I know psychology and mindset is a really big part of how you trade. You said to me prior to I hit the record button here that you think trading is about 80% psychology, 20% about sort of, I guess, technical skills. How come that's your belief? Why do you think this way?
I believe this way because, again, it comes back to the whole 99.5% of traders failing. If trading was as simple as just memorizing chart patterns, memorizing terminology, even reading charts and reading the tape, it was just solely dependent on those kind of skills and just memorization and regurgitation and things like that, then I think it would be a fair assumption that more than 5 to 10% of traders would actually succeed at this. And again, that's a very loose statement. When somebody says 90% of traders fail, that doesn't necessarily mean that the 10% of traders are actually making enough money to make a living out of it. It might be that, if you're in the top 10 percentile barely, you might be barely breaking even. You might just not be losing. So that number actually might be even higher. It might even be like the top 1%. Who knows? But going back to the point, yeah, if it was really that simple, then more traders would actually succeed at it. If it was just simply memorizing the Pythagorean theorem for your math exam, right? Anyone can do that, and then you could just implement it and you're good. Here, you can implement all of these things that you read. And if you can't have the right mindset, you can't make these decisions in a high pressure situation, it all goes to waste. You can't really do it. It's like that professional basketball player, for example, or the professional soccer player. They probably practice penalty kicks all day in practice for years. So why do even the best of players end up missing in a very high pressure situation? It's not because they can't do it. They've done it millions of times. But it's because there's a psychological aspect of it, of what you would call, I guess, the intangibles, right? So in trading, it's no different. You have to be able to be mentally conditioned. You have to be very, very, very mentally stable. You have to be very confident. You have to be able to make these decisions. And you kind of have to have that feeling of being able to make these decisions without kind of, reconsidering yourself, doubting yourself, having that feeling. These things can't play in your head when you're making these decisions, or else it's just going to cause you to have a downward spiral and eventually possibly even have a mental breakdown. Who knows? So that's one major reason why I would say 80% of it, if not more, is psychological.
So with that being said, is there anything you do to try and improve your game in the psychological area? I mean, I know that question wasn't worded very well, but is there anything you sort of try to focus on that's going to help you psychologically in your own trading?
So on top of obviously developing and being competent with the skill itself, obviously, you can have all the confidence in the world, but if you don't know how to do brain surgery, it doesn't matter how confident you are, how much you believe in yourself, you're not going to be able to do it, right? If you don't have the skills. So you have to be very competent in the skill set that you need to be successful at trading. Obviously, if you're a scalper, you have to be quick. You got to have all the hotkeys. You have to know all these things, of course. So first of all, obviously, you got to know your stuff. But in terms of mental conditioning, this goes beyond trading. And some people have probably read my blog post about this, where I explain that a lot of mental conditioning takes place outside of trading. So I do a lot of things like meditate. I go out and I enjoy my life. I get my mind off of trading. I'm not thinking about trading 24/7. I'm not polluting my mind with these thoughts that would be detrimental to my mentality. So I go out there, I live my life like normal. I enjoy it. And I firmly believe that if you are a person who enjoys your life, and you're a person who's genuinely happy, and you go out there, it's gonna carry over into trading. You're gonna have that clear mind to be able to make these decisions if you don't have all these other things going on. For example, a professional athlete will undoubtedly be able to perform very well night in and night out if he's a very talented athlete. But if he has things and issues that are going on off the court or off the field or whatever, that's going to probably affect, his or her performance when it comes to the big game. So the same thing here. If you're a person who struggles to do things that keeps their mindset stable on a day-to-day basis, if you're a person that struggles with things like, say, addiction, or you're a person that gets angry very easily, are you a person who just has issues just controlling little things here and there? These things will carry over into trading. If you're a person who just can't control yourself, can't really control yourself from doing certain things, like I said, having that addictive personality, that's going to cause you to become a trader who just starts over trading, starts getting greedy, and it's obviously going to result in your downfall. So I think the psychological aspect of trading, again, 80% of it comes from within. It comes from internally. It comes from who you are as a person outside of trading. And whatever person you are outside of trading will carry over into your trading performance, and it's going to probably, I'm pretty sure, will impact your trading results.
What you're saying here kind of reminds me of that saying, how you do one thing is how you do everything. And I really believe that's very true. If we just bring this back to trading, in particular during the trading session, how do you sort of control your psychology as much as possible and your mindset during the day? Like, I presume, let's say you've just lost money on the last few trades. Is there anything you do to try and stay focused and keep your head right?
There's a little running gag that I post on Twitter pretty often. And it's a hashtag called Trader Nap, and it's a joke. I mean, it's in good fun, but there's actually a pretty good reason why I actually do that. So there's undoubtedly periods of time during the market where it's a lot easier to make money, and there's going to be times where it's a lot more difficult to make money. I've found out personally for me that at the open is where I make most of my money. And progressively throughout the day, especially during the lunch hours where New York goes to lunch, which is basically 12 noon Eastern time, around those hours, that's when the volume kind of dries out, the volume diminishes, and the price action also kind of diminishes as well. So I kind of identified during those periods of time, it's in my best interest to just walk away, not trade. And I say, I'm just going to go take my trader nap. I'm just going to go knock out on my bed behind me. It's actually something that I really highly recommend people do. Walk away when the edge is no longer there. Why trade during a period of time when you're probably going to end up losing? It's going to cause you unnecessary amount of stress on top of obviously hurting your trading account. So there's really no reason for you to do that. And a lot of people obviously will have that urge, right? Going back to that addictive personality, if you kind of have that tendency, you're going to have that urge to want to keep going. It's the same reason why people stay at the blackjack table in the casino, even when they're up and they know they should leave. Why do they stay and end up losing more money? It's the same thing. People have those kind of mental battles within themselves, right? Those mental struggles. So my approach to this aspect is basically to take preventive measures. Don't put yourself in a position where you're going to be forced to maybe succumb to these urges, these detrimental urges that you may have. If you know that if you have an addictive personality, then you should probably take a step back, and kind of look at it and be like, okay, what can I do to even prevent myself from putting myself into a situation where my addictive personality might take over and cause me to do things that will result in me losing money, right? And obviously this applies throughout every other facet of life, but for the sake of this discussion, we're talking about trading. So having identified that there are periods of time where there's a better edge than another, we should probably objectively look at it and be like, okay, take these preventive measures. During these hours, I know that I'm probably going to lose. So I'm going to go for a jog or go take my trader nap. These things will allow you to not put yourself in that situation to begin with, and therefore probably averting disaster.
Absolutely. I mean, there's no point playing when the odds are not in your favor.
Yep.
Max, are there any final words you'd like to leave with us? Is there anything you'd like to add to anything we've discussed this far? Yeah, all yours.
Yeah, so I wanted to talk about my brand new website, madasmoney.com. A lot of people have been asking me for content, and I used to have a lot of content that was kind of scattered around on YouTube, on my blog. And I wanted to make this website. I first had this idea late last year, and I want to consolidate all of my content all into one website. So that way everyone has like a hub to kind of go to, and then they can check out my YouTube videos. And then within a couple clicks away, they can check out my blog posts. So, I'm a firm believer in giving back to the community that's given so much to me. Trading has been pretty much my life for the past 6 years, and I'm very, very thankful. And I'm somebody that comes from very humble beginnings, and I believe that giving back to the community is a very, very gracious way to kind of say thank you to what trading has done for me. And I will continue to develop new content and be on the lookout for more and more videos, more and more blog posts. Thank you everyone in the trading community for all the support. Definitely, you guys, give me that drive to just keep going. And, I'm going to give back to you guys in the form of making more and more free content via my website, madasmoney.com. Check it out.
Cool, man. And just for anyone who didn't catch that, do you just want to spell that out, how Mad As Money is spelled?
Yes, Mad As Money is MADAZ Money, MONEY.com.
Okay, cool. Obviously, there'll be a link to that in the show notes. And Max, you're also pretty active on Twitter. What's your Twitter handle?
Yeah, so it's MADAZN and then footballer, FOOTBALLR without the E. It's character limitation there. They didn't let me put the E in there.
Oh, right. Okay. And I've got to ask you, man, where does Madaz come from?
It actually comes from that name and that Twitter name. And somebody in one of the chat rooms that I first started with trading a couple years ago just started shortening it to Madaz. And I was like, oh, that sounds kind of cool. So I just kind of just stuck.
Excellent. Well, Max, I really appreciate you coming on the podcast. Thanks very much.
Thanks a lot, Aaron. You know, I want to say I've actually never been interviewed before, so this was actually a pretty cool experience. I really appreciate you bringing me on.
No trouble whatsoever. Pleasure is all mine. Thank you, dude.
All right, take care, Aaron.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's up? Welcome everybody to another installment of your favorite traders' favorite podcast, Chat with Traders. I'm kidding, people, just having a laugh, but welcome nonetheless. With me on this episode 125 is Matthew Hoyle. Matthew was once a trader, or more specifically, an options market maker. And he started at a very young age on the exchange floor in Amsterdam. But since 2003, he's been in the headhunting, or otherwise known as recruiting business. His firm is Matthew Hoyle Financial Markets. So what he does is he finds the best candidates for hard-to-fill roles. He's contracted by banks, hedge funds, and all sorts of trading firms. For example, just to name a few, Tibra, Optiva, Tower Research, Citadel, Millennium Partners, amongst many others. Needless to say, Matthew's super knowledgeable on the industry and he's won many awards for doing what he does. During this episode, we get talking about tips for getting hired, the skills which are most in demand and what firms are looking for, also how firms attempt to attract and retain talent, various compensation structures, and everything in between. Let's jump right to the meat of this episode. Coming to you from Hong Kong, here is Matthew Hoyle.
American rule of law and all that. I mean, it's good.
Good stuff, man. Well, if you don't mind, bring us up to speed on your days prior to being a recruiter. What's your background?
My background, I actually started as the youngest options market maker in the history of the exchange in Amsterdam. So this is back in the days when it was open outcry trading, so the stripy jackets, and we were all standing around on the trading floor. So I went to school in the Netherlands, and I did secondary school, something which was called gymnasium, which is basically the highest level of secondary school that you can do. So that includes ancient Greek and Latin. Then at age 18, I got a double offer to go to LSE, but because I started trading options at the age of 13 and had done rather well, I figured it might be a better idea to go and work on the exchange, much to the disappointment of my parents and my teachers. And lo and behold, I got a job offer, so I took it. That was a lot of fun. Did that for 6 years. Was there when 9/11 happened. All kinds of stuff. You know, it was definitely a very formative time of my life. I also got to work with the founders of very well-known firms like Optiva and IMC and Flow Traders. All those guys were on the trading floor with us. The founder of Capstone, for example, Paul Britton, he'd come over from London. And Duncan Valentine is one of the partners there. All those guys. So it was a very, very interesting time. The exchange went electronic in 2003. Of course, I didn't have a university degree because I insisted to go and work there and be the youngest. So I had the choice to either go back to university and study, or go to Chicago and continue doing open outcry trading. I didn't think that was a good idea because it was clear that it was a sunset industry, or do something else entirely, and it wound up being the latter. So that's how I wound up in recruitment, actually, by accident.
Okay. And did I hear you correctly? Did you say Duncan Valentine? Isn't he one of the dragons on Dragon's Den?
That's a different Duncan Valentine.
Okay.
The Duncan Valentine I'm talking about is the global head of marketing and capital raising for Capstone.
Right. I was going to say, I didn't think he was a trader.
I think, well, I'm sure he does trade something, but it's not the things that we trade, no.
Yeah, exactly. And you made an interesting point. You said that it was quite a disappointing decision for you to go and trade on the floor. Like your parents and your teachers were disappointed with that decision of yours. How come? Was being a trader sort of looked down upon in some ways?
No, quite frankly, it really wouldn't have mattered what I'd gone off and done. The disappointment had everything to do with the fact that I had been offered 2 spots at a world-class university and turned them down. That's where the disappointment came from. It came from me not going to university.
Okay. So you worked 6 years on the floor as an options market maker, and then from there you became a headhunter, a recruiter. How did that come about?
I'd done quite well on the trading floor. We got paid rather a lot of money. It was sort of like the last stop of the gravy train before it closed. So I bought some real estate in the Netherlands, and after the floor closed, I took some time off to decide what to do next. So I had the offer to go to Chicago. And another guy in the same building was actually a headhunter. He was doing sales and marketing and also technology, which I to this day I still find a very odd combination. But he had been very successful, but felt that his employer wasn't paying him enough. So we went down to the pub one day, which was conveniently located opposite the apartment building. And he told me he wanted to start his own business in executive search and asked me if I wanted to help him do it. And I said, well, since I'm not doing anything else at the moment, why don't I have a look at that? And that's how I rolled into it. I mean, it was actually purely by accident. I mean, we used to get called by headhunters, even on the trading floor and back in the open outcry days, all the time. You know, we would always tell them to get lost, which in hindsight was a bit foolish. One thing I certainly would tell your listeners is that if a headhunter calls you, do listen to what they have to say. Don't just hang up the phone straight away. It's an interesting thing. If someone had told me that I would become a headhunter when I was a trader, I would have laughed, and if they'd insisted that they were serious, I would have felt insulted. Although as things turned out, I've actually done a lot better out of this than I ever did out of trading. And I certainly wasn't a bad trader. We got paid 7 figures US back then.
Wow. Okay. That's really good money, especially for however many years ago that was. So just to set the scene here, put this in your own words. I mean, I know it's pretty self-explanatory, but what is your role as a headhunter today? Like, what do you do? Like, how do you describe your job?
Okay. Our job, it's really quite straightforward. We match candidates to employers. The driving force behind that is always the employer. So we are contracted by employers, firms such as Citadel, Tower Research, Optima, IMC, Tibber, all these kinds of guys, to go and find individuals for hard to fill roles, mostly. That's very much the executive search part, which tends to be the higher end of the business. Recruitment, which is more volume driven and tend to be lower end roles, not less interesting, but roles which are perhaps more common, things like junior trader type positions, or entry level technology roles. We also do that, but that's the difference between recruitment and executive search. We do both, and then across all the different market verticals within that finance and trading sector. There's a common misconception, which is that we find people jobs. Now, we don't get paid by candidates, so we don't go around looking for jobs for people. A lot of people do seem to labor under that misapprehension, but that's certainly not the case. Now, that being said, I have been known to put people into jobs even if I didn't have the mandate and didn't get paid for it, simply because it was the right thing to do. This is a business of building long-term relationships, which need to be lasting. And you need to think about that rather than about where the next paycheck's going to come from.
Okay. And so why do these firms come to you? Why do they not deal with this sort of thing internally, like in-house?
Well, on the lower end of the spectrum, so most graduate recruitment is done in-house these days. We're also not set up to go and do the milk rounds at the universities and whatnot. So generally, we get contracted to do the more experienced hires. The reasons that they approach us are several. I mean, we sit on a database of well over 500,000 people, right, which is a lot more than all of our clients put together, which number close to about 100 in that space. We also are quite well known in the market. So what that means is that when good people become available, we're quite often the first port of call, because they know that we have a very, very good overview as to what's happening in the markets in terms of employment, who's hiring, who's not, who's expanding, who's growing into different areas. For example, if someone is an energy trader, that person might be interested in knowing which derivatives trading firms are interested in moving into the energy space, right? So they can go there and set up a desk and they might be able to get better terms. So all those kinds of things. I think also the fact that I used to be a trader does set us apart massively from the competition. I mean, there's a couple of recruitment and executive search firms out there which are run by former brokers. Now, with all due respect to the brokers, I mean, I'll never forget them calling us up, the traders, and they were simply just making things up, now, just to try and get a trade done. And unfortunately, there are also people in our industry that do that. That ranges from posting non-existing job ads to all kinds of other shenanigans. We don't do any of that. So we really pride our reputation, which we worked hard for. I think all those things contribute to why these companies choose to go with us. And the fact that we've got so many customers and have been doing this since 2003, I think, is proof that what we do works. And
what sort of trading operations do you work for? Like, who do you hire for? I know you mentioned a few names before, but what sort of trading operations are these? Like, obviously, prop firms, hedge funds. Is there anyone else that you work with as well?
Yeah. Okay. So within the hedge fund domain, we do pretty much everything, right? So this ranges from multi-strategy hedge funds, so which have a multi-manager type of approach. So think of firms like Millennium, for example, or Citadel. All sorts of firms like that globally. So this is across all strategies. So this can be from equity long short through to equity events, that type of thing, systematic type strategies, stat arb, index arbitrage, but also long-short credit, distressed debt, special situations, convertible bond arbitrage, capital structure arbitrage. Then there's CTA type strategies. It really is a very mixed sort of bag. I find that highly interesting, actually, because I really enjoy talking to different traders who trade different products and different strategies, as do all my staff, because people love talking about stuff that they're good at and that they enjoy, right? So it's always a pleasure listening to these guys. Then within the prop trading universe, there's a shrinking number of more manual prop trading firms. We don't really hire for arcades, where people bring their own money. Although a lot of arcades are actually also doing some automated type trading. I mean, if you look at certain companies like RGM Advisors, down in Texas, I mean, these guys came out of an arcade, for example. Balyasny, the hedge fund that spun out of Schonfeld, I mean, that used to be an arcade as well. So I certainly wouldn't write them off, but the PropXs of this world are certainly not our main customers. They tend to go and find their own people. So further within that proprietary trading sphere, some firms are entirely automated, or quickly going that way. Others still have a degree of manual type trading. Or maybe they use things like auto hedging, or stuff like electronic eye and whatnot. So we cover all that. That's pretty much all products. So not just equity linked or equity options, index options, that kind of stuff. It really is the whole gambit. I mean, we have clients that also trade things like crude and electricity and all sorts of other jazz. Then the last category, which you didn't mention, is the banks. Now, for the last few years, of course, the banks haven't exactly been very active in the proprietary trading universe. Now with Trump and his henchmen rolling back Dodd-Frank, I do think that there is going to be a push back into prop trading. Now that's a good thing, I suppose, because banks are generally less picky than the hedge funds and the prop trading firms. It's also a slightly different style of trading, right? And I'm still quite curious, and I think it remains to be seen how many former bank prop traders will be successful in the new sort of bank prop environment where there's less or no flow and you have less advantages. But that is also another area of interest. And then there are certain exceptions where brokers, or especially in the US, broker dealers also have some proprietary trading activities. Even Cantor trades some prop as well, which most people don't know. So that's another area that we look at. Exane, the French broker, which is owned by BNP Paribas, that's another example. Although that's not a very large part. And then another area is actually fintech type companies, firms that have come out of places like Silicon Valley, or to a lesser extent, out of some of the Beijing development areas there, where you've got firms like Google and whatnot. So some of these companies which are really technology driven and have built great technology solutions are now also branching out into the trading world. There's a fantastic company in Moscow called Artificial Intelligence Management that has 60 quants and developers, all doing machine learning, stuff like that, but they don't have any traders. So companies like that also approach us looking for people that have strategies that they can implement on their platform.
Just going back to one of the words you used, you described some prop firms as arcades. Now, I know that's a slang word and some people are probably not really understanding what you're saying there. Can you just clarify what you mean when you describe a prop firm as an arcade?
Okay. All right. Well, let's first of all start off with what is a prop firm, right? A proprietary trading firm trades its own capital. An arcade, on the other hand, they ask you to bring your own money to the table, which basically acts as a first loss type of principle, right? So if you take 100,000 Aussie dollars or US dollars of your own money to an arcade, they'll let you employ leverage, but the first $100,000 that you lose is your own, right? And you can't lose any more than that. So they're not actually taking any risk on you. They basically facilitate you, and there's also very little trading involved. So basically, they act a bit like a glorified broker.
Okay. Now, moving on a little bit, I want to talk to you about actually sort of getting a job in the industry. So, I've heard firsthand about some firms, they get like 1,000+ applications when they advertise for a certain job coming up. How do employees filter these? And I guess, I don't know how relevant this question actually is to specifically what you do, but I mean, I'm sure you're very familiar with the process. Like, how do employees filter through so many, like thousands or 1,000+ applicants? Like, how do they do that?
Well, I wish I could say otherwise, but quite often the answer is they don't, which is another reason they come to firms like ours. I mean, I think it's good for a moment just to consider why, employers receive thousands of applications. The reason this happens is that a lot of people and, job seekers are inclined to apply for the jobs they want and not the jobs that they're qualified to perform. Now, that's a surefire way to basically not get invited for an interview, right? So, I've seen people apply to every single job that we posted, right? Whether it was, it could have been toilet cleaning lady or something, right? And they would have applied to that as well as a trading job. That's not a good way to go about things. So that's one thing. So I would say that don't apply for stuff that you're not qualified for, because it's going to make everyone's life easier. Now, of course, yes, that there still are loads and loads of applications. Right now, a lot of our customers also use software to help with this process. They use tools like Greenhouse, for example. These are HR CRM type systems. Think of it a bit like Salesforce, but then for recruiting and for CVs, right? Others use platforms like Bullhorn Staffing. So these tend to manage the flow somewhat. So then basically you're talking to a computer, right? So what does the computer look at? It's going to look at education. It's going to look at grades, especially for fresh grad types of roles, right? Really hard sort of quantifiable things. We have certain customers that will only hire from certain schools, for example, right? Now, for the more experienced hires, that all goes out of the window, and then the computers have a much, much harder time interpreting experience on a CV, right? So you really need humans to look at that and make a judgment call. Now, that does become more difficult, although in practice, it's not the senior jobs which receive 1,000 applications. It's the junior ones, right? Because everyone's eager to go out and get a job and then just applies for everything.
Now, this is probably more applicable to the junior positions that come up as well. Is prior trading experience often seen as a good thing or as a disadvantage? And the reason I ask this question is because I know a guy who used to work at Hull Trading, and he was in charge of the hiring and firing there. And one of the things he said to me was that if you applied for a job and you had prior trading experience, in most cases, you'd be disregarded just because of that. They wanted people coming into their firm who had no sort of biases or no preconceptions about how to trade, so that they could sort of train them to how they wanted them to trade, if that makes sense. Can you add to that? Is there anything which you've observed whether prior trading experience is a good or potentially a disadvantage?
It's very true that a lot of our customers want to hire fresh grads. And this is not just for trading roles, right? I mean, there are certain companies such as Virtu, for example, who won't hire anyone with any experience within the financial sector. This includes technologists, which of course are also a big area not to be overlooked. That there are some good reasons for that. One of which you mentioned yourself. It's easier to train people without any preconceptions. It's more difficult to go and find out where the gaps in someone's knowledge are. It's easier just to sort of start from scratch. Now, that being said, I've always felt that it is certainly a good thing to show an interest in trading. Now, this is something else than prior trading experience within a company. right? I mean, what I love to see in a junior's sort of CV is someone who might have written a computer program to do some trading whilst at university, or who may have gone on one of these crowdsourced type of platforms like Quantopian. Quantopian is a good example of that, or Cloud Quant. That's a similar one owned by Kirshner. World Quant also have a platform like that. Or who may have competed in contests organized by Timber Hill, which was the proprietary and market making division of Interactive Brokers that's been closed now. Or DRW also organized competitions like that. So anything which is trading related that demonstrates a keen interest in trading and technology, and more specifically algorithmic trading, all of that kind of stuff is very interesting. I mean, what that can also be is maybe someone who wrote a computer program to play poker, for example, right? So prior experience and interest in are often confused, but they are very different things, right? Having prior experience trading, what I will say is this: if you can also program, that's generally going to overcome any issues which may arise because you already have experience trading, right? I mean, not all customers will accept that, but a lot of them will. So it's not the end of everything, and there are ways to counter it. I do think that whatever way you cut it, showing an interest in trading and trading automation and all these kind of things, I think that's absolutely key.
Yeah. Okay. No, that makes perfect sense. This might be a bit of a broad question, and you may have already sort of hinted at the answer already, but what skills are you noticing which are most in demand as of late?
That's a very good question, Aaron. It's a bit of a moving target, right? So back in my day, it was very strong arithmetic skills, right? This is even still apparent in the tests which companies like Optiva and IMC and Maven Securities, and Acuna, all these Optiva spin-outs and Tibra also administer. You basically have to do a hell of a lot of mental arithmetic in a short period of time, and it's not designed to actually test your ability in terms of math or anything like that, because they're not hard. It's just a lot in a short period of time. It's actually more like a stress test, So back in the day, I mean, anyone with a PhD in physics, for example, would fail that, right? Because they just weren't used to doing that. So people would need to practice it. There's some great programs out there for that, like tradertest.org, for example. This is run by a guy who works at Optiva. If you go on that and use it to practice, don't give them your CV. You should send it to us instead. So that was one thing. Then as time progressed, obviously technology skills became more and more important. And that started off with Python and the scripting languages, and C++ became more important. Java was for a short period. I mean, that's not something I would really bother with now. But I think that all these things are still relevant, right? So it becomes a little bit like a collection of things, right? So yes, you need to be able to perform under stress. You need good arithmetic and mathematics skills. You need to be able to script. You need to know some programming, ideally in C++. All that kind of stuff. I mean, VBA, MATLAB just won't cut it. But now, to make matters even more interesting and complicated, something that we get asked to look for a lot is things like statistics, and then specifically people doing machine learning, and that's now also moved on to sort of deep learning, using Bayesian methods and all that jazz. So I think that as time progresses, the demands go up and up and up, right? Trading becomes more competitive. It's harder to extract alpha, to find edge, to find opportunities. So it really is a mix of all of these things. I don't think you can say that there is any one single thing that you need. I would say that you ideally need all of them.
Now, I know a lot of the hand traders are going to be sort of a bit frustrated with that answer. So let me ask you this question. For someone who just wants to be a point and click trader, right? They have no desire to code. Are there still positions that they could be looking for if they actually wanted to get a job in the industry instead of just being an independent trader?
Well, I mean, point and click traders generally tend to go in one of three directions, right? I mean, some of them have evolved into absolutely enormous discretionary macro traders. Think Paul Tudor Jones, for example, right? So that really is taking punts on absolutely everything. It's all discretionary. I mean, that's very much a point and click game. Others became very, very large in certain products. There was a certain Swiss gentleman named Paul Rotter, for example, that a lot of the manual traders may remember. He lived in Singapore for a while. I think he just moved, actually. He's gone somewhere else now. But those guys tend to generally retire. And then there's the category that decide that they're going to go out and hire people who can code and try and translate their ideas into automated trading. Now, there's been some very, very successful examples of that happening, right? Because I have a lot of respect for manual traders who've been in the markets for a long time, because they know their markets inside out. They know those beasts and those products, like no one else does. And that's something that the quants really still can't compete with. Now, I think the trick is being able to sort of download that knowledge and finding ways to automate it, or at least partially automate it. Although I think in practice, a lot of manual traders do some automated spreading and all kinds of stuff like that. So that is also another path to go. So that's generally what I see in the market. Does that answer the question?
It does, yeah. And are you seeing these things just because of the sort of firms that you work with? You typically tend to lean towards working with more quant-driven firms and different operations, or do you think that's just a generalization of the entire sort of spectrum?
No, I think that the whole industry is shifting more and more towards automation. I mean, the explosion of algo trading in countries like India and China has been very noticeable, right? So I think that for people doing purely manual trading, unless they're absolutely huge, so think running several $1 billion sort of classic hedge fund kind of style, I think that the market is becoming increasingly difficult unless they have some sort of special edge, right? I mean, think like that guy in Japan, for example, that nobody knows who he is but makes hundreds of millions of bucks. I mean, that kind of stuff. Well, when I speak to very experienced manual traders, the arcade types of guys, I mean, so some of these are guys that I used to work with, right? Who used to be options market makers. I mean, very, very bright guys, and they decided to go down that route. It seems that every year they make a bit less money. And I ask them why that is, and they say, well, it just becomes tougher, And then, of course, that there are outlier years like 2008 when everyone makes a killing, right? Or 2015 in China. But I think it's fair to say that in general, that type of trading and business is going to become more and more difficult.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
So let's say a junior position or someone looking for a junior role. I know that's not your specialty, but is looking to go into a quantitative prop firm. What are some of the common roles that are out there? Because I know there's many different roles that someone can go into. Someone's not just an algo developer. There's many pieces in the machine that kind of make the firm operate. Like, what are some of the sort of roles that a junior might be able to look for?
Well, it depends what you want to do, really, right? And I would preface the answer by saying that certain companies have a very strict segregation between technology and trading, such as Optiva, for example. So if you get hired within the technology division as either doing IT infrastructure or software development, you won't be able to transition into trading later. Other companies do allow that. IMC is an example of that, for example. So those are things that I would consider. Now, most of the large companies do have what essentially amounts to a traineeship, right? Either within technology or trading, regardless of whether or not they do allow that crossover. So those are certainly things that I would look at. They tend to be the companies that find their origins in Europe. Some of the big US companies take a somewhat different approach, right? So the ones who are less into the options markets but more into Delta One type products. So think Virtu, for example. So they say that absolutely everyone, regardless of what degree they've got, right? If it's a bachelor's, a master's, or a PhD, has to start completely at the bottom and basically starts in administration because they really need to understand how the system works all the way through, right? I mean, a company like Virtu has a hard cap of 150 employees globally, which is quite incredible considering that they make nearly as much money as some companies that have 5 times that many employees, right? So, that's a different type of approach, a more integrated one. There's various options. I think that it really kind of depends what environment you want to be in, and I sort of alluded to that by talking about the differences between several firms, right? I mean, it really is. It's a difficult thing because coming straight out of university, and looking at these junior types of roles, I mean, obviously most students wouldn't know the differences between all these firms, but the differences are very, very significant. I mean, consider this. Most of these companies have grown incredibly quickly. So a lot of them have struggled to really find a corporate identity and a clear corporate culture. So these things tend to be a little bit in flux, and then when that does start to form, I mean, they really do evolve in very, very different ways from each other.
Yeah. Now, you use the phrase coming straight out of university. What if someone hasn't come out of university? What's their chances of actually getting a position at one of these firms we're kind of describing here? Is that one of the ways that employees or potential employees actually filter applicants?
It is, but only to an extent, right? So someone who has spent 2 years training to be an actuary, for example, could still be highly suited for a junior trading type of role, one of these large firms, right? Someone who has spent the last 2 years doing sales and marketing might be less suited unless it's for the wholesale desk at a place like Optiva, for example, and they speak 10 different languages. So I think that it really depends on what the candidate in question has done with their time. I think that that's a very important thing. And then the second most important thing, it's going to come back down to also that interest in trading. I mean, what is the motivation? And if someone asks you in an interview, why do you want to get into the industry? The correct answer is not, I want to get rich quick. You might, but that shouldn't be the driving force. So I think a big part of it will depend on what someone's been doing with their time. Now, that being said, these things do have a limited type of shelf life. I think after 3 years, it does become a lot more difficult, right? So basically, I mean, you've got 3 years out of school to go and figure out if you want to go in the trading direction or not. And then if you do, you should have been doing something which at least has some sort of relevance, right? I mean, it doesn't need to be relevant to trading, but utilizes some type of transferable skill, right? This is something that we look at a lot, transferable skills. So, things that people do in other industries or technologies that can maybe be applied to the trading world.
And do you find, just while we're talking about sort of coming out of university and that sort of thing, do you find that as someone might get older, it does really become much more difficult for them to land a position inside one of these firms?
Yes. Within technology, not so. We get asked for technologists all the time, right? And that there's such a big shortage of senior C++ developers and whatnot that, we'll gladly take someone who's got 15 years of experience as long as they're good at C++ outside of the financial industry, right? So that's a very clear sort of difference. The same goes for very heavyweight quants. I mean, some really big quant funds like PDT Partners or Renaissance Technologies, Rentech, but also Citadel, and Two Sigma, AQR. They will take academics as well, right? I mean, they don't want people that have actually worked anywhere outside of university, right? But it's not unusual for them to hire a 45-year-old professor. So that's another area. Within trading, if you've spent, say, 5 years in an arcade doing purely manual type trading, then I think going to one of these firms and getting hired as a junior trader is going to be difficult, right? A better avenue to pursue might be to look at an execution type of role within maybe a hedge fund. Right, so basically managing the hedge funds flow to the streets and stuff like that. I mean, that can be an awful lot of fun. And some hedge funds also allow for small sort of side pockets, carve-outs, books, where the execution guys can also trade at their own discretion, right? Now, of course, these aren't the hundreds of millions that the PMs generally play around with and manage, but a place like Millennium, it's not unusual for them to give the central dealing desk, a $5 or $10 million carve out that they can put their own trades on, for example.
So for the most part, our conversation sort of revolved around how the would-be employee can get inside one of these firms. Let's talk about it from the other angle. So, what do these firms do in an attempt to try and attract the best talent that they can and also keep that talent once they have them?
Oh gosh, pretty much everything you could think of under the sun, right? Something the Americans are huge on is that employees should not be allowed to pay for any food, right? So they have these massively stocked fridges, right? I always find that's somewhat overkill. All these kind of perks, right? I mean, I've seen absolutely everything. I mean, DRW does yoga classes, wine tastings. Other firms take people to museums. Days out on the town, holidays, all this kind of stuff. I mean, it's all nice, but the thing that drives most people when they get some experience ultimately is going to be fair compensation. Companies like Tower Research and AlphaGraph and Jump Trading, I mean, they all pay formulas, right? Big sort of international trading companies, the Optivas of this world, they pay discretionary bonuses. So that is a big difference. I find that the really successful traders would much rather have a clear-cut, cast an iron formula of their trading profits than all the other perks on the side, right? That being said, I mean, those perks are nice. I mean, another very popular one that I've seen recently is the paternity leave, right? So you as the father get to take a month or two off, spend with your newborn. I think there was one company that was even doing that. If you got a new dog, you get a month off to go and spend with your dog, all this kind of stuff. So it's a long and varied list of things to entice people. But the companies that do it best are the ones that pay the best, right? I mean, if you look at a fund like Rentec, which has basically the best performing hedge fund in the world, which is only open to the staff, right? They have pretty much zero staff turnover there. If someone leaves, it's because they retire. So I think ultimately hiring people, enticing them to join is one thing, and the sort of cool perks can play a big role there. But keeping them, you really do have to pay them.
Yeah, and how much does the salary and the compensation structures, how much does that vary between place to place? Like for an equal kind of role, a comparable role at across the board, does the pay vary greatly, or is it fairly well balanced?
Okay, so I mean, pay is generally composed out of fixed pay, right? The base salary. These tend to be similar in various geographies, right? So there can be quite big differences globally. I mean, there was a time when down in Australia, people were getting 100,000 Aussie dollars, and the Aussie and the US were nearly one-on-one, whereas the starting salary in the US would have been 60, right? So, generally within the same sort of regions, so Chicago is going to be a little bit lower than say, New York or San Francisco or Austin, Texas, for example. I mean, those are generally the four sort of hubs in the US. London used to be quite competitive, but now post-Brexit, of course, the pound versus the US a little bit lower. Continental Europe, in particular, Amsterdam is probably not very competitive. Neither is Germany. Switzerland gets a bit better. So does Paris. Hong Kong, it all tends to be quite similar. Singapore as well, Sydney as well, Tokyo as well. So that's the base element. Now then the variable part, right, which of course is the juicy bit that everyone is is always chomping at the bit to know about. This really depends the type of platform and setup that you've joined, right? So it's either a company, a large company that has a discretionary sort of bonus model, right? So these tend to be the big option market makers. So think Optima, IMC, Tibra, former Timberhill, but also Volant Trading, CTC, Wolverine, Peak Six, all these kind of guys, right? They all have that discretionary sort of element. Other companies which have a team-based structure, so Jump, Tower, AlphaGrep, and a whole host of other ones, that's a different kettle of fish, because the team lead or leads have a deal with the company for a certain payout, and then they distribute that within the team. So there's generally more direction, right? And quite often team members will also get a percentage written into the contract, right? So, I mean, that might be 10% or 15% or, so there can be big variation. Now, the advantage, of course, in being in a big firm with a discretionary sort of model is that when they have an absolutely knockout year like 2008, everyone gets paid a massive amount of money, right? That's really great if you're a sort of average kind of guy, because then you'll get a lot more than you might have deserved. But some of the top performers might wind up getting a bit less, in an average sort of year. So they would have done a lot better at a place which does have a more structured type of payout.
When you talk about a discretionary payout, a discretionary model, can you just explain sort of what that means a little more?
Okay. I'll give you an example of Optiva, right? So the way Optiva is structured is a third of all the P&L after costs is attributable to staff bonuses, and 2/3 is attributable to the shareholders, right? So if you want to make a lot of money in a place like that, you really need to be a shareholder. Now, that third, it's basically the management who decides who gets what. Now, there's a lot of factors that go into deciding that, right? Trading performance, but also performance within the team. How helpful have you been? Have you contributed to projects? But also, do you show up to work on time? Are you a pleasant guy to work with? I mean, all this kind of stuff, right? So discretionary, basically it means that you're going to find out what it is at the end of the year. And, depending on where you are, there could be a significant political element to that as well, right? Whereas if it's a percentage payout, which is contractually agreed, incidentally, most hedge funds also have percentage payouts, right? I mean, that's also an interesting thing to note. Then you're going to know pretty much exactly what you're going to get. Right. So the discretionary payout is something which, of course, has been long favored by the banks as well.
Okay, cool. Yeah, I think that makes things a little clearer. That's good. So just looking forward now, to the future, a few questions around that. I guess the first one would be, are there any roles which you used to hire for, which pretty much no longer exist?
Good question. I think that a lot of roles evolved over time. Believe it or not, that we do even still hire open outcry trading roles, right? I mean, ultimately, big companies like IMC and Optima and CTC, I mean, they do need people in the trading pits as long as they're open in Chicago, right? Of course, these are a lot less common, but it's not the case that they've vanished entirely. No, I think that if you take into consideration that certain positions may have evolved slightly or significantly over time, I don't think it's the case that certain jobs have completely disappeared. Yeah, just in general, right? I mean, if you take some very specific things like prop trading within the banks, of course, I mean that did completely disappear for a while, right?
And have you seen the amount of hiring decrease at all? Like, as automation increases, has the amount of hiring decreased in any way? Or, maybe even if it's not due to automation, is there another factor which affects the amount of hiring that takes place?
Yes, I've always associated hiring more with volumes traded rather than the extent of automation. I mean, Virtu has a hard cap of 150 employees globally, right? So that's going to be very interesting to see what they do with KCG that have about 1,000. I mean, that's probably going to be a massive amount of layoffs, but that's a more unusual type of approach. What I tend to see is that hiring is driven very much by volumes first and then volatility second, right? So when volatility is high, everyone's looking for traders to take advantage of it. When volatility is low, everyone's looking for tech guys to basically try and slit each other's throats with speed and latency, and the latest microwave and radio frequencies and all that jazz. So technology war sort of rages. And then when things are quiet and people find it more difficult to make money, so when vol is low, so volatility and volumes are low, that's generally the kiss of death, right? So people start to downsize. I mean, that typically happens after a big market move. I mean, I'm sure that all your listeners have seen many times that, after a market tanks and crashes, and then the volatility goes away, the volumes go away because everyone's lost all their money, and it just sort of lies down there, right? And then, everyone sits around waiting for the next bull market to sort of happen. That's very much a situation where I would rather expect layoffs than anything else. Now, that's within the hedge fund and the prop trading world. Now, within the bank world, yes, increasing automation has led to less hiring and will continue to. The reason for that is that, quite frankly, the banks are nowhere near as nimble or sophisticated as all the prop trading firms and the hedge funds. So, these guys are way overstaffed still, and that there's a lot of dead wood that can still be cut. I foresee that will continue going forward. I mean, especially with new technologies like blockchain, that might be able to replace things like syndication, and maybe even entire exchanges, dark pools and all that kind of stuff. So, I think that that within the banks, who are also under immense pressure to continue to cut costs by the shareholders, because they're all public companies, it's much less a factor of volatility or volumes, right? They're going to be cutting costs no matter what, right? If they have a knockout year, they'll say thank you very much, that was great, but we're still going to try and squeeze every last penny we can out of it.
Further moving forward, do you have any predictions for how hiring might change? I asked you earlier what sort of skills are most in demand right now, and you said, well, it's a constant moving target. Do you have any predictions for how hiring might change moving forward and any further developments in the industry?
I think that machine learning and artificial intelligence is more than just a flavor of the month sort of thing. I think that you are going to see an increasing shift there. Now, obviously, I understand that not everyone is going to go and study that, and they shouldn't, right? But I do think that there's going to be increasing demand there. One thing which is always going to be in demand is people who are good problem solvers, right? Nobody's really interested in hiring a trader that has one strategy. I mean, I want to hire traders that have a track record of reinventing the wheel and coming up with new strategies. As markets become more competitive, the shelf life of trading strategies becomes shorter. So what you want is someone who has the ability to and the energy to go out there and look for new and cool and interesting stuff, and put it all together and make it happen. Not someone who has a strategy that makes a lot of money, but then when it stops working, sits around thinking, damn, what now, Sherlock, right? So I think that's quite an important thing. Other things which I think will be more in demand. This might sound a little odd. I think people who have a sort of keen sense of business development. One thing which I see lacking is the sort of natural wanderlust, and desire to explore. Right. I mean, I wish I saw more people come along and say, hey, I've been trading this market, it works really well, but I want to try and apply it to different markets. And, or I heard that there's some funky stuff going on down in Mexico, right? Because Trump's rattling the sabers, and, can we go and trade that, and apply our algos there? And, all this kind of stuff, or can we move into new products, what's going on in China? I think that's also becoming more and more of an increasingly important thing. Now, the reason for that is that being competitive technology-wise, to do that on a global scale has become pretty much impossible, right? There is a reason that Jump and KCG, combined forces to share microwave networks, and that IMC has now invested in the McKay brothers, and so is Tower, and you just can't really do it on your own. So what I'm seeing is a trend where companies will invest selectively for specific trades in specific markets. So, the way things have been going is that it's actually become more fragmented. So you have different companies, all different companies are fastest in different markets, right? So where I see the advantages for people is if you can basically take, your IP and your ideas and all that stuff, and then port it into new markets, figure out if it works, and then make the relevant investment just in that market. I mean, you don't need to have global colo, right? I mean, it only needs to be in the markets where you want to be competitive, right? That's where you want to have colo and have a microwave connection if possible. So that sort of desire to explore, I think is certainly something which I would like to see more of.
I think that's really cool to get your insight on that. Just to take us out here, is there any, I guess, final words, final bits of wisdom you'd like to pass on? Anything that might be helpful for particularly people trying to get into junior roles? Is there anything you'd like to share which might be helpful for them?
Demonstrate passion. Think carefully about answers that you give. Don't say negative things about teachers or former employers, stuff like that. It's all pretty basic, It's think before you act. And at the end of the day, people will hire you because they think that you're going to be successful and make them an awful lot of money, right? But they don't necessarily want to hear that you want to be a millionaire before the age of 30, and that's why they should hire you. Yeah, it's nothing really out of the ordinary, I suppose. And I would think that all of this is really rather obvious, although you'd be surprised. I mean, the sort of answers that people give in interviews. And at the end of the day, I mean, just be yourself, but I think one thing that I would really recommend, if possible, do mock interviews, right? I mean, so many people lose out on jobs just because they perform poorly in interviews, and also on tests, right? Be it arithmetic tests or programming tests. Interviewing is the same thing. Practice makes perfect, right? And there's no shame in not doing a good interview if it's the first one you've ever done, right? Because you haven't had any practice.
What do you mean by doing mock interviews? Like, what's an example of that? How can you do a mock interview?
Look up a bunch of interview questions on Glassdoor. Get one of your mates to basically pretend to be the interviewer, tell them to be devil's advocate, and just go through the motions. Yeah,
right. Now, that's really good advice. Really sound advice, Matthew. If anyone listening to this wants to find out a bit more about yourself and what you do, where is the best place they should go to?
Our website is matthewhoyle.com. That's MATTHEWHOYLE.com. That's probably the best place to go. You can basically just leave a message on the website. I'm also happy for people to email me directly. My email is very straightforward. It's matthew.hoyle@matthewhoyle.com. So matthew.hoyle@matthewhoyle.com. And then we can take it from there. I mean, there's a whole bunch of us here in the office, so there's a lot of people looking to fill a lot of positions. So we're always happy to hear from people.
Very good. Well, I appreciate you coming on, Matthew. This has been hugely interesting for me. I mean, we've covered a lot of new ground that we've not previously talked about on the podcast. So I've thoroughly enjoyed it, man. Thank you very much.
Likewise, Aaron. I certainly enjoyed it myself as well. Thank you very much for inviting me. And I wish you all the best. It's a great show that you're doing. Thanks a lot.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Welcome, everybody. Hope you are doing fantastic. Aaron Fifield here, and featuring on this episode is Neil Sloan. Though not a trader herself, Neil has been in and around markets and exchanges for roughly 30 years, mostly working in roles that assisted commodity traders and brokers in one way or another. And since 2006, Neil has been the principal of Capital Trading Group, a Chicago investment firm which she co-founded with Patrick Lafferty. And this is the reason why I asked Neil to come on the podcast, because the role of CTG, or Capital Trading Group, is to support traders who wish to expand their operation by managing money for others as a CTA business. Now, CTA, of course, is the abbreviation for Commodity Trading Advisor. CTG do also offer services to professional and individual investors to help them navigate managed futures. But for this episode, we focus on what does it mean to be a CTA, the incentives to become a CTA and where to begin, fee structures, the requirements and regulations, how to attract capital from investors, and other related subjects. I think this episode will be really helpful to some, and to others it might simply be interesting. Either way, I hope you get something out of this. Please welcome my guest, Neil Sloan. Now, from what I know about you, you entered the field of trading around about 30 years ago. How did this happen, and where did you start out?
Well, 30 years ago, the world was different than what it is today. So I was right place, right time, right work ethics. I would always be, shall I say, babysitting the family of the wealthy. So I was fortunate growing up in the Gold Coast of Chicago, babysitting for very well-off families, one of which who was a reputable stockbroker at the time. I was inspired and intrigued by what he was doing. So at a very young age of, say, 16, I wanted to learn more because I was fascinated by all the books and so forth he had in his house and so forth. So from there, I got a position at a commodity firm. And, CTAs were not, commodity trading advisors, managed futures was not as pronounced back then as it is today. But I would serve the brokers. I would provide a lot of the admin work and checking out trades and so forth, because we had open outcry back then. And I would chart manually with the high and the low and the close and the opening on a chart book that was called Commodity Perspective. I'm really aging myself here. But everything was done manually. And I just loved the business. It was exciting. It was you're learning every day. It was not a typical 9-to-5 job. It was invigorating because you're learning constantly. And I loved the markets. So I wasn't a trader, but I was more one who was involved in the service capacity of providing those that did trade, removing less of their to-do responsibilities so they could just focus on the markets.
Okay. And how long did you do that for?
Oh, geez. Many years. I mean, I didn't become a business owner of a brokerage firm until approximately 2006. So I always served, really what I consider to be pretty good brokers. They were in the industry for a long time, and they found it advantageous to have somebody handle all the admin work for them and serve clients so that they could focus on the trading.
So, I mean, that kind of makes sense why you started Capital Trading Group then. When did you found this company?
In 2006.
Okay, in 2006. Right now, well, I'd really like to talk to you about the CTA landscape, what it means to be a CTA, and sort of everything that surrounds it. So let's just start with the very basics. What is a CTA?
It stands for Commodity Trading Advisor. So it's somebody who's willing to handle the professional aspect of managing outside money. So they fall under the regulatory environment. They're much more scrutinized on what they're doing and how they're doing it and how they market themselves and so forth. But it's when people want to take it to the next level.
Okay, so what's the difference between a CTA and a hedge fund?
Primarily, it has to do with regulation. Hedge funds are lightly regulated. Commodity trading advisors are not. While there are different elements of how regulated they might be, for example, if you are a commodity trading advisor and you want to narrow in on who your clients will be based on suitability, and you want your clients to be what's called QEP, they have to have a much higher net worth, not necessarily risk appetite, but just have to be much more financially qualified to participate. So they have regulations, certainly, that needs to be attended to, but not to the same degree as somebody who's taking clients that are not accredited or not QEP. There's a much greater degree of cost and oversight when you are handling clients that are categorized more in the retail sector, so to speak.
So why would someone want to start a CTA over a hedge fund, whereas a hedge fund is less regulated? Wouldn't that be more appealing for a trader to start a hedge fund rather than a CTA?
I think it depends on the audience that you're targeting. You know, a lot of times hedge funds terminology is the markets that they're trading outside of just the regulatory part of it. So if they want to start a CTA, they first have to define their style of trading, what they're doing, and how much they need under management for each individual investor to meet the risk-adjusted returns that they may be targeting. That alone will probably dictate the type of client that they're targeting. So if they're already targeting a higher end investor anyway, they can pick, based on that alone, what they need to do within the regulatory guidelines, and also who's going to be raising the money for them. What their distribution arm is should also dictate the direction that they want to take.
Are the fee structures somewhat similar between CTAs and hedge funds? Like, it's commonly known that hedge funds charge their 2 and 20. Is that quite similar in the CTA space also?
Yes, it is. Although I will say that what we're experiencing, of course, is fee compression. I think investors are demanding more for less. They want to be able to tap into the talent of traders, but they're also dealing in a very highly competitive environment. And while the cost of trading in terms of electronic trading over open outcry has been complementary, on the CTA space, the traders themselves are still paying for quotes, which you don't really have in the security space. So I think what you're going to see over the next, and it's probably going to evolve sooner than that in the next 3 years, I think you're going to see the fee compression go down even further, and maybe possibly even see a 1%, 1 in 15 might be the average than 2 and 20 today.
And how do you think that's going to affect CTAs themselves? Like, does that potentially mean this is going to become less lucrative for them?
I think they have to approach it in a more serious fashion than just thinking that they have great returns and investors will follow. I think investors have to find you. I think you have to have an infrastructure. I think you have to be able to, like any business, be able to stand the test of time with a lower fee model, entice people to want to do business with you because you have your own skin in the game, but are also willing to charge less, maybe below the average, to capture more. It's the world we're in today. Same thing with mutual funds and why the ETF space has been so strong, because it's so attractive on the fee component. But then again, you're talking about tactical strategies versus, passive anyway.
So when you talk about, in the next 3 years, it's possible that we might see some CTAs charging 1 in 15. Do you think that, maybe in the next 10 years that trend's going to continue and fees are going to come down even lower?
Well, there's a point where it's no longer viable when you take away, the profitability. I guess case in point is like the Futures Commission merchants once depended pretty heavily on interest, or as they call them, the float on the assets of customer seg money. It was a big profit margin for those firms. And as you know, interest rates have been nearly flat for many years. As a result, they're no longer as profitable. So what one has to look at is recognize that the path to least resistance right now has been on the clients' fronts. They're demanding more for less. and you have to be willing to give more for less and do more. And then at that point, what can you do to cover your cost as far as finding firms like our firm that might be willing to provide the infrastructure that they're lacking, so they're not just a single man or a single woman shop in trading. But I think it's the path. I think that's where they're going.
Yeah, I mean, that'll be interesting to see how that plays out and affects things. Are there various types of CTAs? Can you talk to us a little bit about that?
The majority of the commodity trading advisory space is comprised of trend following strategists. So you have various styles of trading, various markets traded, various risk-adjusted returns, and various requirements on the type of investors that they're seeking that they want to manage assets for. So we all have a different risk appetite. We all have a different financial obligation to family or whatever the case may be. Investors have to know themselves enough to know, well, I'm willing to risk, say, $100,000 in a portfolio that might have $2 million in it, but I'm only going to give $100,000 to a CTA in efforts to hopefully smooth out my volatility in my portfolio. So there's many choices, and our role will be to better understand the investor, to match them with choices that they have. And there's thousands of choices, but then when you narrow down what the investors are seeking, you might be left with a handful of traders. But you have trend traders, you have global macro traders, you have option strategists, option premium writers, you have spread traders, seasonal traders. Majority, though, have been trends. And the new emerging managers are coming out with more unique styles, which is attractive, too, because the environment's been very challenging.
Right. So let's dig into that a little further. I've got a few questions around this. So why are trend following strategies like the dominant strategy amongst CTAs? Like, why is that so popular?
It's probably pronounced because when the CTA space became more acquainted with managing outside money to the level that being a CTA is, it could be starting back from, if you've ever heard of the Turtles. Richard Dennis was one of the founders of a program where he would have a want ad in the paper, so to speak, looking for traders that he could teach and educate and then give them X amount of dollars in which they could manage assets. And from there, the managed future space kind of took off. Not to say that there weren't other registered entities that were managing outside money, but I think the Turtles kind of put that on the wall, so to speak. And trend trading was just more systematic. We had more of the core commodities that people could trade, the meats and the grains. I mean, earlier on, we didn't have all the different components that we have now on which to trade. S&P 500, the bonds and so forth, as the financials became and opened up, the window just opened up more to various ways in which to trade. But trend trading was just something that many found it easier to comprehend. And then I want to say the last probably 10 years, options, as you know, options didn't come around until the latter part of the 80s, and they were so much more complex for people to understand. So only into the last, I want to say 10 years, did we see more strategies surrounding options on futures contracts.
Okay, so just so I understand this correctly, traders who operate on a very short time frame, so perhaps even intraday traders, day traders, there's nothing stopping them from becoming CTAs, like there are investors out there who are looking for CTAs who trade those very active sort of strategies also?
If people are managing their own assets and they feel that they have the capacity to manage outside money as well, professionally speaking, and to establish a business front in which to do so, they can do so. They could go short term, they could go long term. At the end of the day, it's about being able to generate alpha. It's about being able to generate and justify the risks associated with the potential to make money on what they're doing. And why would investors want to, give you the discretionary authority to manage their assets? Then you want to be able to prove credibility. And while the past doesn't necessarily dictate the future, you usually want to have your own skin in the game and you have your own method in which to control that risk so that people might be confident and comfortable in what you're doing for yourself they might be willing to let you do for them.
Now, just going back to when we were talking about the trend following strategies, I think you said options trading strategies were becoming more increasingly popular in the CTA space. Do you think trend following strategies are going to become less popular in the CTA space also?
I think people are seeking ways to make money. And while I'm not a trader myself, this so-called Fed engineered rally ever since 2008, the behavior of the markets have altered. The other thing that's altered the behavior of the markets has been the removal of the open outcry. As we become much more electronically traded, things became easier in which to trade. I think these long-term sustainable trends have been challenged because of that.
Okay. And in the current state that we're in, do you think there's enough variation amongst the types of strategies that are available to investors?
I think there should be a lot more. I think that the only reason that we're seeing an increase in new managed futures within option strategists is because the trend traders overall haven't been able to perform as well as we would like to see them perform in prior, pre-08 or 2009 scenarios. And I think that when they're seeking consistent returns, the options strategists have been able to perform pretty well because it's dictated on most often time decay. And while they're susceptible to different market conditions and trend traders that leave them stressed, for example, gap market movements, outlier events, crisis-like events can be more challenging in option strategies. But a lot of the investors that I deal with are comfortable with that as long as they could pick a manager that has been tested during crisis-like conditions like 08 or during where we had a flash crash condition, and then they take a look at the recovery time for that. They'll be comfortable, they're fine with taking risk funds to allocate to that manager.
Sure, okay. And are CTAs confined to trading just futures and options, or can they also trade other things like equities and currencies? Is that a possibility?
Yeah, as long as they're traded on an exchange, like the Chicago Mercantile Exchange, for example, as long as they're traded on an exchange and they have transparency and liquidity and they're not restricted to serious capacity restraints and so forth, absolutely. It's just they're not trading on this, the Chicago Board of Options Exchange contracts. They're not traded to actual individual stocks. Now you're dealing in a whole nother regulatory oversight.
Sorry, can you just repeat that last bit? You can't deal in individual stocks?
Correct. So the commodity trading advisors basically are trading commodities themselves. So they might trade the S&P 500, they might trade the futures, they might trade the options on futures, but they're generally futures contracts that they're trading. They're not trading individual stocks. They can trade the index, the S&P 500 index. They could trade the dollar index, but they're not trading IBM. They're not trading Apple.
And what's the reason for that?
It's a whole different regulatory oversight. So in the commodity world, we have the CFTC, Commodity Futures Trading Commission, and the NFA, National Futures Association, that is our oversight. And they come in and audit, et cetera, and monitor. And then you have to be members and registered with the CFTC and so forth. With the hedge fund world, you're dealing, and again, it depends on the level of your business. You might be dealing in the, with the SEC and so forth and FINRA.
So I guess that could be another one of the differences between a CTA and a hedge fund, is a hedge fund can typically trade individual stocks, correct?
Correct.
Okay. Well, Neil, let's shift this conversation to talk more specifically about starting a CTA. So I guess the first question I'd ask around that is, why would someone want to become a CTA? Like, what are the benefits to the trader?
Well, it's a whole different world from trading your own money versus trading outside money. So if you're a CTA, you're typically meant to manage outside funds. And through doing so, you're able to monetize the relationship of those that you have discretionary authority over. For example, we talked earlier about the fees. So if you're charging 2 and 20, you can now do for yourself, you can do for others. And now you can take on a 2% management fee. So if you have a $100,000 investment, you could charge 2% over a year's period of time. And that would be additional source of revenue for you. And the same on the 20%, which is your 20% performance fee, but you're only going to be charging a performance fee if you're performing. And you can achieve a higher ground every quarter, so that all you're really doing is you're structuring what you do for yourself, if you are doing this for yourself, and you're leveraging that by doing so for other parties in a discretionary aspect, and also getting paid in which to do so.
And when would it make sense for a trader to consider becoming a CTA? Like, at what point of their career would it be a smart move?
I would say when a person has been trading their own funds for, say, 3 years and has what they believe to be an attractive track record to present, might be the time window in which to take a look at it to the next level. Because after 3 years, you would have enough history to be able to generate risk-adjusted returns. And while you are still categorized as an emerging manager, you've at least been tested with your own funds. And assuming you want to replicate that and duplicate what you've done for yourself, then you could take it to the next level and register as a CTA.
And in regard to the track record, would that have to be based on a certain amount of capital to be, considered a respectable track record? Like, if someone started with a $10,000 account and they traded that over 3 years, like, is that enough to be worthy of consideration?
Probably not, because the majority of CTAs have a much higher minimum requirement. They typically have, say, 100,000 that they will require to have under their umbrella. There are CTAs that have lower dollar denominations. The one I could think of is 15,000 is the minimum, but on average, they're much higher. Unless they put together some kind of a limited partnership, like a fund structure. But CTAs that are accepting accounts on an individual basis, so those clients can open up as a single managed account versus a fund, usually have a higher minimum requirement.
Yeah, no, I was more referring to the actual track record that someone puts together before they actually form a CTA themselves. So
I follow you. So if someone's trading their own account and they've had success in doing so with dollars as low as 10,000, then yes, they can approach that and utilize that same dollar amount and offer that same amount to create a track record and put together a disclosure document and offer other investors to invest that small dollar amount. It's just a challenging dollar amount is why I say that. But if they've done well with that, by all means, they can attempt to duplicate that for others as well.
Well, let's say they've grown this $10,000 account to $20,000 over the space of 3 years. Can they then ask investors after forming a CTA for investment of, a minimum $100,000 each? Is that how it works?
No, they can ask for the same amount. So, or he could ask for, say, 20,000. The key thing is to have the dollar amount dictated on the amount that he could manage, where the risk-adjusted returns is justified to the outside investor to even considering the program.
So what are the first steps to starting a CTA? Like, where would you even begin?
Well, I think if they have, let's take 3 years of data, so their monthly statements, they could forward on to us, and we could put together the 13-row performance capsules and pro forma that, so we get an idea of what that track record would look like using real money that he's already established, but also taking into account what an investor, should they have invested with him at inception, what it would look like after the fees are taken out. And then we would connect them with an attorney to put together the disclosure document, or not necessarily an attorney, but like one of our compliance personnel to help to get together with them. After they compile the track record, they can get the disclosure document, which will then disclose to the potential investor the background of the trader and verify if they've had any negative scenarios, legal issues that they've had and so forth in relation to their background, things of that nature. We would then connect them with our capital sources, and we would get everything lined up for the trading platform that they're comfortable to use, the clearing firm that they're comfortable to use, get them there's a whole checklist of what we have: reporting requirements, back office requirements, disaster recovery procedures. Now, it sounds like a nightmare, but it is a long laundry list of things that have to take place. But we would walk them through that of what they need so that they can do the business and start off on the right foot. And then we would work on getting them exposure, introducing them to other parties that allocate assets.
Right. And how long is that process? Like from the moment someone decides I want to be a CTA, and let's say they come to someone like yourself or whoever that may be, how long until they're pretty much up and running and open for investment? Is that like 6 months or what's the time frame?
Well, much of it is dictated. Well, to get the disclosure document approved by the NFA and so forth, it typically takes about 60 days. And of course, a lot is dependent on the trader getting back with questions that are typically coming back and forth. So about 60 days. At that point, we would get the 3-year track record on rating sites and verify those returns are within line of what the administrator confirmed and the auditor and tax preparer and so forth. Assets, as far as allocations that could potentially go to the trader, a lot of it is going to be dependent on if they're willing to go to events such as the CTA Expo, which provides emerging managers to get exposure and meet allocators in a venue that's usually a one-day event. For example, there's one that's coming up in New York, and they could attend events like this to start to mingle. So unfortunately, while he's a manager trying to manage assets, in the earlier stages of his business venture, will require him or her to go out there and meet people face to face so that they are comfortable with who this person is and who could potentially be managing those assets that they may allocate to him or her.
I actually have a bunch of questions I want to ask you about marketing and how to actually attract investment too. So I'm definitely going to pick up on this.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
When someone becomes a CTA, so they've gone from I guess, what could be considered as a retail trader, as someone who's just at home trading their own capital, to becoming a CTA, what infrastructure requirements are necessary? Does anything change on that front, like in regards to hardware or software, etc.?
Yeah, absolutely. Because if they're accepting multitudes of individual accounts, it can become quite cumbersome. Some of the services that they can be responsible for or retain outside service providers to do so would be everything from trade allocations, daily account reconciliation, equity margin updating, etc. What happens with the trading part of it is they're going to be given one account, a new account number, that's going to be their block account. And that block account will typically have their account number within it in conjunction with multitudes of other accounts that they're managing. And they will usually have an allocation already set up before a trade is actually executed. So a lot of traders will trade in what's called unit sizes. So they might have, for every $25,000 account, 1 unit to trade of soybeans. I'm using that as a hypothetical example. And if they have a 50 grand account, that client will get 2 contracts. But they will have, say, for example, an Excel spreadsheet that will define how many contracts is supposed to be given to each account. All that they're concerned about is that they know who the accounts are, which we will have a spreadsheet established for them, and that when they're executing, they know what the quantity is based on the number of accounts that they're managing and what the unit size is for those individual accounts. So it does change in the sense of quantity, and it may change based on how they actually execute, because they might find an easier way in which to do so with a different type of platform than they're currently using. And we will walk them through all that as well.
You know, you've been doing this a long time now. What are some of the common mistakes that you see new CTAs making when they get into this?
I think that they don't plan to allow more time than is needed for the assets to slowly come their way. I think many either A, think that their track record is enough to draw assets, but it's not. I've seen traders that have a track record that, let's just say, isn't spectacular, but yet they generate a lot of allocations. So it is about marketing as much as it is about the track record. And even though a track record, could be sexy, we all know that the past doesn't dictate the future. So they have to make sure that the clients that they're attracting are ones that understand the risks associated with the potential to make the money as well. But most of them fail because they don't have the operational needs to sustain the longevity of the business. They don't have sometimes the proper risk controls in place, the redundancy in place. So if it's a one-man show, they don't have any backup if something happens to them. They have to look at it as a longer term. It doesn't happen overnight. Learning how to trade didn't happen overnight. So they have to look at it the same way. It's a process.
And I guess a similar question, but slightly different. What are some of the common challenges that new CTAs often come up against? Like maybe some challenges that they might not expect, particularly in the early stages.
I think the demands I think they come into it thinking that it's going to be just like they're trading their own account. They're dealing with different personalities of those that they're serving. And they're not accustomed to. They could be great traders, but they're not always accustomed to dealing with the outside parties that they have to rely on to get other things done.
Okay, so how much contact does a CTA typically have with their investors?
I guess it depends on how they're structured. If they're structured where they're the ones that are one-on-one with the investors don't typically reach out as often when things are going good, but will reach out much more so when things are not going as well in the performance reporting and so forth, as far as the returns. And that can be a total distraction from the trader focusing on what he's supposed to be, and that is managing the risk and trading. So it's a tough line to draw. And that's why if they're going to start a CTA business, they might want to make sure that they have not just their trading plan in, with it being as systematic as they possibly can, even if they're discretionary, but also where they have people that can help them to support the business and the potential of growth. So those people can be the ones that could contact the clients on a regular basis when need be on behalf of the trader.
in regard to challenges that a CTA might come up against, how does one need to think about, or what considerations need to go into the scalability of their strategy? Like, when is that something which is assessed?
Usually it should be assessed from the earlier portion of what they're planning on doing as a CTA. If they feel that the markets they're trading have capacity constraints of 20 million or 30 million, they need to take that into consideration, because what if they get an allocation from an institutional investor? Then they have their entire business reliant on one large allocator, and they're really not able to take on too many other accounts. So if that one large allocator pulls, their business has been disrupted, to say the least.
And how much of their strategy actually needs to be disclosed to investors? Like, how transparent do they have to be around that, if at all?
They have to be transparent enough to disclose the style of trading and the markets they're trading and what they're anticipating for their stops in the overall portfolio. And while there's no guarantee that they'll be able to control the drawdown, they usually want to stipulate what that could be. So, they might have a shutoff valve, so to speak, on what they're doing. A lot of them they're not going to release the Holy Grail, but they're going to disclose enough so that the investor can determine if that style of trading and the stress points of that style of trading is something that they're comfortable with.
Okay. Yeah, that makes sense. They don't have to disclose, the fine details of what actually causes their strategy to enter and exit markets and that sort of thing, right?
Correct.
Cool. Just to pick back up on regulation, let's talk a little more about regulation, because I know that is a big part of running a CTA. So what are some of the checks which are done by I think it's the CFTC before they give you the tick of approval? Like, what regulation requirements need to be met prior to opening shop?
Well, the first thing they're going to do is we're going to get a disclosure document that, like we mentioned earlier, will be disclosing their background, will be disclosing their style of trading and the markets traded, and the minimum account required. And it will also show the performance capsules on what they've done in their proprietary personal account pro forma with fees. That gets submitted to the National Futures Association. The NFA will then review that, and they'll go back numerous times with our administrator in relation to what is needed. But in general, as far as just a general guide of forms and things of this nature, they're going to go through what they call the Form 7R. This is getting a little bit more detailed. They have a Form 8R that's completed and filed that the principal of the firm does. They get fingerprints. Yay. They then have to take what's called the Series 3, which is an exam because they're required to be an associated person. So we'll start with the basics that first have to take place. Then we'll compile the past performance tables, which, like I said, preferably we have 3 years. They can provide hypothetical trading, but once they do real trading, they're not allowed to continue with the hypothetical analysis if it's been beyond 3 months. But after they've gone through the various forms, the 7R, 8R, fingerprints, Series 3, then they will also have the CTA disclosure document. So this is kind of the order of which that this happens. And that disclosure document will also cover the risk of trading and the background information and the fee structures, because this new CTA may want to not charge the 2 and 20. They may decide to be more competitive and go with a 1 and 20 or 1 and 15, or some are actually doing more zero management fees and a higher incentive fee. That's something that they have to decide on their own. And then, of course, we have written procedures and policies that we as a firm can work with them on. Their operating procedures, their business continuity and disaster recovery plans, ethics training. I know, isn't this exciting? Privacy policy, et cetera. But it's pretty mechanical. Doing this is a heck of a lot easier than trying to manage assets, because you really have to have the ability to focus on the markets and so forth, and be confident in what you're doing. But this is a general guideline of what is typically needed for them to begin the whole CTA aspect.
And what about ongoing checks? Like, what are the regulation checks that they need to comply with on an ongoing basis? Can you share a little insight to that?
Well, they're going to have to primarily anti-money laundering laws. There's a lot of policies, and what their policies are, they also have to follow suit on. So if you have a written policy that states that what your disaster recovery reflects is you're going to put everything on the cloud and it's not on the cloud, that's when you are not being compliant. Your marketing material has to be submitted typically to the regulators ahead of time. All forms of communication, you want to make sure that you have a booklet to reflect that it's been reviewed and approved before, dispersing. But the key thing is ethics training, AML, every year. The policies that they put in place have to be followed. None of which they're going to be able to do this totally on their own. They're traders typically. That's why they reach out to our firm, upon which we would usually, have somebody within our compliance department help them and actually do an on-site visit to help them to make sure that they have everything that they need to run the business, and the compliance are all in good gear as well.
Okay, and what about audits? Like, how frequently are they done? Are they done every 6 months, 12 months, or are they just kind of slightly random?
The audits are typically going to take place every 3 years on average. And then in the beginning, they're probably going to get audited earlier than that just because they're a startup CTA. So, after they've done their business, they could probably expect every 3 years. Now, I know people that have been getting audits more back to back. Why, I don't know. It's on average you can expect an audit every 3 years. And they can also do, hire a compliance person to help them do what's like a mock audit, just so that they can review everything ahead of time, so that when the regulators do walk in to their office, they're always proactive and they're prepared for that.
So how much warning are they given ahead of time that they might be having an audit done? Or do they just show up at your door one day?
They can show up on your doorstep, unannounced, unexpected, and other times they'll give you notice. I know somebody who, just received a notice that they were going to come and visit them, and they give them 2 weeks ahead of time. But you can't run your business on hoping that they will just announce themselves that they're going to be showing up in 2 weeks. You start doing the business the way it should be done right from the get-go, so that if you are blindsided, you're prepared for anything that could come at you, no different than trading the markets and some outlier or catastrophic event take place. That's how we look at it.
And what happens in the case that the auditors find something which isn't compliant? What happens in that case?
Well, they'll write up a report, and it will be like what they call a review, and they'll address what they expect you to change. It depends on the severity of it. The most important thing being a CTA is to make sure that performances that you're distributing out there are that they are accurate, and that marketing material is not misleading. How you retain clients is not misrepresenting yourself. That you're not doing business with non-registered parties that are referring business. These are certain things, and that you're making sure, AML is a big deal. You're making sure that you know who the investors are and how the investment dollars, where they came from. So, basically they will communicate, but they can easily shut down a CTA's business if you're not doing business in the ethical fashion that you need to be doing business.
Right. Okay. And what about the costs associated with this? Like, are there major ongoing costs to, just keep a CTA business in operation and to comply with, all these regulators and whatever else is involved? Like, how significant are the ongoing costs of just doing business and keeping the lights on?
As a CTA, you could be paying, most of your costs is going to be relating to the preparation of written procedures and policies, and the initial costs relating to getting your disclosure document together. So your initial costs might be in the realms of, say, maybe $3,000 just to get the preparation work and the submission of the DDoC done. And then in terms of your training and your Series 3 and all that, so you might be talking $7,000 overall to have that all done. Everybody is different in terms of the cost. Now, we don't do this specifically in terms of the compliance aspect. We align them with those that specialize exclusively in, submission of DDocs, helping them get their CTA up and running. We handle all the execution and the back end of things once they've reached all of this. Cost, I would say, would be roughly $7,000. It might be more per year. That cost goes down as, of course, you receive clients, because now you have a revenue source relating to the clients that you're serving, because you're getting management fees for managing those assets.
That seems quite reasonable, actually. I was expecting it to be much, much higher, but...
Well, it is higher if you establish a fund structure. If you become a commodity pool operator, then your cost goes up, because now you're typically dealing with a fund administrator who's generating your monthly statements for your clients versus the FCM who's generating those monthly statements. You're dealing with a lot more cost as a pool operator, because most pool operators are the ones that are absorbing those typical costs versus a CTA that's just handling individual accounts. The futures commission merchants generating a lot of that data.
Right. Well, let's go back to investors and marketing. So, of course, I want to ask you a few questions around this subject. So, what are the most common ways for CTAs to actually raise money from investors? Like, how do they attract investment?
If it's a CTA that's looking to target just a regular retail client that might have a minimum, say, of $50,000, then the sweet spot in which to generate that exposure would be through the entire IB network. And by IB network, I mean independent brokerage firms such as ourselves that are in the business to, introduce assets to CTAs when they're a good fit and they're justified in terms of their risk and their strategy and so forth. That's the best way that I have seen CTAs grow their business, is through the IB channels.
And what about marketing? Like, what regulations or what limitations does a CTA have around marketing? What can they do? What can't they do? I presume they probably can't, run Facebook ads or anything like that. Like, what are some of the limitations and confinements that they have around marketing?
They just have to submit whatever marketing material, PowerPoint presentations. They have to submit to the NFA. They turn over, comments to them pretty fast. So within a week, they should be able to have that approved, and it doesn't cost them anything to submit it, to get the approval letter on it. At that point, they can take their CTA and either attend the CTA Expo so they can meet other IB network opportunities and other allocators in person. They could go to the hedge events. There's a lot of events that may cost them $600 or so to attend, but they're meeting an audience of potential allocators in one day. They can also take their returns and post them on Barclay, Autumn Gold, IASG, various rating sites. So those that are seeking allocations to CTAs can be made aware of them and see how they performed, and they could do a peer group analysis on them through those sites as well. It takes time. It's a process, kind of no different than if you're developing a client relationship. You meet a client, it doesn't mean from the moment they meet you, they're ready to write a check. They have to know who you are, and they have to trust you. And it's a slower process in the sales model than what we've had in pre-08, but for good reason. I don't think too many were immune from the catastrophe of 08. And while CTA world may have done well in most cases when it comes to trend traders, as the saying goes, you're only as good as your last trade. So, you have to build credibility, and building credibility and trust takes time and effort.
Okay, but can they do more direct forms of marketing, like paying for ads online, maybe buying a sponsorship on this podcast or any podcast? Like, can they do those forms of marketing, or does it have to be more kind of what you described?
Absolutely. For example, there's a manager that we're serving that was recently interviewed in a financial publication. So they can reach investment news. They can reach Modern Trader. They could reach out to CTA Intelligence. They could reach out to various publications, and they can be interviewed in those publications about what they do and so forth. So those readerships can consider reaching out to the CTA directly. They can do exactly what you're offering right now. And you have a large audience, and that would be huge for them. To be able to do a podcast with you and have you interview them and ask a ton of questions so that potential allocators can learn more. So there's a lot of things that are available to them that they can reach, but they want to make sure that they can get all the I's dotted, T's crossed, and so forth, go through all that, and then they should have a whole marketing plan on what they want to do. And not everything will have the returns of what they want, kind of like trading.
Do investors who invest in CTAs, do they have to be a quote-unquote accredited investor?
Typically, if they're in a limited partnership or a commodity pool, yes. There are a lot of CTAs where they don't have the financial criteria that we're speaking about here right now as far as accreditation. If they're requiring smaller dollar denominations for their investors, then typically they're not going to want them to be accredited. If they want $1 million as their minimum account, they're typically going to want them to be accredited. But absolutely, that's why the trader has to decide what dollars can the actual trader trade and feel he is successful and be able to replicate that or put forth effort to replicate that for outside parties as well.
Right. And from your experience, what are some of the things which investors are looking for most? Like what sort of leads their ultimate decision on which CTA to go with? Because, you said earlier that those with the best performing track record don't always get the investment that they think they're going to. So what's ultimately
the leading drive to what causes people to invest?
Exactly. Like what are the things which investors are really looking for?
Well, I think it depends on who the client is and the audience and the distribution channels. So, for example, if I were going to an investment advisor, they're not going to be targeting a CTA that might have an 18% return where he's had a 15% drawdown. They're going to be more focused on retention of assets and preservation of growth than any other formality. A retail client typically would be willing to take a higher degree of risk to achieve a higher return than an advisor would. I'm speaking in general terms, of course. But it's interesting because we do have investors whose focus is more on the sector aspect. Like they want to find a trader that only trades the metals or only trades the commodities. So it's pretty wide based. When I was talking earlier about a process of sales or a process of relationships, that's really what it's about. In the earlier stages of the 3-year track record, if they go to events and expect to take a lot of time out of their office to mingle and meet, I think the trade-off would be that they're going to get a higher ranking for people to consider them to invest with if after 1 year where they've met, they've seen them continue to manage risk in the fashion that they're comfortable with.
And I should probably ask you a question around investors withdrawing funds. Like, how easily can investors withdraw funds? Is there a certain lockup period? And just to take that one step further, so I guess 2 parts to this question, what are the consequences for a trader if they lose money?
Well, if the trader loses money if the client needs funds, the first question is it's an individual account. The trader will typically want 24 hours to unwind the positions in a methodical fashion. Okay, so some of the traders in their disclosure documents will stipulate that they want at least 5 days, just because they want the slow and methodical way to unwind positions without this rapid market order on all positions. But the fact is, most of them will be able to unwind the positions on day 1 and day 2, wire funds. And they will wire the funds out, excluding if there's any money that's owed to the trader in relation to management fees and or incentive fees. But they can usually get the money right away. That's why when 2008 took place, And if an investor was making money with the CTA but losing in many other asset classes, they still may want to withdraw funds from the CTA simply because it's a liquid asset class, unlike many other investments that are not.
And what happens if the trader loses money for the investor? Like, how does that, are there any consequences to the trader?
Well, absolutely, because if you invest with a trader and you've lost money, you can expect that you're not going to be right all the time. You can expect that not every month will be profitable. We realize that to achieve success, there's going to be risks taken in which to do so. It's a matter of, are the losses understood? Is there reasonings behind them? Did something change in the systematic manner in which he's trading? Did anything, what was the rationale behind it? Or was it just normal conditions? And is it a dollar amount that he can recover from? Typically, investors, if they're sold the right way, they're sold in such a way that they understand losses can and will happen. It's about, are they losses that can be recoverable? In other words, if I take a 15% loss in a market that hasn't moved very much, or, with what the style of trading is, I would really dig into what happened. And is it going to take me 5 years to recover from those losses? You want to know the road to recovery and things like that. It's not devastating unless, of course, you have a trader that's done well for 5 years and all of a sudden his worst drawdown has been double what it's been in the past.
Yeah, I think that's a really good answer. And one question I meant to ask you earlier, actually, a lot of people listening to this all around the globe, I think about 55%, maybe 60%, something around that, of my listeners are in the US. But for those outside of the US, is it compulsory that you need to live within the US to run a CTA?
No, there are different, again, we're going into the regulatory stuff. If you're in Canada, there's additional layers of responsibility in the regulatory environment. If you are living outside and you're not a U.S. citizen and you're managing assets, you can do so. Where the big variances exist has to do with the investors, or and how the solicitation is taking place.
Okay. All right, Nell. Well, let's leave it at that for now. Let me ask you, where can listeners go to find out more about you if they wish to?
They can reach out to me either via email or toll free. I'll give you both if that would be okay.
Yeah, go for it.
The toll free number is 800-238-2610. Again, it's 800-238-2610. And or they can email me directly at nsloane, SLOANE, at ctgtrading.com.
Okay, so that's your website also, ctgtrading.com?
Correct. And if they go to the managed futures sector on the website, we do have some brochures on there, such as a guide to starting your CTA program, customized solutions and things of that nature. We don't have as much on there as it pertains to the regulatory stuff, and we would welcome the opportunity to have the potential CTA speak to our compliance department to go into greater detail on the checks and balances that, they can expect.
Sure. Okay. Well, yeah, I mean, if anyone wants more info, they certainly know where to find you at. So, Neil, thank you very much for coming on the podcast. This has been hugely interesting. I appreciate it.
Sure. Thank you for the invite.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
How you doing, everybody? Thank you so much for tuning in to episode 128. This week, joining me is Andy Kirshner. Andy has been a trader since the early 90s, and somewhere around 2001, he founded Kirshner Trading Group, which is a proprietary trading and technology firm in Austin, Texas, and also through a partnership with S&B Capital, Kirshner Trading have a second office in Midtown Manhattan. So, what did we talk about? Well, we spoke about Andy's ability to take pain on adverse positions as though that's a strength of his, whether or not this has been a key ingredient to his trading success, and do traders with higher risk tolerances make more money? Andy also shares his daily habits and critiques a trade which didn't go so well from the session prior to recording this episode. And naturally, we cover a few other things too. Please enjoy it and take some notes if you need to. Here is my interview with Andy Kirshner. Okay, cool. I mean, let's start right at the beginning. I think this is probably the early 90s. I mean, where did you start out? I don't know a great deal about your background and how you actually did get your start in this, but if I'm not mistaken, you actually started out as a software developer. Am I right? I mean, feel free to correct me.
No, I was a geologist by training, but was ski bumming around a little bit, and a friend of mine figured out how to tell which stocks were going to go up the next day. And so we put all of our money together, $5,000, and started trading options out of the library.
Can you tell us a little bit more about that? I mean, what sort of experience did your buddy have in trading, or were you both very green to this?
Well, my friend was extremely dyslexic and a great friend. And so, you know, he was finishing up undergraduate at Texas Tech. And so I drove down from Colorado and moved in with him, and we started trading the markets. So he essentially, being dyslexic, he's a guy that was excellent at pattern recognition, and he paid his way through school by figuring out how to tell which baseball cards were in a pack, you know, before he bought them. You know, you'd walk down a beach and he'd find 72 shark's teeth and I'd find 2. So he was that kind of pattern recognition, savantish kind of guy. And so, you know, we would make a list of the top 100 IBD names, Investors Business Daily names, and look for patterns within those, and we'd trade options on them. And this was before the internet and before you had the ability to actually trade and get prices on a screen. And so we turned our $5,000 into $1,500 by the end of the summer, but we were really encouraged because we go, gosh, if we could only get the prices that we see on the screen, we'd make a lot, because we were right 80% of the time. So we ended up finding out this was just as the SO's system was developing, where retail people could actually get prices from the market makers on the screens. And so we called the guy on Sunday, drove down Monday, and moved the next week. It was that compelling.
Okay, and when you say called a guy, who was this guy?
His name was David Jamail and David Birch. They became my partners or I became their partner in Cornerstone, which became ProTrader, back in like 1996.
And what was ProTrader?
ProTrader was a broker-dealer that essentially serviced day traders. And so it started out with 12 seats in Austin. And then we grew it to maybe 20 offices around the country, did maybe 1% of the NASDAQ at our peak, and serviced probably 450, 500 traders. We ended up selling that business, the retail and the technology, to Instinet in 2001 and kept the proprietary trading business, which is what we do today.
Okay, and so just going back to ProTrader there, is that where you were a software developer? I mean, were you a software developer at any point, or have I just totally misread something?
No, I think you may have misread it. We have a lot of software developers here, but they will laugh at you if you were to tell them that I was a software programmer.
Sure, okay. So at ProTrader, you were a trader, or were you more involved in the business side of it?
No, I mean, I live and breathe and trading, and that's what I like to do. I'm not a great manager or any of those types of things, but I love talking to traders and helping traders get where they want to go, and having a little input on technology and kind of what it takes to put it all together so you have a real healthy environment. So, yeah, I mean, I spend all my time trading and then 2 or 3 hours after the market doing stuff like this.
So earlier you said that you started out with about $5,000, you and your buddy. That account sort of dwindled down to $1,500. What sort of things helped you to get better? How were you helping yourself to improve?
Well, so as you can imagine, we drove down and they took a look at me and they took a look at my friend and they said, we'll hire your friend, but you can't really trade here. You're too self-confident and you look like a train wreck waiting to happen. And so I ended up, kind of working part-time jobs, and I'd do 1 trade a day at a bucket shop kind of across the street. And my friend Scott was hired on Scott Dyer is his name, was hired on to trade, and they loaned him $100,000. And so all the best traders in Austin were kind of at this one firm, ProTrader, and I was friends with Scott and became friends with all the traders, and so they kind of told me kind of what worked for them and what habits to do and how to stop losing. You do trades 2 times, and if you don't make money on them, it's rare that you do it a 3rd time. And people gave me some mechanical processes. So for me, it was more about talking to the best traders I could find, figuring out what worked for them. And, there's lots of details kind of through that, but, the markets change all the time. There are a lot of timeless principles, but, my strategies have changed many times over the years, but a lot of the habits haven't.
Okay, so how long would you say it was before you actually started to see some progress in your own trading?
So I guess I probably traded on my own in a small shop for maybe about a year, and I'd maybe make $1,000 or $2,000 a month doing 1 trade a day on average, and these were longer holding times. But then another company opened, and they needed a trader, and so they gave me some money to trade, and I made $80,000 the first month, and then $100,000 plus every month thereafter for ages. And so it didn't take very long. Kind of once I was kind of on my own and had enough capital, I was able to follow rules and remember numbers and do things like that. And it was helpful that I was not around a bunch of other people, because I just did things that made sense to me at the time. And had I been trained in a different environment, I may have, become a scalper and not holding things longer. it took me a year and a half before I got an opportunity, and then I had no idea that it would suit me as well as it did.
That's a really significant increase to go from making $1,000 to $2,000 a month to then making $80,000 to $100,000 a month. I mean, how was that possible? Was it just because of the amount of extra capital you were given? I mean, I'm sure there were some other factors to it.
No, it's mainly the amount of capital. You know, I could be in lots of positions at once. And back then, it was largely a market maker driven market. And, you know, things would move 3 points and they would kind of go up in a jiggly line. But if you could hold these pullbacks, which were measured, you would end up with 80% of your trades were flats to plus or minus. And then you'd end up with 10 or 20% of your trades that were plus $2, plus $3, plus 7/8. And I was able to kind of, anyway, it didn't bother me taking those kinds of risks and holding things longer.
Okay, so when you describe the market environment as a market maker driven sort of market, can you just break that down a little bit and maybe expand on that, please?
Once upon a time, you know, probably before you were born, you know, there were the markets were, you know, largely, I'm a product of really having access to the markets. Prior to this, you know, to be a trader, you had to be in Boston, New York, Chicago, some in Minneapolis, here in the U.S. anyway, to really trade. And you were generally a market maker, and those guys traded, and they would accept or fill your orders, you know, over the phone. Computers did not run the trades. It was a human was on the other side of you. When that happened, and things were traded in eighths and quarters, and then eventually sixteenths, and eventually pennies and now sub-pennies. But things moved a little smoother back then. This is in the mid-90s, and it was easier to trade against other humans than it is to trade against computer models that always seem to be searching for your stop today.
We're going to talk a little bit more about that in a moment. I think that'd be interesting to go into a little further, sort of about how your trading has changed due to, you know, markets changing, of course. But before we do, I'd like to ask you about some of the mistakes that you made early on, because I think it might be helpful for others to hear about some of those mistakes and maybe caution them about a few things. So, I mean, is there any mistakes that you made earlier on which, you know, you'll always remember?
I've made so many mistakes. In fact, I was just adding up my mistakes today, and, you know, I made, I don't know, 100,000 plus of mistakes. And that kind of gets you sharp if you kind of continually look over your mistakes. Big mistakes that I've made, the biggest ones that I typically make, 'cause one of my strengths is that I can hold lots of pain, and I can hold winners for a long time. It's also my biggest weakness, and which is, you know, a lot of times I might get up 20% on a swing trade or something like that, and it hasn't quite hit my targets. I don't have sometimes if I'm not a little bit more structured on, hey, how I need to capture profits, or if it doesn't work out exactly as I intend, how do I work my way out of this trade? And so sometimes I will hold on too long, let them come back too far. And so, you know, a couple of years ago, I turned a couple $1 million trade into a couple $1 million loss, you know, across a number of different stocks. And that hurts, and it just gets your psychology all messed up. And anyway, I still have troubles with that from time to time, and I just have to journal about it and make sure that I'm a little bit more focused on making sure I have a real structure, and if things aren't going exactly as I need to, how am I going to scale down?
Right. So that ability to take a lot of pain on positions can be a positive and a disadvantage. I mean, is that something you have always been able to do, or is that something you've been able to get better at, or has become more acceptable to you over time?
I think I've always been overconfident, and the big numbers don't bother me. So you grow into it. And just recently this year, I'm sitting next to a really good trader that's traded really big. And so I'm trading a lot bigger because of it. And so that I'm having to change my psychology around and also tactics around how I'm trying to capture trades, and how do you handle stops when you're moving lots more shares and those types of things.
How important do you think it is to have that skill of being able to take, a bit of heat on a position and withhold the pain when a position's moving against you? Like, I feel like that this is probably quite a key element to your success as a trader. Am I right?
I don't know if it is or isn't. I think it's one part of it. I mean, I think it's more helpful to kind of trade according to your psychology. If you have something that really works well for you and you can repeat it lots of times, then you should focus on that and make sure that find an edge and really make sure that it works for you, and then see how big you can do it without affecting the way that you trade. The best traders are the ones that can trade 50,000 shares or 100,000 shares like they trade 1,000 shares, and not change their decision-making process for the most part. If you're going to sit in the seat all day, you might as well be doing some size.
So even when you get into a position, how do you determine when you're going to get out and when you're actually going to cut your losses? Like, do you have a predetermined point, or do you kind of feel it out as you go?
Usually now, I am laddering into positions and laddering out of positions, and I get more of a feel for how things are going to happen. But I usually am trying to, get in and say, okay, I'm going to risk a point and a half on this trade, kind of worst case, and I think I can make 3.5 or 4. And what are my odds? I probably have a 50-50 chance on something like that. Sometimes you may add into something and then it feels like it's really got some support in here, so I may triple my size and go, well, I'm only going to risk another 30 cents on this particular name from this spot on triple the size, but the risk reward just went from, since it's gone against me, but it seems to be having some support, my risk reward is now not 1-3 or 3-1. It's more like 10-1. And so I don't mind getting in a lot bigger right here, even though my odds are a little bit less because it hasn't worked for me thus far. But I still have, the chances of the trade working are less. It may only be a 30% chance that it works. But if it does, it's going to be a 10-1 winner. And so I modify my behavior around that at times.
Now, I just want to take a step back to a comment you made to a couple questions ago. When I said that your ability to be able to take a lot of pain on a position is probably been a key element to your success, and you weren't so sure if it is. Do you think the traders who maybe have a lower risk tolerance make less money, though?
No, not necessarily. Not at all. There's lots of different styles that work for people. Some people are scalpers. Some people are swing traders. Some people only like to do things that are set up where they're going to win, 70 or 80% of the time. So you can be very successful and you can accomplish whatever your goals are in lots of different ways. You can be a computer genius and write some models like we've got a bunch of guys here doing quantitatively. So there's, I asked somebody once who ran a really big firm, hundreds of traders, said, who's your best trader? And he looked at me and said, I don't have a best trader. The best trader in what? The best trader that's, the best short seller in this particular market, the best semiconductor trader, the best swing trader, the best. And so matching up your psychology with the types of trading that you're willing to do and the types of risk that you're willing to take makes a big difference. And, it really does help to discover what that is. And then you have to really make sure you have all the right habits around it too. Are you journaling? Are you reviewing? Are you preparing? I could tell you my exact strategy today when you can tell me yours. And unless I did all the work around it, I'd be only 20% of as good as you are at it. And probably the same thing would go for you. So it's much less about the strategy and much more about, are you doing all the right habits in preparation, journaling, review, using the technology, preparedness?
Well, this is probably a good point for me to ask you. What are some of those habits? You briefly hit on them there, but can you go into that a little further and maybe walk us through I don't know if you want to walk us through maybe a typical day or however it might be best to get this across, but it'd be interesting to hear about some of the habits which you feel contribute to your success as a trader beyond having just a good strategy.
Yeah, I think the strategies come and go. To me, so things that work for me are, and I don't do it as much as I'm a little bit lazier in my older age because I've been doing this for a long time, and I want to see my kids off to school and those kind of things. So I sacrifice some upside for doing, having a little bit more balanced life today. But coming in early, reviewing the news, reviewing the things that are gapped up, I'm putting out offers and bids and alerts at different places that I'm looking for. I'm talking to the other traders. We've got 10 guys that get on a Skype call and, we're talking about our best ideas for the day, putting alerts on those, calling out your trades throughout the day with other people. You tend to do better trades if you are more overt and talk about them. It's hard to do today. Most people are, the traders we have in our office, they'll call out some of their trades, but often they're texting the guy right next door to them in some way, because most of the traders around here are somewhat introverted. So, but I find that the more you talk about a trade with someone else, the more you follow it and do a better job at it, and the more clear you are as well. And then, making sure you have good exercise habits, those kinds of things, so that you're rested and refreshed. Journal at the end of the day, look over what worked, what didn't. I always kind of add up and tally my mistakes. And, you caught me on a bad day. I'm kind of chapped about this one particular trade, or a couple of others too that I didn't perform well on. And, then you're kind of ready to do it all again the next day. I think another thing that really helps for me is talking to, lots of different traders and different time frames and ideas and setups and that kind of stuff. And, that kind of informs you on what's working for others. And there's so many different opportunities every single day to make money. Making sure you're in the right place at the right time really helps.
Yeah, those are all really great. I appreciate you sharing that. One of the things you mentioned is I've caught you on a bad day, and I don't mean to kick you while you're down, but would you mind sharing why you didn't perform as you would have liked to? Were there any factors that you can sort of pinpoint?
Yeah, so I have this. Today is, May 23rd, 2017. I have the stock Momo that I've been in for a long time, and it's a Momo stock, actually. And just, it's been getting pretty hot. To me, it feels like it's just about ready to turn over. I pretty much knew I wanted to get out today. Had really good earnings, blew them out, gapped it up a couple of bucks. And, I had offers out, laddering out 50 cents up and I'm out of half of my position already. But the other half I was hoping to take out at, from 46 to 48. It opens up at 45. And, I had a feeling that this thing was going to, come unwound. But a lot of times it'll, drop down about $1 and then kind of come back up and go roaring through. And so I was too afraid of missing the upside to put in a really good stop. So what I really needed to do was put in a stop at 44 and say I'm either going to lose $1 from this 45 level, or I'm going to make, $3, or $1 to $3 on the remainder of the shares. And it just, washed right through 44, and then it was just a mess, and it ended up going down to like 38. I had a pretty good idea that the numbers were going to be good. I ended up getting out at 41 after it kind of settled out, but it'll probably end up going to 48 over the next month or two, but it may not. But I gave it way too much room, and so I should have been more structured ahead of time and not thinking on my feet, if you will. And so I risked 150,000 more than I should have, and I ended up losing 90,000 more than I should have on that particular trade. I've got to be much sharper to be able to stay in the game and do a little bit better on those. Now, it easily could have gone to 43.5 and then gone to 48, but it didn't. And, I would have been mad or whatever, but I needed to be, in this context, I needed to be a little bit more structured and have my game plan a little bit more in line and precise.
Okay. Now, this is probably, you can correct me if I'm wrong here, but is this kind of the scenario where trading becomes very difficult? Because you've probably taken trades similar to this in the past where that sort of thing has worked out in your favor and you've made considerable amounts of money from that particular, or a trade like that. This time it didn't work out. I mean,
well, it's not so much that it didn't work out. It's more the mistake was not having a well-defined plan. I had an intuition, man, this is pretty much it. I need to be tightening it up. I told people on the call I need to get out today. If all of those things are kind of lining up for me and I don't have a really great stop, I've really kind of misplayed the day for that particular trade. So it's less about does the trade work or not work. It's more about doing what you think you should do. And today I was not disciplined enough or structured enough for how I was feeling about that particular trade. Other days I may have said, okay, yeah, this is fine. They got great numbers. It feels good. I'm willing to let it kind of wash back around and no problem. But today I kind of went against, anyway, I was unstructured. So anyway, it's embarrassing, but everyone else that listens, don't make the same mistake.
Absolutely. I mean, I think it's really great that you can be honest about it and share it. I mean, I'm sure it's going to help many people who are listening to this. We'll still make mistakes no matter what level we're at.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Maybe I should have asked you this a little bit earlier, but what sort of trader are you? Could you just give us a rundown on sort of the opportunities that you try to capture, the things you look at, just sort of a bit of an overview of your strategy, if you will?
Well, I've got a lot of different ones, but I'll say what kind of seems to be working more today for me than ever before is now I'm kind of the guy that, I'll step in when things are really looking ugly or looking great. So I do a lot of fading of real extension moves and try to kind of ladder into those. And then if it really feels right, hold on to them for some big retracements. So I do a good portion of that. I would say I also end up doing some swing trading in trying to buy some breakouts of some momentum names and some news trades too, in terms of things that just seem to make sense. It's overdone or underdone, or hey, this is really going to go. And I try to pick bottoms if it feels like, boy, all the bad news is in and it couldn't get any worse. And a great example was earlier this year, Trump is beating up on Mexico. Everyone's afraid in Mexico, and the EWW, the Mexican market, and the peso were just getting crushed, and they couldn't get crushed anymore, and it just finally stopped. And so then you just step in and catch a lot of it and catch a 5 or 6 point trade. And those are, fantastic ones, or 8 points. I don't know. So anyway, that's 4 or 5 different strategies that I've run across. But how do you find the most beaten down kind of things and look for a turn? Or how do you find the real, where most people are getting stopped out, and that's kind of a good place to step in?
Okay, so you're mostly trading equities and a little bit of currencies?
I trade all U.S. equities for the most part, and I give options money away to some of the other guys that you probably have on your show.
Okay. Okay, now you've mentioned laddering into positions a few times. Laddering in that's another term for scaling in or adding to a position. Am I correct?
Sure.
Yeah. So can you explain to us a little bit about how you do that and when it's a good idea to do so? You're obviously trading a much larger account than probably most of the people who are listening to this podcast. Is it laddering into a position? Is that something that becomes necessary and useful when you get to larger account sizes, or is it something that can be beneficial for many traders?
I think it really depends on your style and what it is. You can do it on any. If you have a style where you're looking for kind of retracements, or perhaps you want to have it show you something and then add to a winner, that's probably even better. I think it worked for any size account. It really depends how the way I think about it is when you're trying to pick tops or bottoms or fade big moves, it's helpful to do them in smaller chunks. And so you get a feel for the market. And unless you're in some, it's hard to really feel what it looks like, what it is. And, I'm willing to risk some money here and some more here. But at some point, you can't take any more on, and you've got to, unload it. So.
And when you come to unload a position, are you also scaling out, or are you taking everything off at the one time?
When you know that you're wrong, it's helpful just to kind of start taking it off, make a bad trade, get out. You can always get back in. Oftentimes I'll punch out of all of it, and then a lot of times then I'm frustrated, but it happens. You can't win all of them.
Of course. And when you're adding to a position or laddering in, as you refer to it, how are you determining the size each time?
It's usually somewhat equal sizes, and usually, I don't know, and the size of the particular trade really depends on how comfortable and how liquid the trade is and how strongly you feel about it. So, some trades I'll be in a few thousand shares, and some trades I'll be in several hundred.
And just generally speaking about this concept of laddering in, is there any advice or suggestions that you'd give to newer traders about how to think about doing this, or anything that may be helpful to them?
I'm not sure. I think that, laddering in or laddering out that's just part of a particular strategy. I think it's more important to find something that kind of works consistently, where you're going to win, more than 50% of the time, and you have a 3 or 4 to 1 kind of win ratio, and have discipline. I think once you kind of get that, then you can be thinking about laddering in or where you'd add. And so I wouldn't complicate it too much for newer traders, if you will. I would try to focus on just get in, here's your risk, be disciplined, here's where your reward is, And then, if you really get that going, then perhaps start adding more shares. I think most of the time, if people add to winners rather than, adding to losers, they're going to do a lot better.
Well, let's talk about this a little more. In addition to the firm, Kirshner Trading, and some of the traders within the firm, I mean, when new traders come into your firm, do you teach them specific strategies, or how do you encourage them to find something that works for them? Like, what's that process look like?
Well, we try to get people going quickly. So there's maybe a 6-week kind of, here's a bid, here's an offer, here's some different strategies. But most of it's around the habits of, here's what you need to do to be successful. And then after about 6 weeks, we turn them on live and start them trading. And at least this isn't the discretionary part of the business. And they usually will match up with an experienced trader and, get on someone's team. And then they'll start, calling out the trades they're looking for, help write models, help write alerts, do other things. And they learn from someone that's, more experienced. And usually both parties learn and from that, and we find new opportunities and strategies.
Okay, so in regard to them actually coming up with their own strategies, they're partially strategies which they pick up from the advanced member in the team and sort of things that they observe themselves as they are live trading?
Yeah, pretty much.
Okay. Can I ask you, what are some of the questions that you ask traders during the interview process before you bring them into the firm?
I'm not doing a lot of the newbie interviewing today. I will say some of the things that we're looking for is, prior records of success, prior records of overcoming adversity, the ability to act without having all the information. Engineers usually are not great intuitive traders, if you will. This is all for the discretionary side. The quantitative side, you're asking much different questions. Those are the types of things that we'll kind of look for. And so you're really looking for, sometimes, really competitive video gamers sometimes are really good. Guys that are, don't mind sitting around playing video poker for 16 hours a day sometimes end up being pretty good. There's lots of different attributes, but you're looking for a track record of success and the ability to adapt.
Okay, and that track record of success might not necessarily be in trading, right? It might be some other sort of competitive field.
Sure.
Okay. In regard to new traders coming into the firm, what are some of the mistakes you see them most commonly making? Is there anything that stands out?
The biggest one that people will make is that they think it's going to be a lot easier than it really is. And so the biggest mistake people have is they don't, they're not prepared externally for how hard it is to kind of be able to make it. We take in great people and still only, 2 out of 10 make it and will be successful traders over time. And it takes, it's a couple of year process. And so, at least at our firm, we don't really pay salaries. It's kind of a eat what you kill. And so a lot of people are not really ready for that. And that's on the discretionary side. Quantitative side's different. And so people get partway into it without realizing what it's going to take and don't have their financial stuff worked out on the back end. Meaning I'm not, I'm working a second job or I'm doing something else, or maybe my wife's working to keep me afloat or whatever it is, while you kind of figure that out.
Okay, so let's two things on based on your comments there. A lot of people who come into it are not ready, particularly because you don't pay a salary, and I mean you're not unique in that way. I think that's the case at many proprietary trading firms. Like you said, you eat what you kill. So how could people be more ready coming into this?
To get into trading?
Yes, and probably more specifically getting into proprietary trading, I guess. But yeah, I mean, you answer that how you please.
To me, I'd say you want to read some of the good trading books and Reminiscence of a Stock Operator, Market Wizards books, all of those things. And they all describe, how people find an edge and, how they treat their psychology and things like that. And I'm sure there's plenty of, trading to win psychology books and, those types of things. That would be one. The second would be find wherever it is that you want to go, find the best, and this applies to any field, but, find the best person in whatever field it is that you want to do. If you really want to be a short-term trader, find the best short-term trader you can find and try to go work for that person. If you want to be, a big fund manager somewhere, go find the best fund manager that you can find in your area and go work for them. And shortcut your process. Don't try to figure it out yourself. Instead of taking 20 years to get there, boy, what if you can talk to people like I talk to all the best traders in Austin? What if they shortcut my learning process to, 1 month instead of 5 years? So really find the best person out there and best group where people are making the most money, having the most success, and go study under them. Be part of the team.
Yeah, that's really great advice. And just to pick up on a second thing, you said trading is so difficult. I mean, in your opinion, why is trading so difficult? What about this whole game causes people so much grief?
Well, it goes against most of our instincts. If you ask 100 people on the street, if you bought a stock at 10 and you bought two stocks at 10, one goes up $5 and one goes down $5. Which one do you sell? What do you think most people say?
You'd sell the one that's in profit.
Yeah, almost everybody says that. And, I've asked it, I don't ask it all around, but, it's probably nine out of 10 people say that, probably even higher. And that's the exact wrong thing. So it goes against all your basic instincts of, flight or fight. And you have to kind of, do the opposite. And you have to be disciplined about it. And so anyway, that's one of the reasons I think trading's hard.
Is there any advice you'd like to give to traders who have been at this for a few years and are struggling to break through?
Well, I think if you've been at it for a few years and you're struggling to break through, are you prepared? Are you focusing on it full time? Do you have a strategy written down? Do you have targets and stops written down? Do you have your setup written down? Are you journaling to find out what went wrong each day? Are you adding up your mistakes? Are you also noting what worked well and, patting yourself on the back for that? Are you, if it's not working, who is around you? Who is making money and why? How do you learn from that person? Don't keep doing the same thing if it's not working. And for some people, and maybe a lot of people, it is, how do you maybe it's better for you to run automated models. It takes a lot to kind of run automated models and things like that, but oftentimes a structured way of doing a trade, people can actually say what makes sense and do it well. But when the emotions get involved, it's easy to mess that up. So some people might be better at automating, hey, I'm going to buy this here. Here's my stop. Here are my targets, and then let it go. So anyway, there are lots of different ways to kind of attack that. But if you're not making it, you definitely need to be changing something and investigating what works. Is it your habits? Is it the people? And find something that is working. And it really comes down to, do you care about being right in your strategy, or do you care about making money? And once you start caring about just the outcome rather than being right, there's really no stopping you.
Yeah, well, you hinted at automation there. So I'd like to ask you a little bit about this and more broadly about technology and how traders can utilize it, because from what I understand, you guys there at Kirshner Trading kind of pride yourselves upon how you use technology, or that's the sense I got anyway. What do you think the future of trading kind of looks like? I know that's a very broad question, but what are your views on automation, how traders can utilize that, not just traders who are 100% automated, but like even discretionary traders using technology, because Mike Bellafiore speaks about this quite often, about encouraging traders to become more bionic in how they operate and that type of thing. So, yeah, I mean, what are your views on automation and how it can be utilized?
Well, if you look across everything in our lives, they say software eats the world, and everything's becoming more automated, across every aspect of your life. So if you expect Tesla cars to be driving you, why wouldn't you expect that you should be using some AI and technology to be helping you with your investing process or trading process, in our case? So the way of the world is, everything gets smarter and faster and more efficient, over time. And I think it's helpful to consider, creating models, creating quantitative alerts. There's so much noise in the market. You see every penny movement. What you're really trying to do is find, hey, where are these great setups? So, we're tracking the 8,000 stocks that are out there, but how do I see only the best of the best that kind of fit my strategy? If you're served up those on a silver platter and either automatically execute on them or are alerted to them, then you have narrowed down your chances of success. Well, you've narrowed down what it is you're really looking for, and your chances of success are much, much higher. Our guys will start from, creating alerts to running models in the discretionary trading business. And on the quantitative side, they're just doing, all model work and using lots of AI to kind of start figuring out other patterns and different, what are the most important things there? What are the factors that make the most difference in these particular situations? Now, all of that being said, AI and automation, all of those do or help someone smart with a strategy operate a little bit better. It's a tool. So AI plus humans is not 1 + 1 = 2. It's 1 + 1 = 3. So you're looking for a real, hey, how do you really boost your efficiency and power, become smarter, make better decisions with better data?
Right. And your traders in-house, the guys who are more on the discretionary side, what tools are they using to develop alerts and different things? Is that all proprietary software, or do you use some other methods?
So we have, internally, it's all proprietary software. We call it Great Pi. It's written largely on a Python languages or Python language. And, you've got everything from, script automation that helps people write code to you can go directly to our website and look on CloudQuant, and you can write anything that you want and create a model. And if it's good, we'll kind of help fund it for you. But so generally we're using Python, and you can think of anything that you could possibly do, and you can get those alerts and turn them into models, and it's largely internal, but you can check it out on our website if you want.
Okay, cool. Yeah, well, I mean, I'll make sure to include a link to that in the show notes. What's that? That's cloudquant.com, isn't it?
It is, yeah.
Yeah, cool. And are there any further comments you'd like to add around automation or the future of trading, or should we close this out?
Well, thank you for having me on. I've talked around a lot of different things. I wish you the best of luck with your show, and really, I don't have any other further comments.
Okay, cool. Well, let's leave it at that. Andy, I just want to say a massive thank you for coming on the podcast. It's been really great, and I really do appreciate you taking the time.
Thanks a lot. Happy to be here.
So if someone wants to find out more about you, where's the best place to go?
Oh, our websites, Kirshner Trading or CloudQuant, either one.
Okay, and Kirshner Trading is spelled KERSHNER trading.com or cloudquant.com.
That's correct.
Cool, man. Thank you very much once again.
Thanks so much.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's going on, everyone? Welcome back. Thank you for listening in. Now, to introduce my guest of this episode, his name is Victor Haggany. Victor began his career at Salomon Brothers in 1984, starting out in a research role before joining their prop trading desk. In 1992, Victor left Salomon to become one of the founding partners of Long-Term Capital Management. LTCM was an incredibly successful hedge fund. Some years, while using a lot of leverage, the fund would return over 40%, until 1998, when LTCM failed in a spectacular fashion, causing the Federal Reserve to step in and organize a bailout in order to prevent the possibility of a collapse in the global financial system. Victor took a 10-year sabbatical after the dust settled, and in 2010, he founded Elm Partners, which is an active index investing fund. Victor mentioned to me that he didn't want to spend too much time discussing LTCM, but if you're interested to find out more, there is plenty of info online, and I've linked to a couple resources in the show notes, which can be found at chatwithtraders.com/129. But we did spend quite a bit of time on something I thought was very interesting, which is optimal bet sizing, and how bet sizing alone can drastically alter outcomes over a large number of bets, or trades, if you will. Much of this discussion is in reference to an experiment Victor carried out with some involvement from Edward Thorpe on the patterns of how 61 participants would bet on a biased coin with real money. You can find a link to the paper, which was produced afterwards, also in the show notes. Last thing, the sound quality isn't superb, so I do apologize, but I'm sure, hopefully, your ears will quickly adapt. With that being said, here is my guest for episode 129, Victor Haggany. I read somewhere, I'm not sure how true it is, but your father was also a trader.
Yeah, my father was a trader. He wasn't a trader in the financial markets, but he was a trader in the import-export business. More that than an entrepreneur, but he was also an entrepreneur and a businessman.
Okay, that makes sense. So, did he have any influence on you getting into trading? I mean, what got you into trading?
Well, no, he did not have any influence on me getting into trading. What got me into trading was John Merriweather and his team asking me to join their trading group on the floor. I had joined research at Salomon Brothers in fixed income research, and after a few years of doing research, they invited me to become a trader. I had no idea about it, or didn't know if I would be. I mean, it wasn't something that I was planning on doing. My father, though, did influence me to join Salomon Brothers. I had an offer from JP Morgan and Salomon Brothers, and I said, "Dad, which one do you think I should take?" I said, "The JP Morgan one is paying about 40% more." And he said, "Which one is which one is just a flatter, sort of crazier place where if you do well, you can go further? Which one is more bureaucratic?" And I said, "Well, JP Morgan is definitely more bureaucratic." And he said, "Well, go for the Salomon one then. Go in there and have some fun." And he was right.
Now, we won't spend too much time on this because there's some things that I definitely want to get into conversation with you about, but just give us a quick rundown on what you were doing at Salomon Brothers, and then for anyone who is unfamiliar with you, bring us up to speed on the long-term capital management situation, and then we'll get into some other topics which I think are quite interesting. So, yeah, just give us a short rundown on your background in this industry.
Okay, sure. Yeah, so by way of background, as I mentioned, I started at Salomon in fixed income research, and then after a few years was invited to join the ARB desk, the government ARB desk, or proprietary trading desk, run by John Merriweather, that was kind of in the center, or a prominent player in the book Liar's Poker. I was the youngest trader on the desk, and learned from all these other great people, and became very, very close to everybody, and it became my family. And so when a few of them, in particular John, left Salomon Brothers in 1992 to start LTCM, I had just gotten married, decided that I would like to stay with my colleagues and mentors and friends. So I left Salomon Brothers in late '92, and and then after a while I gave it some more thought and joined with John and my other partners as one of the founding partners at LTCM. And then I moved to London with my wife because I had been in London before for school and university, and I set up our London office, and eventually had an excellent partner in the office, Hans Hufschmidt, and we ran all of the trading that we were doing in sort of the European sphere. And then when LTCM failed in 1998, I was one of probably a minority of partners that stayed to work for the 13-bank consortium that took over our portfolio, and we liquidated it for them over the course of a little more than a year. And then I stayed a little bit longer to help my friends get a successor hedge fund started called JWM Partners. And I forget the exact year, but I took a sabbatical, and then which turned into a 10-year sabbatical around 2001, 2002, which then eventually led to me founding Elm Partners, which I've been running for the last 5 years, which is kind of a big reverse of direction from very active investing at LTCM to what we call active index investing, which is a much more passive, long-only approach, where we charge clients 12 basis points to help them to get efficiently invested in ETFs and index funds.
I know we don't want to get bogged down in this, and we want to keep things moving, but the long-term capital management situation was a very interesting event. For someone listening to this podcast who wants to find out more information about that and wants to kind of read up on that just out of curiosity and just interest, where should they go? I know there's a lot of information online and that sort of thing. I'm not sure how much of it is accurate. I mean, is there any credible resources which you'd suggest someone turn to if they're interested in finding out more about what really happened?
Absolutely. So So the problem is that the problem with the writing about LTCM is that it was such a big news item that authors and researchers felt that they needed to write about it right away. So the most popular book following LTCM is the Roger Lowenstein book called When Genius Failed. It's a good read. It's a good read, and it can't possibly be 100% accurate, but it gets a lot of the facts of the situation correct. But the problem is that it was written in such close proximity to the event that it really doesn't have the perspective where there's so much more valuable insights to be drawn that you would get in looking back at this, after 15 years or so, and particularly after the financial crisis of 2008. So nobody is really going to write a book about LTCM, that's a fresh look at it, say in 2010, looking back at that, that's from so long ago. So unfortunately, that doesn't really exist. So the Lowenstein book, there's another book by a gentleman named, I just had his name in my mind, Dunbar. Yeah, Nick Dunbar. That was another book written at the time that came out just before Roger's book. So those are okay, in terms of laying out what happened at the time. Those are decent. And Roger Lowenstein's they're both good writers, so they're well-written books. Sort of the most, I would say, to really get a much better idea of the whole thing, though, I would suggest buying the Harvard Business School case study by Andre Perold, P-E-R-O-L-D. So Harvard Business School did a case study on LTCM, and so they collected a lot of facts, and it's very concise. And that's where I would really go to try to get more directly at the facts and save yourself a few hundred pages of reading. So the Harvard Business School case study, I think those are really the best resources for trying to take a look at what happened. But, as I say, the best thing would be for somebody to write a book now reflecting on it, because I think that I think that the lessons to be learned from it are different than they felt in the aftermath.
Okay, excellent. And I mean, I'm sure as we get talking, you'll probably draw on some of those lessons as we go. So I appreciate you sharing those few resources.
Yeah, no, absolutely. I mean, we're all a product of our experiences. So yeah, the LTCM was probably one of the biggest experiences. Certainly by far was the biggest business experience of my life.
Now, Victor, you first came onto my radar. Obviously I was familiar with the whole LTCM thing, but you first came onto my radar recently when you produced a paper. Now, that paper was based on an experiment about a biased coin flip. I'm not going to try and explain what the paper was about. I'm going to leave that up to you. But I'd really like to talk about this. I thought it was quite an interesting experiment. So just to begin things, what was the premise or idea of the experiment?
Well, we wanted to investigate how quantitative, financially trained people would approach wagering on a biased coin with real money. So we set up an experiment where we went out and ultimately tested 61 subjects, where we gave them $21. We gave them a computer program that had a biased coin that you could flip by pressing a button. We told them that the coin was biased 60% to land on heads, and it was. And we told them that however much money they had at the end of 30 minutes, we would pay them that money out, subject to a cap. And the cap they would find out about if they got close to it. So flip away for a half an hour. And within a half an hour, some people who flipped quickly were able to flip 300 times. And you could flip any amount of money that you had in your bank account you could wager on the flip of the coin down to a 1 cent increment. So that was it. That was the experiment.
Okay, and how much would the participants make if it landed on, I presume it was probably heads that paid out the 60%, and then tails was the losing side. How much would they win or lose for each, depending on which side it landed?
No, so the coin was biased. So the coin would land on heads 60% of the time, but the payout you would win or lose whatever you bet. So if you started off and you bet $4 if you bet $4 on heads and it came up heads, you would win $4. If it came up tails, you would lose $4. You could also bet on tails. You might say, why would somebody do that? But people bet a lot on tails. We told them it was 60% heads, and it was, but still people sometimes bet on tails. So you could bet on either side that you want. That was one of the things we were curious about. And the payout was a 1-to-1 payout, but you had a 60% chance of the coin landing on heads.
Okay, I get it. So, I mean, that seems quite bizarre. Why did people bet on tails? I mean, especially if there was a much greater probability of it landing on heads. Why did people pick tails?
Well, we conducted some interviews afterwards, and the two biggest reasons that we found were, one was that, and this is a well-documented bias that people have, is that they kind of feel that things that are random aren't random, that there's predictability in random things, right? So people after a string of heads, like if there were 4 heads in a row, they would be more likely to bet on tails. They couldn't resist. It was like, wait, there were 4 heads in a row. It's going to be tails next. And there's a whole, there's papers and papers written on every one of these biases in the literature. So that's been documented before. The other one, which was really interesting, which I got from my mom. So my mom wasn't in our sample, but I let her, I had her do the experiment, but I didn't count her in there. And I said, Mom, you bet on tails sometimes. Why'd you do that? And she said to me, I know that I should never bet on tails. I understand that never should bet on tails. It's 60% heads. But, it was just so boring and I couldn't help myself. So I think that this boredom is really important. It's a really important aspect of what goes on. That just sitting there and just betting as fast as you can on heads is boring. And that's a bit of a problem for some of us.
Yeah, that's an interesting point. So, once you conducted this experiment, what sort of results did you see? Like, how did the group perform?
Well, people did, especially given that these were, math students, finance students, MBA students, venture capital investors, and investment managers, that's kind of described all of the backgrounds of the people. About a third of the people went bust. A third of the people went bust, flipping a biased coin that's in their favor. About a third of the people, or a little bit less than that, reached the maximum, the payout, which was $250. So a bunch of these, in a lot of cases, these kids, it's like going into one of the London universities, and a bunch of these guys are around, and I'm paying them all out, like $250, for flipping a coin for half an hour. But so it was really interesting. So about 20% of the people hit the cap of $250 or 10x. 30% of the people went bust. The other 50% of the people averaged about $80. Everybody altogether averaged about $90. And this is really suboptimal because a very simple kind of rule, such as I will just bet 15% of my stake on every flip and bet heads, would give you upwards of a 95% chance of hitting that $250 cap. So very suboptimal behavior. What was it, like just under half of the people bet on tails more than 5 times. That was kind of crazy that there was so much tails betting. And we said, as I say, more than 5 times. So I think, I might have bet on tails once just to see what would happen. Like if I bet on tails, would it say, you've just won, you've won, that you stepped out of the box and bet on tails and now you're a winner or something. I might have bet on tails once for $1, but, but like 40-50% of the people bet on tails more than 5 times. So, really interesting. I love this coin flipping stuff. It's great.
Yeah. So, you said, I think if I heard you correctly, about a third of people went bust. They went bankrupt. They lost all their money. What were the reasons that led participants to go bust? Like, did they just bet everything on one flip? Was it...
Well, ultimately, they had to do that, right? The only way you can go bust, and there's 2 ways to go bust, really. Either, you sort of bet, either you make a voluntary choice to bet everything, or you get down to having 1 cent left, and then you can't bet anything less than 1 cent, and so you have to bet the 1 cent, and if you lose, you're bust. But basically, everybody just voluntarily sort of bet their whole stake at some point, and they were out. And normally, what would happen is they bet their whole stake just after they had lost betting more than they should have been betting. So it was kind of like, you had, $15 in your bank account, and then for some reason, you bet $7. Maybe you were following a doubling down strategy, so you bet $7 on heads, and now you had $8 left. And you're like, oh gosh, I got to get back up there. So you bet. So maybe, you would bet a small amount for a while. Then, you're not really going anywhere. So then you'd say, okay, I've got $9. I'm going to bet $4. Now you've gotten to $5. Then you bet $2.50. You lose that. You're down at $2.50. And then, you're like, how am I going to get out of here? And you just start betting pretty heavily as a fraction of the $2.50. And, all of a sudden you're at 50 cents and you're like, all right, the only way I'm going to get out of here is to just bet my 50 cents and get 5 heads in a row or something, which is, I don't know. We should have interviewed the people who went bankrupt more, but they didn't really want to talk about it much. They were kind of out of there pretty quickly.
I can understand.
As soon as, we did have a rule. We said, you cannot leave this room until the half an hour is over. So we were afraid that sometimes, you would get this thing where somebody would say, geez, I got $2 in my bank. I just want to go out and make a phone call. I want to get out of here and have a coffee. So I'm just going to bet this thing and leave. So we said, no, you got to, so we made everybody sit in the room. So even if you went bust, you had to just sit there until the half an hour was over.
Now, you made an interesting comment before. You said something like, if participants had have just bet 15% of their bankroll on each bet, they would have had a 95% chance of hitting the money cap or the payout, the max payout, which was, I think, $250. So where does that 15% come from? I guess we're now kind of getting into optimal bet sizing. But yeah, how did you arrive at that 15%?
Well, first of all, as I was saying, there's kind of a whole range that works pretty well in this particular problem. Like if you were betting anything from like 8 or 9% up to about 20%, you'd have a really, really high chance of hitting that cap. Kind of the magic number, in a way, there's sort of this magic number, which is known as the Kelly number, the Kelly criterion, which maximizes your rate of growth of wealth, named after John Kelly, and lots of books and everything written about that. That fraction would actually be 20%. But given that this game has a cap, that probably you would want to bet less than that Kelly number. The optimal solution to this game is really complicated, but these approximations or heuristics are fine. I mean, you just have to have the insight that you want to bet some. You want to be betting some fraction of your bank on the bets. And you also, if you know that there's a cap, you want to have some idea, you want to have some prior of what the cap could conceivably be. I think any, common sense would tell these guys that I'm not going to walk in and do this experiment and pay somebody $1 million if they make $1 million, right? So, whether it's $250 or $50 or $1,000, these guys should know that, that's kind of going to be the range of this cap, that it just wouldn't be credible that I would go in there and be paying these guys, if they got on a roll, that I would pay them $100,000, right?
Yeah, and when I read the paper, I think it stated in the paper that if someone had used optimal bet sizing with these sort of odds, the payout after flipping a coin for 30 minutes could have been, I think it was well over $1 million. It might have been way over. How much was it?
Yeah, so exactly. So if this game had been uncapped, so one thing that people had no appreciation of is just how incredibly valuable this game would be uncapped. So if this game were uncapped, then the expected value, and this is going to be, I think this is kind of an interesting thing to dwell on a little bit more. The expected value of the game would be about $3 million. In other words, if you flip the coin 300 times, and every time you bet 20% on it, that would be like a 4% return on every flip. And a 4% return over 300 events, is like over 100,000. And so that's where you get to the $3 million from the 25 starting point. So that's the expected value, which I think, none of the participants really, or virtually none of the participants appreciated. But then it's kind of interesting because you get into this question of, so how much would you pay? Let's say that somehow, for some reason, somebody offered you this game uncapped, as unlikely as that would be. But somebody, for some reason, you got to play this game uncapped, just as a thought experiment. What would you pay to play the game, right? You would say, well, it's worth $3 million. Should I pay $1 million to play the game if it's got an expected value of $3 million? Well, the answer is no. I mean, that the way to figure out how much you should be willing to pay to play the game is that you need to bring in a function of your own risk aversion. You need to bring in a utility function. And this is so interesting. It goes all the way back to Daniel Bernoulli and all this work that was done, 400 or 500 years ago. The St. Petersburg paradox is about a game. It's about a game of chance similar to this one that has an expected value equal to infinity, but people are only willing to pay like $10 to play it because the expected utility of the game has a value equivalent to $10. Now, I know that I'm going really fast here, et cetera, and it's sort of, there's a bunch of short pieces on our website that talk more about this, but probably people also have learned this at, in finance or economics classes if they've taken those. But it's so interesting because that difference between the expected value and the dollar value equivalent of the expected utility is so huge. So in this game, the expected value uncapped would be $3 million, but you could imagine somebody who's, sort of normally risk averse, being willing to only pay $10,000, $20,000, $30,000 to play the game, depending on their risk aversion. And so, and the way to think about that is where the real value of this game is coming from is when you're getting a lot more, it's very skewed. If you get a lot more heads than the expected number of heads, it becomes a bonanza. So, and I've got a little bit more to say on that, but let me stop there so you could give me a little more direction. But I've got something that I want to explain on that more as well.
Feel free to do so. I mean, I was going to ask about how this ties into financial markets, so I think that might take us on another tangent. If you want to finish off any further comments you have, feel free to do so.
Okay, so what I'd like to say is that, one of the really key things that this research makes us think about is investment sizing, is trade sizing, and is risk management, all the same thing. And what's so interesting here to me is, let's think about the 60-40 coin for a second again, right? So I said, well, the Kelly optimal bet is 20%, right? Well, what's the strategy that gives you the highest expected value of the game, right? Because I said Kelly gives you the highest expected growth rate. I said the game is only worth in expected utility terms, $10,000 to $40,000, maybe more depending. But what's the optimal strategy to follow if you were not risk averse at all? You had no risk aversion, and you were just trying to sort of get the highest expected value from the game. The answer is that you bet 100% of your money on every flip, and you do that for 300 flips. Now, I think that is just a moment's reflection tells you that is a ridiculous strategy. You have almost 100% chance of winding up with no money left over because you're going to lose. The chances that you don't lose money on 300, that you don't come up tails in 300 flips is pretty close to zero. It's like one of those crazy small numbers. But that's the highest expected value for the game, right? Because, well, that's what it is. Now, what if we said, instead of betting this sort of Kelly optimal fraction, if I said to you, well, look, this is a great game. Forget about Kelly. Let's just bet 50% of our bank on each flip. Well, if you do that, the expected value of the game is much, much higher than it is by betting 20% because you're betting more on a favorable flip. Okay? But what's the problem with that? Well, the problem with that is that you can see that. So first of all, in terms of expected gain, right, I said to you that if you're betting 20%, your expected gain for each flip is 4%, right? 60% of winning $1 minus, 60% of winning 20 cents because let's say that you have $1 of wealth and you're betting 20 cents. That's the 20%. So it's 60% of 20% minus 40% of the 20%, and that is 4%. So you make 4% expected return on each flip. But if you're betting 50% of your wealth on each flip, then the expected gain per flip is actually 10%, because you have a 60% chance of making 50 cents and a 40% chance of losing 50 cents, and that adds up to a 10% return. So that means that after 10 flips, your expected gain is to be at a multiple of 2.6 times your starting point, or after 100 flips, you've grown your wealth expectation to 14,000. But think about this for a second. Let's say you're taking 10 flips like that, and things turn out exactly as you expect, which would be 6 heads and 4 tails, right? Well, let's think about first, let's think about that as being 4 heads, 4 tails, and then 2 more heads. So what does that look like, right? Well, when you make 50% of your money, that's great. Your dollar grew into $1.50. But then when you lose on the next coin, you've lost 50%, you're down at 75 cents. So do that up and down 4 times, right? And you're down to having about 30 cents left over. Geez, that's terrible. But then you win twice in a row, because we said 6 heads and 4 tails. But the result of winning twice in a row after that is you've just grown back up to 0.7. So in the case where you go up 6 and down 4 in any order, if you get 6 heads and 4 tails and you're betting 50% of your wealth, you're going to wind up losing 30% of your wealth. Isn't that crazy, right? That's the sort of downward drift in the median value. And so if you do that a lot, if you do that 100 times, you're going to wind up with 0 left over, 0.03 or something like that. And what's more is that if you think about it in sort of any kind of normal utility sense, you'll see that betting 50% is a negative expected utility investment to make. And so therefore we shouldn't do it. It's a bad thing. You would be better off. So if somebody came to you and said, here's a 60-40 coin, the only thing is you have to bet 50% of your wealth on it, what would you do? Any normal person should say, hey, I'll pass. Thank you very much, and sort of move on. So, I think this whole bet sizing thing is so important. It seems so sort of simple, and it seems like it's secondary to the idea of identifying a good investment. We do need to identify good positive return investments. That's critical. But we also then need to decide how big to be in them. And I think that, one of the great lessons from LTCM is about trade sizing. If we had had a third of the positions that we had, things would have been different. So I'll stop there.
Yeah, I think if anyone's getting lost in this, which is quite easy to do, check out the paper. I'm going to link to the paper in the show notes. So it'll be at chatwithtraders.com. Might make some of this a lot clearer. If you are getting lost, if you're following along, that's even better. But I'll link to the paper in the show notes.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Now, this is all very interesting, but I guess the real question is, what can we learn from this as traders? Like, where can we get a biased coin in financial markets?
Well, the clearest place to get, in my opinion, the clearest place to get a biased coin in the markets is beta. To me, that's the clearest place to get it. Is that the stock market, not only that there's both reason to believe that the stock market will give us a return above the risk-free rate, and also we can verify that on an ex-ante basis by looking at corporate earnings, corporate dividends, and making some relatively straightforward assumptions about the future outcomes. So without looking back at the past at all, I think that we can look at equities and convince ourselves that equities should and do have a positive expected return above the risk-free rate or above inflation. Unfortunately, it's a pretty bad Sharpe ratio compared to what we really want, right? So, I think that it's a bit like a 60-40 coin toss, but with a lot more hair on it than the coin has. So that's one place that we can get, other related sources of beta, similar sources of beta out there. We can also get that sort of positive biased coin from those. So, not only is our global equities likely to have a risk premium going forward, but also, real estate and other related things. But once you move away from that, Aaron, it gets really tough. But there's lots of, there's relative value. There's a lot of relative misvaluation in the world out there. So you can put on, I don't really follow it anymore, but you can put on trades, buying in the fixed income world and different places and find these good relative value trades. The problem is that, I think that the distributions of those trades are really difficult in the sense that they tend to have these big negative fat tails on the downside.
Yeah. I guess one of the big takeaways from this experiment is just showing how position sizing can have such a huge effect on your outcome, after however many flips or however many trades, after doing something many times over. I know one of the people who helped you with this experiment was Edward Thorpe. What sort of comments did he have, and what was his input on this experiment?
Well, I would say that his involvement in it was first inspiration, that he that everything he's done, everything he's communicated to people sort of inspired us in this direction. And then after we had done the experiment and after we had written it up, we sent it to him to get his comments, and he had helpful comments for us. And he had even better than that. He was very encouraging, and he really liked it. And he's talked about it to some of his followers as well. So that's his involvement in it.
I listened to a talk you gave, I think it was at the TransferWise office, and it must have only been the other week. I came across it on YouTube, and I noticed it had only been online for a few days. One of the things you said during that talk I found rather interesting, especially given that you have worked with Ed Thorpe. You said, I don't know if you can beat the market, and I think this kind of ties into what we're talking about. Well, we've talked about prior to this as well. Would you mind just expanding on that comment?
Okay.
Tough question.
Yeah, I'm trying to remember what I said, and at the same time asking myself what I believe in this, because I'm not sure that that's exactly what I said and how it came out. But I believe that certain people can beat the market. I definitely believe that certain people can beat the market. I'm very skeptical that investors can figure out who those people are in a positive, expected manner. So there are, there are brilliant, rare people out there, relatively rare people out there who can beat the market. As somebody who I don't think that I can do it, or I don't want to try to do it, I don't think I can identify those guys in a reasonable time to be able to allocate them money and earn an improved return as compared to a relatively passive form of investing. I think that's what I said to them. And I was talking to them about the paucity of or the lack of power of historical data to help us identify these things. I think that historical data, I know it's very hackneyed when this saying of, or this boilerplate phrase of past returns are not indicative of future performance. But when you do the numbers, when you think about the numbers from a statistical point of view, you'll conclude that that past performance cannot really be indicative of future returns with the amount of data that we have on different things. And actually, I've just got a paper that we're going to post in the next couple of days that's kind of on this topic. And again, it's using a coin. It's using the lens of coin flipping to explain that. To give you a quick preview of one of the opening of the paper asks this question. It says, imagine that you have two coins. There are two coins presented to you, and you're told one of them is a 60-40 coin, and the other one is a 50-50 coin. And you're asked, how many times do you require? You're going to request a certain number of times to see the coins flipped in parallel and count up heads and tails. How many times do you request to see them flipped so that you would have a 95% confidence in choosing the right coin or identifying the biased from the unbiased coin? People's intuition, all right, if people sit down and calculate it, they come to the right answer. But people's intuition is to give a relatively low number, like 20 or 30 flips, that in 20 or 30 flips you would get there. But the answer is 143. And what that kind of means is that it takes 143 years to differentiate an investment manager that's giving you a 0 Sharpe ratio versus one that's giving you a Sharpe ratio of 0.2. And slicing the data up into weekly data or monthly data doesn't help at all. So anyway, that's about half the paper I just gave you right there. So, but hopefully you'll enjoy the other half of it when you get to it.
Yeah. And where will that be available when it comes out?
It'll be on our website, and by the way, people can sign up to get our thought pieces as we put them out there. Just go to the website and you can sign up, and then we'll send you our blog pieces. But that'll be on our blog and also on the Elm Labs website, and hopefully in the next couple of days. We're trying to make it interactive, so we want to make it where you go there, we ask you the question, you put in your answer, then we talk about it, we ask you another question, and then talk about it some more. So we think that's kind of fun.
Oh, okay, good one, very cool. Are there any parting words of wisdom you'd like to leave with us? Anyone who's listening to this, Victor, anything you'd like to add to take us out?
No, I've really enjoyed this. I think that I don't really have very much on the wisdom front, so I hope you'll have me back sometime. I really enjoyed chatting with you and sharing thoughts and experiences.
I've thoroughly enjoyed this, Victor. I appreciate you coming on. So if anyone wants to find out more about you, elmfunds.com. And are you on Twitter?
No, I guess I should. I'm hoping to do that soon. I haven't figured out Twitter yet. Sorry, I'm a little bit slow. But I did do LinkedIn, so I've got Twitter ahead of me, and also Facebook is in my future, I think, or in the future of our company. But at the moment, LinkedIn, but hopefully soon on Twitter.
Okay. Very good. Well, again, Victor, thank you for coming on the podcast. I've enjoyed it, man. Again, thank you.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast on iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.